So it's a rainy day, so I understand. uh, People will slowly reach because our destination is also on the rainy day. It become difficult. Uh, so I request my council colleague to escort the speaker for the day, for the session. Sorry, we have so. So I request back office to start the ICI motto song to start the event. Request to everyone rise for the motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you. So as you know, today's program is on the conference on merger, acquisition and business restructuring. And total there are 4 sessions. So we will be starting with the some sort of a to start it on for the day. We'll be starting program with the future outlook, including opportunity under the IBC framework. Give you the overall overview of the entire subject. And then the next is on the tax implication or the tax opportunities in the merger and demerger. And the third session is on more on accounting of the same transaction. And the last will conclude with the panel discussion. So before we start, let me briefly talk about the WRC activities. As we already completed 4 months, and during this 4 month, WRC has organized many innovative and unique events under the leadership of my chairman Saurabh Ajmera. So starting with we in the somewhere in May we have organized a program on Global Capability Center at the Geo Convention Center, and that's a unique program. That sort of program was never happen in the WRC. The Wealth Conclave, a program specifically curated for AI fund and the family wealth. We also last week we concluded again a different program, a summit on the startups and the MSMEs. So that event was also happened at the Geo Convention Center. So similarly, events are also will continue to do in the next 3-4 months, 5 months, whatever the balance tenure of 8 months are there. And during this 128 days, I think more than 120 events has a large event has happened under his leadership. So I request everyone to take the benefit of this knowledge building and take the advantage of these events. I'll come to this event. So we'll be starting this event. I'll request my council colleague Piyush Chandak, he's the past vice chairman of the WRC, to introduce the speaker for the day. Thank you.
Thank you, Rakesh bhai. First of all, like we were discussing on the 8th floor with the speaker that today are rains, but I was thinking that looking at the topic and the number of registrations we have, at least youngsters will make it and be present at the first day. And I can see the youngest person over here, he raised his hands as well, that he is here. And also I'd like to put your hands together for this person who has made it. And again, in that row, are you students or chartered accountants? Can I? CAs, but don't tell me you are from INCOP. So I knew. So that way, but the topic is like nowadays, when I was the chairman of Vikasa and dealing with students before 2 years in WIRC, the lot of queries and lot of things students came to us that we want articleship in particularly this kind of area, and firms are very few, and how can we get, and how recommendation likewise. So we were thinking कि यहाँ पे थोड़ा ज़्यादा mob होना चाहिए आज. Anyways, the speakers are always enthusiastic, और हम लोगों ने देखा है, we have the history in Indian culture and mythology. The one of the best example of a speaker giving the whole entire seminar to only one person who was the listener, and that example is Bhagavad Gita, wherein Krishna was giving his lecture to Arjuna, and that is how the speakers are also now enthusiastic. They are going to give you the best of the knowledge they have and the experience sharing with all of us. So today we have CA Margav Shukla, who is a chartered accountant and law graduate over 15 years of experience in direct tax advisory, corporate restructuring and insolvency matters. With expertise in international taxation, tax litigations and IBC advisory, he has successfully handled high stakes cases before tax authorities, including significant search and seizures and CIRP matters. He was widely recognized for integrating business restructuring strategies with tax compliance and insolvency frameworks, while also contributing as a thought leader through industry articles and professional forums. So let us welcome again with a round of applause to CA Margav Shukla ji, and I'll request the Treasurer WIRC, CA Rakesh bhai, and the coordinator to join to felicitate the speaker for the day, for the session.
Hello, hello. Good morning to one and all present here. Very warm welcome to this M&A session. One of the best part of this session is that it has four topics which has been selected, and the topic which is given to me is not only simply M&A but M&A under IBC. So up until some time, I used to call IBC as the newest of the law, but that status has changed for IBC because we now have Income Tax Act 2025. So I think now IBC no longer remains the newest of the law, while in practice, it has not been touching each and every chartered accountant as far as the practice of IBC is concerned. But we were fortunate enough to have a co-founder in form of Mr. Jayesh Sangrajka, who is one of the leading RPs, who has handled a lot of he has resolved lot of CIRP cases, and on account of which the desired exposure was given to us. And though my profile said that it is 15 years of experience, if I talk about IBC, it is only 10 years, because that's what the law has been in practice for. So it came in 2016, and 10 years of IBC, various sessions have been taken on IBC. But how it is relevant for mergers and acquisitions is what we are going to focus on. So while other 3 sessions are simply going to talk about the M&As happening in the field which is profitable, M&A talks about taking over the companies which are in distress, right? So majorly we have seen, how many of us here have practice in the field of IBC? If somebody can, by the raise of hands. Some work in relation to IBC, anybody? Because the numbers are low, I'll have to go, 1, 2, 3, 4, 5, 6. Yeah. So as we see, out of the total people available here, only 6 have touched in some way or the other, or maybe in the best possible way, the IBC. So how it is important, while we know that we are now used to seeing loss-making companies going for IPO, I'll not name them, be it Zomato. Okay, I can, because it's a listed company. So yeah, Zomato. Then we have Zepto, who's going to go for the IPO. So in the IPO scenario, we all know that a loss-making company can still go for IPO, depending on the information that it has. And if it is a company which has, which is in the day-to-day use life, I think those companies are getting far more subscription. The another reason for subscription, as we all know, is the grey market premium, GMP, wherein people are just going for the purpose of booking the profits. But capital gains is not the topic for which we are here, obviously. We are here for mergers and acquisitions, which happens at a scale. One particular myth which would be there as far as the topic is concerned, that M&As only happen in an area where the acquisition is for a particular amount and particular threshold, for example. So we have all heard of bigger cases where in thousands of crores the cases have been settled under IBC. But we also must know that cases under IBC are also resolved for an amount as low as 72 lakhs. So 72 lakhs is one benchmark. At the same time, the cases have been resolved for 42,000 crores. We all know the case of SR Steel, which was taken over, a steel plant which faced turbulence because of the debt, growing debt. The debt grew, because of which the company went into CIRP, went into insolvency, and thereafter it was taken over by SR Steel for a staggering amount of 42,000 crores. So not many people would have infused that much amount of money, but yeah, through IBC it was possible. 42,000 crores, a plant which was there was taken over. So we'll look into how IBC presents a unique opportunity to scale your business at a valuation which is very attractive. And why I say so is something that we'll run through in next 1.5 hours. So one thing which I think everyone will take home is that IBC presents a very good opportunity for expansion, for growth, if it is in the line of the business which you are looking. So if you are aware, some company in your line which has gone into IBC, it's a great opportunity for you to expand very easily. At the same time, IBC does not stop you from acquiring something which is not in your line of business, but you are interested in the assets which the company has. So one of the best examples which we got to work on was a company which was engaged in the printing business, right? And it was taken over by a company called as Technologies, which is into the internet thing. Now, one would think that how a company, internet company, took over a printing business. And that is exactly what, promoters also had challenged in the NCLT, that it will not continue the business of printing when it comes to the takeover by the resolution applicant. So the reason why SIFI Technologies took over Print House India Private Limited is because they wanted a land which Print House India Limited had in its balance sheet. So the major price, it was acquired for an amount of 56 crores. All these numbers are also available in the public domain, so I can quote them. There is no harm. NCLT, the websites are, NCLT and IBBI are the two websites wherein you can get to know of all the major companies which are into CRP. I'm sorry, not major, all the companies. So you can get these information. So 56 crore was the amount of acquisition which was done by SIFI Technologies of a company which was in the printing business. So it did not ever intend to continue printing business. But NCLT upheld that value maximization is one of the biggest proposition. So IBC helps lenders recover that money, but it is not only a recovery mechanism, it helps to continue a business which was in distress because of the issues created by the then promoters by way of taking funding which was not correct, and correct form of funding which they took, because of which they went into insolvency. So we should not restrict ourselves to think that the acquisition has to happen in the same field of business. It can interest you only even if you have certain assets which interest you, and the acquisition can be done. So that is something which is to be kept in mind. Now we'll move on to the M&A landscape. Print House Private Limited. SIFI, SIFI Technologies Limited. Value maximization. And they said that we will put that particular land to an even better use, because printing as a business is losing its sheen. It's a loss business. So even if I continue, it will not add value to the ecosystem. Now we all know that we only take pictures in mobile phones, right? Who gets the album printed? It's an outdated thing. So printing business, NCLT upheld that if the value maximization is happening, and if they will add value by taking over this company, that is sufficient. So we'll look at what happens in the M&A scenario. I'll not go through the numbers. The market momentum, we all know that large number of deals are happening in M&A. IBC is just one piece. Strategic capital, a lot of money is flowing in through M&A. Sectoral transformation, a lot of money are going to specific sectors. AI is the buzzword, but there are other sectors also which are growing. IBC as a deal catalyst. Most of the distressed assets, we all know that before IBC, it was BIFR, wherein the timelines were not defined, and if a particular company goes into insolvency, it used to simply die. So machinery used to get outdated, obsolete, and there was no proper mechanism by which the company was taken over by somebody. That was the challenge of BIFR, because of which IBC was brought into enactment in the year 2016. And I think based on the number of deals that it has achieved, number of companies that it has revived, number of employees that it has given job to, and the number of home buyers that it has given homes, has been substantial, and it has been an event which has of importance, because home buyers are one such category. In case of a real estate scenario, people have booked homes. We all know in Mumbai, every other lane has a redevelopment happening, and this session is again not on redevelopment, but lot of home buyers booked homes with the private reputed developers. But real estate is one such place where as soon as you go for a funding, the debt meter starts, and because of the debt starting and delays on account of the procedural aspects, they are not able to complete the projects on time, because of which ultimately they are not able to fulfill the promises. The projects are stalled for a number of years. One such project wherein we had the opportunity to work was Aristo Developers Private Limited. So it was a project in Mulund area. It was stalled for at least 15 years. Thereafter, because of the IBC, it was taken over by Prestige Group. We all know Prestige Group. While we were coming, most of whom who has come from the Bandra side would have seen Prestige all over. Now we can see banners of Prestige all over, but their primary situs was in Bangalore. Through IBC, they acquired a company, which is Aristo Developers Private Limited, and now they have foothold in Mumbai like anything. They can see at the prominent locations. So most important thing, while the lenders got their money, the recovery for lenders was 67%. But to my mind, that was not important to us. What was important to us was that the home buyers who had paid hard-earned money and saved that money and paid to the builder, they got homes when the project was resolved, and it was delivered by Prestige Projects. So I think IBC impacts many areas. It is not only a recovery for lenders, but it is acquisitions. It is strategic acquisition for a company like Prestige, who could establish its footprints in a city like Mumbai. It's a game changer. Yes, yes. Highly phenomenal. So this acquisition would not have been possible easily to take over Aristo Developers, but because of the IBC and the mechanism it has, it was very easy for a Bangalore company to come to Mumbai and resolve this company. So, yeah. Infrastructure push, key factors are capital availability, economic growth, technology, manufacturing. I'll not bother you with the numbers. But basically key frameworks, which are the key major acts which gets applicable when an M&A is triggered. Companies Act, we all know mergers and acquisitions happen under the banner of Companies Act. Competition Commission of India, you need a permission from Competition Commission of India when you breach a particular threshold, and the threshold keeps on revising. So if a particular market share is breached, if a particular turnover threshold is breached, if a particular asset threshold is breached, it is imperative for you to take permission from CCI. SEBI takeover regulations, it comes into picture when a listed company goes into CIRP. Yes, you heard it right. Even listed companies go for insolvency. Even they are not. Exactly. So they also goes into insolvency. Correct. FEMA, whenever there's a cross-border thing happening, so IBC in its 10-year journey has seen a few of the cases, like ArcelorMittal in a joint venture had bidded for an asset. Huge money was pumped in that particular case. Similarly, there was a case wherein there were oil fields. Oil is the buzzword today. Everybody tracks oil prices. Earlier, they used to only track what is the price of oil for a 5-liter or a 15-liter jar which is being ordered at home. But because of the Trump effect, everybody has started tracking the oil prices as well, because it directly affects the Nifty and Sensex and hence your investments. Yes, sir. One oil company which Videocon was the company. Again, I can name them. It was one of a subsidiary of Videocon. VOVL was the company, Videocon Oil Ventures Limited. It was a joint venture with Bharat Petroleum subsidiary. So it had rights in Brazil oil fields. And why it was interesting is that while it was in CIRP, one of the important clauses which we always draft in a share purchase agreement, that is right of first refusal, that came in handy for Bharat Petroleum, not British Petroleum, Bharat Petroleum to take over that particular company which had 35% stake in the joint venture. So while the process was run under IBC, every bidder, there were various bidders who had bid for the company for the 35% stake in a joint venture. But ultimately, COC decided that this should go to the Bharat Petroleum because they have the right of first refusal. And they don't want at the end, when a resolution plan is put up before NCLT, Bharat Petroleum would have challenged that because it had right to buy that particular stake. this money was ultimately, the case was resolved by the Videocon company. The acquisition happened by Bharat Petroleum. So this is one case where the assets were outside India. The company holding those rights was in India. So insolvency happened in India. And that is how it was ultimately resolved. So there were various buyers, because oil is something which no one would like to leave. Even our Mukesh Bhai doesn't leave oil. So that it received various bidders interest. It gave interest to various bidders, but ultimately because of the ROFR clause, the company could have been acquired by the Bharat Petroleum subsidiary. Then IBC, we are going to talk about it. I have 44 minutes left, and I think it should be sufficient. And the Income Tax Act. Ultimately, any transaction happening under the Companies Act or under insolvency, income tax professionals are always there at the forefront, because a particular deal could be a deal maker or a deal breaker, depending on how we advise what should be the structure, right? So income tax professional sits in the front, though I have mentioned Income Tax Act at the last. And if you see, I have not mentioned the 1961 Act or a 2025 Act, because M&A, you might be defending an M&A which has happened prior to 31st of March 25, or if you are advising a client, Income Tax Act 2025 would be applicable. So yeah, importance of that. Geopolitical and tariff risks, we all know how it is impacting us. I think sometimes we forget that whether Mr. Narendra Modi is our Prime Minister or Mr. Donald Trump. Inbound deal activity, we all saw, as I mentioned, ArcelorMittal was one such case wherein a huge amount was infused through IBC. That takeover happened. So foreign money came in to resolve an Indian company. That also talks about how good our laws have been. So much attractive that it gives comfort to a foreign national, foreign investor to invest in a company which is a stressed company. Usually we all run from a stressed company because nobody wants to get involved with it. Outbound expansion, similarly, as I mentioned, the Bharat Petroleum's case, though it was acquired by an Indian company itself, but the assets were in Brazil. Sectoral capital flows, so various sectors, whichever goes for insolvency, the money is getting pumped up. There are hardly any cases which does not attract the bidders. These are some of the numbers, deal values. We'll not get into that. The value deals are increasing day by day, though we are saying that the markets are bad, but it is not stopping. Correct. Correct. So expansion is something that always happens in any market. And so if you see the numbers 7.99 and 10.5 lakh crores, these are the numbers of the deals that has happened. So what has happened from 15 to 20, 21 to 26 and 26 to 30? So every 5-year period, there is a buzzword. AI is currently the buzzword. ESG is another buzzword. If we want to know what is trending topic, we can always go to WRC website, because they conduct seminars on the trending topics always. So what is the future outlook? AI and digital infrastructure, ESG and energy, advanced manufacturing, enhanced IBC-led distrust M&A. Because as the law evolves, and there have been amendments as it happens in any law, IBC has also seen numerous amendments which are happening, because ultimately huge amount of money is being put in. So one such case, I mean, all the practicing IBC professionals would know that there was a case of JSW which had put in money to the tune of 20,000 crores. 20,000 crores was infused in a company, Jayaprakash Associates Limited. What happens in a typical IBC deal is that there are two parties. There are more than two parties who submit the plan before the RP. Bhushan Steel. So more than two parties put in the money. What particularly happens is the COC votes in favor of one particular company. And since other party has put in lot of efforts to acquire that company, that particular company challenges that this award, this company, which is being going to one particular entity, the successful bidder, the successful resolution applicant, it should not go to him on account of X, Y, Z particular reasons. So this order was passed somewhere in the year 2020-21. They had put in money to the tune of 21,000 crores and 20,000 crores, and they had made various additions to the plant and machinery to the plant. Supreme Court delivered a judgment that there were fallacies in the process. There were delays in the process which could not have happened, because of which the deal has to be cancelled. So imagine a scenario where a company you have taken over, 4 years have passed by, and then Supreme Court passes this order. How do you unwind the transaction? That is a bigger thing in this. Supreme Court did not look into that. Supreme Court passed an order stating this money has to be returned back by the bankers because the money had gone to the lenders. 20,000 crores has to be given back to the bankers and they will restart the process. Review petition was filed by the successful bidder, and based on the review petition, the order was passed that while the procedure part is relevant, it cannot unwind a transaction which was followed by the COC, and they reiterated a principle which is very widely used in the IBC scenario, that is the commercial wisdom of COC. COC is Committee of Creditors, which stated that the person involved in that company, if the stakeholders does not have a problem, then the third party who did not get the award cannot be a party to dispute before the Supreme Court. So the matter travelled from NCLT to NCLAT, National Company Law Appellate Tribunal, to Supreme Court. But ultimately Supreme Court upheld that it is the money of Committee of Creditors which has been at stake. And if in their commercial wisdom they felt that they should go to this successful resolution applicant, merely because there was some lapses, it cannot be said that the resolution entire process fails. So that was upheld. Bhushan Steel. Yeah. Correct. JSW. So we'll look at what are the general options which are available. We see share acquisitions happening, share purchase agreements being drafted, share swap in a case where you want to consolidate a holding and give up a holding in a particular company. We all know slum sale, wherein we transfer a business undertaking which a particular company wants to transfer and the interested buyer is interested in taking over. We know that M&A typically happens through mergers and demergers, the scheme through NCLT or through a fast track route. Then we have this IBC route which we have been discussing for last 20-25 minutes. So we see what is the traditional measures. The traditional measures include executing the contractual documents depending on the nature through which you acquire a particular undertaking or a company. Whereas in IBC, the resolution plan is the principal document. In case a company is in CRP, it is resolution plan wherein you say that you will pump in this much amount of money. It will go to these lenders and how you will revive the company. What will be the capital structure? Who will be the directors in the company? That the resolution plan is put before COC, which has who has given the company the loans because of which the company went into insolvency. So it is put before COC. It is put to vote as to the company should go to which particular lender. So value maximization definitely is the objective of the COC so that they get the most out of a distressed company. Once COC approves it with a majority, then the plan goes to NCLT. NCLT checks whether the provisions of IBC under section 30 and 31 are complied. It also checks that it is not taken over by the erstwhile promoter. Because this, yes, related party as we call it, that it should not happen that through backdoor entry, the erstwhile promoters are only taking over the company because the real value the promoters would know. But since they could not do it in the first attempt, which is because they were running the company, their rights were suspended when a particular financial creditor or an operational creditor goes to NCLT, stating that this company is not paying me a loan or a amount which has been paid to them, they are not returning my money to the tune of 1 crore. That is the threshold today. Initially, when IBC was introduced, the threshold was only 1 lakh of rupees. So if a company did not give your 1 lakh, which I think would be more than the 1 lakh, I mean, we do charge more than 1 lakh to a company. So it was not only you could not give an NOC to the another chartered accountant, but you could take that company to NCLT because it did not pay your dues. So 1 lakh. That amount was, that threshold was increased to 1 crore. And with 1 crore as a threshold, you could take the company to insolvency, wherein RP would be appointed. And he would run the company and director's powers are suspended. So resolution plan becomes the most important document. Every other thing is seen from the view of what you had provided in resolution plan and the NCLT order which approves it. Now this is only one part. You can also take over a company once it fails the resolution plan level and the company goes into liquidation, wherein you have an option to buy a particular asset, because once the CIRP period is over, corporate insolvency resolution process, the second level is the liquidation, wherein liquidator is appointed and liquidator gets one more chance to sell the company as a going concern, but now the going concern has been amended and it has been removed. So they don't want a company in liquidation to go as a going concern to a stakeholder. Now, so IBC law by 2025 amendment, they've removed this. So now in case of a liquidation, there is an itemized sale of asset. Now, if you are interested in a particular asset in a company, liquidator comes up with an auction notice. It is a very transparent process. They published forms wherein they give details of the asset and you can acquire one particular asset. So in my earlier example, in case of a print house, the company Sifi Technologies did not wanted that company to go into liquidation in first place. It did not wanted an asset by asset. It ensured that it took over the asset. It took over the company, because had the company got into liquidation, there would have been many such buyers who would have been interested in such land. And if that only land would have gone for the sale, that would have been a challenge for Sifi Technologies, because then he would have to bid at a very high price for the land acquisition. So it took over the company at CIRP stage itself. So resolution plan, wherein you take over the entire company. Under liquidation, you take over individual assets, which is a very simpliciter case as we buy any particular asset. In liquidation, you can buy a particular asset. So that's what we spoke about. Section 30-31, as I mentioned, that section 30 gives is in relation to submission of resolution plan. 31 is approval of resolution plan. The law gives you various protection, that any wrongdoings, any misdoings, any past assessments, because we have income tax professionals, I have to say that, any past assessments, any past TDS defaults, every creditor, including the tax authorities, income tax department, GST, they have to file claims when the company is in CRP. And once the company is resolved, nobody can come to the new buyer and say, this is the amount that is payable. So it gives you protection from all the past liabilities, which is the most important thing in any M&A deal. We have seen deals being lost because there is one particular dispute and the buyer always says that this dispute will get resolved for an amount of X money. I want to give you the entire consideration subject to that X money, which can be kept in an escrow account, or it will be paid when the particular assessment is resolved. So what happens is, in that scenario, say the deal value is 100 rupees and the we'll take an example of assessment, it can be any other thing, but an assessment is pending or assessment order is passed and the matter is challenged before CIT appeals or a tribunal, and the quantum is 25 crores. How would you advise a buyer that what would happen to the demand of 25 crores? So what would typically happen is that I would say, out of 100, I will pay you 75, 25 will keep it in an escrow, and or it happens by way of an indemnity, but we all know how much indemnity is enforceable. Thank you, sir. So indemnity, it becomes very difficult because as soon as the seller goes out, you are not in connect with the seller that you will be able to recover that 25 or whatever the disputed amount is. Now in this case, IBC itself provides you that protection mechanism. you can always say that this is the NCLT order which has given me reliefs. Still there are claims which are being filed, which has to be contested, but indemnity is not a foolproof document as against the provisions of the law and the order of NCLT. So it always comes to the rescue. We've all seen that tax authorities are still reopening assessments for companies which have been taken over. So we have guided various resolution applicants, and we still see that the past notices are still coming in to the resolution applicant, that because the company remains same, the assessments are being opened because there's no carve out which has been given under section 147, 148, 149. So while we have a provision in IBC that states that you cannot be bothered for past liabilities, Income Tax Act itself doesn't have any provision which gives a leeway to the assessing officer to not reopen the case of a company which has been taken over by the resolution applicant. But we have various authorities in form of Bombay High Court, Delhi High Court, which have quashed the reassessment notices which have been issued to the resolution applicant who has taken over the companies in CIRP. So while the provision is very clear, it still requires High Court to come into picture because of absence of provision in the Income Tax Act. Supreme Court in case of Monet Ispat has already interpreted long back that whenever there is a conflicting provisions in case of an Income Tax Act and an IBC, IBC prevails. So there is a section 238, which says that notwithstanding anything contained in any other provisions of any other act, this law shall prevail. So while the section was a 3-line section and it was unambiguous, Income Tax Department still disputed it and went up to Supreme Court stating that we have the powers to recover, because Income Tax Department, obviously that money is recovered for the purpose of interest of the nation, but we all know sometimes how much aggressive they go. So Monet Ispat was a case wherein they held that IBC prevails over income tax. So when an IBC, NCLT, the court which is authorized by IBC says that all your past liabilities are quashed, it has to be quashed. You cannot reopen by issuing a notice under 148. So that's the protection which we get. The reason of emphasis is that while in any M&A deal we take an indemnity, but indemnity always is a deal maker or a deal breaker, because not every promoter who is selling is ready to give an indemnity. Because if you ask a particular promoter ki your litigation is happening, how much do you think you will be liable to pay, he always says no, nothing is payable. Nothing is payable. This will never come up. This, I mean, GST authorities will not, the appellate authority will always decide in my favor. Tribunal will always decide in my favor. But the cost involved in that, the interest element, all those things, we were advising a particular client wherein it was taking over a classes business, wherein the entity was teaching large number of students. This is a private deal, so I will not give the name. But in that particular case, the deal value was agreed between the two parties at 10 crores. They had an ongoing assessment in relation to payment to teachers that was being disputed in one of the past assessments. And the outstanding demand was to the tune of 3 crores. And we were advising the buyer. So in that particular case, we had a similar scenario wherein we said that out of 3 crores which is pending as on date, we'll keep 50% as set aside in an escrow account. We'll pay you the balance 8.5 crores. But they said, no, we have already agreed on a deal value of 10 crores. You're supposed to pay me 10 crores. I'll fight this case for you. But based on the submissions which were made at the assessment level, which we had reviewed, we were of the opinion that this will at least take another 10 years. The simple reasons behind that were two. Not sufficient documents were provided at the assessment stage. So we all know what happens at the appellate stage. CIT appeals now has the power of set aside. Right. So even if you give, sir, even if you give additional evidence, which is possible at the CIT appeal stage or a tribunal stage, because they are of the view that ultimately justice should prevail and you should get one more chance. But what would have happened in that case is, first of all, I would have taken over the company. I would have taken over that particular entity. The documents were available with the erstwhile sellers. And if the matter would have gone to tribunal and then tribunal would have set aside to the file of the assessing officer, I would have seen that litigation ongoing for next 10 years. And I asked my client a simple question, whether you are okay with a contingent liability of a 3 crores in your books and 1.5 crores sitting aside in an escrow account. So that litigation cost, we had argued with that party that this will not fall in our case. You will have to fight. And he agreed to it because he said, ultimately, I will lose this money if I don't win. Because I had set aside that amount. But for a seller, it was not sufficient because he says that if out of 10 crores, you remove 1.5 crore, this deal is not making sense to me. And for buyers, the deal was not making sense because they did not want to take the liability on their head. Because it was ultimately, if say for example, he does not honor that indemnity, the so-called indemnity, it would have fallen on me because this entity was being taken over by myself. So ultimately that deal did not happen. So had this case been in an IBC scenario, I think it would have been easier because the protection would have been far more greater and in terms of a statute rather than an indemnity. So IBC also provides that in a resolution plan, you can also say that this particular company would be merged in the resolution applicant or the otherwise. Sometimes we have seen that resolution applicant, the taking over company also merges its business in the defaulting company or the corporate debtor as we more popularly call it as. And those mergers are typically seen where the corporate debtor has huge losses. And losses is also one more area because of which the companies are sold in case of CIRP. We have seen huge losses being incurred in past by the corporate debtor, and the resolution applicant pays price for the tax benefit which he is going to get over a period of few years. So while we were talking about that it need not be the same business, it need not be a particular asset, we have seen companies being resolved on the strength of the losses. Because as we all know, we are, for every rupee earned, we are losing 25 paise in case of a company. So we've seen deals happening because of the huge losses which the corporate debtor had. So you can provide for mergers and acquisitions in the plan itself. NCLT approves it, but we have seen various litigation happening wherein NCLT has stated that merely because you have a merger proposed in the resolution plan, it will not straight away be treated as one company. You have to still follow the procedure under 230 and 232 of the Companies Act as it stands today. So various professionals had a view that once I write it in a resolution plan and once it is approved by NCLT, everything is taken as done. But because NCLT is the approving authority for a resolution plan and NCLT is the approving authority for 230, 232, a merger scheme, amalgamation scheme or a demerger scheme, they said no, you have to come to us once again under 230 to 232. So it is not exempted, but you can provide in the plan. M&A with IBC, M&A without IBC, it all depends on the target company which you have. If your target company is not in IBC, you cannot take M&A with IBC route. But what if you have two target companies, one in IBC, one without IBC? So what happens is IBC is a time-bound resolution process. 330 days has been mentioned in the statute, but resolution professional who runs the company has an option to, take an extension, which in most cases do happen. But still, the process gets completed within a period of 2 years to 2.5 years. And as far as the acquirer company is concerned, his time only starts once he puts the resolution plan. So it is a time-bound process. M&A, we all know sometimes the deal keeps on happening. And I think the chartered accountants are the ones who lose a lot of amount of time because we quote a fee for advisory, assuming that the deal will get over in 3 months, 4 months. But sometimes the negotiation keeps happening so much of time. Sir says 3 years. So, correct. So deals, yes sir. Yes sir, tax amount. Yes sir. Yes sir. So basically, fortunately, as I was mentioning that under section 147, 148, 149, there's no carve out. But fortunately under section 79, there's a specific carve out stating that provisions of section 79 will not apply to a company which has been taken over in case of a CIRP. So what the basic condition of 79 is that as soon as the shareholding of 51% changes, you cannot take the loss. And in case of a resolution applicant, 100% changes. Because one of the basic lines in any resolution plan is that all the equity shares of the past company, the shareholders, will get cancelled. And a fresh issue of equity shares will happen in the favor of resolution applicant. So if you see in this case, strictly seeing section 79 is violated. But 79 specifically says in subsection 2 clause C that in a case where a company is being taken over by CIRP by way of approved resolution plan, in that case that violation will not trigger. So I will be able to continue. Sir, IBC will prevail, but here fortunately Income Tax Act also gives me a provision. So in that case it is easier to argue before a tribunal. Sometimes it is difficult to convince. Sir, precisely. So what typically happens, why a particular tax demand cannot be carried forward is because resolution plan deals with all the liabilities of the company. So it can be from a financial creditor like SBI, Axis Bank, whatever. It can be from an operational creditor who has provided services to you. It can be from tax authority, be it income tax, GST, dues, property tax. We have seen all kind of things. Electricity, companies are not being paid. So all those companies are supposed to file claim with the creditors. And ultimately what happens is that the role of RP is to sell the company whatever best value it can get. Now the best value what a company gets is the amount of value which is then to be distributed between the committee of creditors. And typically, though in CRP case 53 is not exactly followed, but the distribution happens in that particular manner. And fortunately or unfortunately, income tax department sits fifth in the row in the distribution mechanism. 1, 2, 3, 4, 5. Only when 4 people have got their entire money, the 5th people can get any money. Correct. And what typically happens is that since there are, once a loan account is classified as an NPA, it still takes around 1 year, 2 year, 3 years time. And what lenders typically have a clause in any loan agreement that the interest rate, penal interest rate will be 18% and 24%, while the original rate is only 10-12%. So their amount becomes so huge that they are not able to pass on any money to the second level, unsecured financial creditors. Now coming to the specific. Sir, perfect. But there is a time gap between the loan becoming NPA and the loan, the company being admitted into CIRP. So I am talking about the excess interest in case of the period loan becoming NPA, because not immediately any lender goes to the IBC. They try to resolve. And this resolvement has also costed a huge amount to Bank of Baroda. If you have read yesterday's Economic Times, it was a reverse scenario because we are in this discussion. It is very important to know that Abu Dhabi Global Management, ADGM, NMH Healthcare is the largest healthcare provider in UAE. This is very interesting to know because first time in an insolvency scenario, a bank has been made to pay an amount to the administrators. And how it has happened is this way. The debt amount is to the tune of 67,000 crores. This is happening in UAE. This insolvency is happening in UAE. And how it affects an Indian bank, a Bank of Baroda, which we don't even look at very respectfully, not a private bank. Bank of Baroda, having a Dubai branch, had given loan to NMH Group, one of the largest healthcare provider in UAE. It has also its businesses in England and various other locations, but the insolvency is happening in Dubai. And what the administrators have done in that particular case is that they've filed a claim against Bank of Baroda itself. So as I was explaining, lenders file case with RP. Here RP has filed case on a lender stating that you have colluded with the promoters. The debt which you have given, by no reasonable circumstances any lender would have given. Because as we all know, lenders are also in pressure to give the money because that is the spread how they earn the money. So in this particular case, administrators filed a claim on the lender. So it was a very funny scenario. Bank of Baroda had given loan to NMH. So they had already filed a claim in NMH. But administrators found out that they have given money in such circumstance which nobody could have given. And it was just a claim filed on Bank of Baroda. Without even that claim being settled by the authorities therein, Bank of Baroda has agreed to pay an amount of 5,600 crores. 5,600 crores, yes. Sir, I will answer to that. Because it was linked, I went there. I will answer that. Right. Why administrator went behind the lender, right? Which is a regular question. So in India also, in IBC we have section 66, which says that if any person has acted in connivance with the promoter, this is not allowed. So what happens in a COC scenario is that there is not most of the time, but there is not one lender. There are 4 lenders. So in this case also, BOB was not the only lender. So say for example, there was HDFC Bank. I'm just giving an example. There was HDFC Bank, there was Axis Bank also sitting in the committee of creditors. They said that this loan, at the point in time wherein this loan was refinanced, we would not have given any loan. So they requested the administrators that this loan should not form part of COC itself. And there is a mechanism and there is a procedure. You should file a counter claim on the Bank of Baroda that instead of you asking for money from the administration, you should recover money from administration. So the best part, which I mentioned, that despite there is no order of any authority of the UAE, Bank of Baroda suo moto has agreed to pay 5,600. Imagine what papers they would have at that point in time that they did not even go into litigation. Correct. Correct. Yes, sir. Sir, definitely. But so far it has not been invoked. Under the IBC, so what happens most of the time is we have PUFE applications, preferential undervalued fraudulent transaction. There is a specific section and most of the COC goes behind the erstwhile promoters, as we call it. So PUFE is basically targeting them. This was a case where, I don't know, it would be thought of which person who initiated this, and ultimately even without the matter being decided. So that's what I'm saying. It's like your audit papers are so bad that you propose to settle even before the disciplinary action starts. Something of that. Exactly. And imagine the bad repute which it got with it. That despite no order, the amount is being paid. Now, sir, addressing your question, that Income Tax Department has a outstanding claim of 5,000 crores. We are handling one company wherein the value is 7,000 crores. Now, in a scenario where there are losses which are being incurred, so there are 2 separate provisions which are governing this. One is a clean slate theory, which I have covered in my slide at a later point in time. That clean slate is guaranteed to you. Nobody can claim a past amount because you are doing a one-time settlement, as so to call it. The one-time settlement happens by the successful bidder. He pays one money and it is deemed that all the liabilities are extinguished. So that is first part. The second part comes with respect to this. There are past losses. Now past losses, as you rightly mentioned, sir, that those losses can be allowed to be carried forward if they are undisputed, if they are assessed loss. So in my example, I had given that 150 crores is the loss which has been carried forward by the entity for the last return which has been filed. Now what happens is, say out of that 150 crores, you have one particular year where the loss was 30 crores and the TP adjustment was made to the tune of 35 crores. And that loss, so not only loss for that particular year, the 20 crore loss is gone, but because of this 30 crore being added, the 10 crore loss of another year is also going out. So all in all, that 150 crores become 120 crores. So now you only have 120 crores to be carried forward. So that's the reason when we take over a company and when we are advising the company in case of where the acquisition is primarily focused on taking over the loss, the due diligence with respect to the litigation matters is to the fullest, because my claim has to be accepted. So I'll give you, sir, one more scenario. Once the company is admitted into CIRP, what happens is no amount can be recovered by anybody, right? There is a concept of moratorium, as sir mentioned. Yes. So what happens in a moratorium case is that you cannot adjust any amount. Now, income tax department, as we all know, has powers under section 245 to adjust the demands. And if you have a refund case which is being filed, the return gets processed and it is adjusted against the outstanding demand very easily, irrespective of whatever you provide the answers, because the answer is read by AI and AI has to be right. So they adjust the amount. Now, we have handled cases where, because it happened during the time of moratorium and it is strictly prohibited by the IBC Act, we have gone to NCLT and stated that during the resolution period, this adjustment has been made. We have made the jurisdictional assessing officer party, because CPC cannot be made party. I mean, who sits at CPC, we all don't know. That is another, yeah, so actually God sits at CPC, that if we can say so. So we made jurisdictional assessing officer party and we asked for a prayer to NCLT that 1.5 crores of refund which was adjusted, that amount should come to me, because this amount could not be recovered. Income tax department had already filed a case with me, filed a claim with me, wherein the outstanding demand was 20 crores. So they said now only 18.5 crores, because IBC also has a provision of netting off. So they said I can do this, but section 14 of the IBC specifically governs moratorium, and we were successfully able to get that refund in favor of the resolution, not the resolution applicant, because at that point in time we were advising RP. So RP had appointed us. We fought this case before NCLT. NCLT directed assessing officer to give refund of 1.5 crores. Since that refund came after 3 years, because the unfortunate thing for jurisdictional assessing officer was, he says, I don't have a mechanism to issue you a refund in a case where I have outstanding demand of 20 crores. I said, sir, you pass an order giving effect to NCLT order. He says, मुझे order giving effect सिर्फ CIT appeals और ITAT का आता है. There is no order giving effect of NCLT as a provision to me which is available. He is correct. But I said, sir, you have to give effect to this. So in that particular way, we got a refund of 1.5 crores, which was very beneficial because it enabled the resolution professional to run the company without calling for money from the COC. Sir, I can give you that case. Yes, it's an NCLT order, so it's a public domain. I can give you the name of the case. It is Satra Properties India Limited. Satra Properties India Limited. During the moratorium, you cannot make any adjustment. Making that adjustment for CPC was very easy. He said, ऐसा तो कोई आया नहीं हमारे पास refund मांगने. Correct. He doesn't believe NCLT is also a body which he is bound by. So, time-bound resolution process, attractive valuations, transparent bidding process. Any company which is there in IBC, the notices and auction notices are floated. It can be easily viewed ibbi.gov.in if I'm not correct. If I'm not wrong, that is the website wherein you get to know of each and every company. So we all know that Alok Industries was one company which was in CRP, which is taken over by Reliance Industries. It is not an investment advice. One should not make investment. Alok Industries is a listed entity taken over by Reliance, but yeah. So that was one acquisition done by Reliance Industries as well. Clean slate protection, we have all argued. Indemnity is under the legal framework. Minimal negotiation with lenders. So it's a transparent bidding process wherein you submit the bid. The bid is opened by the lenders and it is discussed in the COC. So there are certain things which happen, but yeah. On the forum, definitely the negotiations are minimal. As against that, we all know what happens in an IBC. As sir mentioned, it takes sometimes 3 years. Yeah. Because deals do not happen as quickly as possible. Yes, sir. NESL, yes. NESL is another website wherein they upload the auction notice. Yes. But the interface wise, IBBI website is far more easier for me. So my preferred mode of going is that. Plus we also have, we have a specific LLP, Incorp Restructuring Services LLP, wherein we have partners in 12 different locations. So I think because of the network also, the information keeps on flowing to us. But as far as the general practice is concerned, you can get the information on the IBBI website. Yeah. So I've just compared the biggest IPO which India has seen so far. Hyundai Motors, 27,870 crores. Life Insurance Corporation of India, LIC, 20,000 crores. Paytm, 18,000 crores. Coal India, 15,000 crores. Reliance Power, 11,700 crores. Geo platforms I have not mentioned here because it will come. So as and when it happens. And as against that, the top 5 companies which have been acquired in CIRP, 42,000 crores, 35,000 crores, 19,000 crores, 5,000 crores. Alok Industries also sits here, 5,000 crores. So huge deals have happened in IBC domain also. It is not that only smaller value of deals are happening. Myths and reality, I think I have limited amount of time. I'll try to cover the other part. Credit driven process, market consolidation. I think this is most important, market consolidation, because it enables you to grow at a faster pace. Because you take over a company which is distressed, you get that company at a cheaper valuation. You are enabled to move on faster, to grow faster. Value acquisition, investor participation. These are some numbers. Capacity expansion value. So I'll not run through each and every one of them. Bhushan Steel, SR Steel. We'll share the slides with you. So we can see the recovery rates that has happened for the lenders. 63% in case of Bhushan Steel. SR Steel, it is 85%. DHFL, we all know, 46% taken over by Piramal Capital. Bhushan Power and Steel, 19,700 crores, the case we were talking about, 40%. Aristo Developers, the case we talked about, Prestige took over at 1,650 crores. So this deal was basically cash and non-cash because it was a real estate project. They had given an upfront consideration of 350 crores, and balance they stated that they will give by way of a construction to the lenders itself. So 8 lakh square feet was given to the lenders. This was one of the first cases which was resolved by us. So the numbers are there in the public domain. And because of this particular entity, Prestige got its foothold in Mumbai. Future of M&A, I think we've talked about. Group insolvency, cross-border insolvency, faster resolution timelines, enhanced creditor rights, greater participation. Key takeaways, M&A market is on fire, we all know. Capital is flowing, cross-border activities are happening, strategic acquirers are using distressed assets to accelerate growth. IBC has emerged as a key enabler. One piece to look after, because as we saw at the start of the session, only 6-7 odd people were aware that this is a sector where the M&A piece is happening. As we saw about the big numbers, there are also small numbers, and at the start of the session I had also mentioned that one particular company was taken over for 72 lakhs. So it is not that thousands of crores are the deal value in each of the CIRP. This is one more initiative which IBC has brought in, pre-pack insolvency, wherein even before the... Yes, sir. Sir. Company is not in? Sir, that company you cannot take over in IBC. Certainly. I mean, it's like you wishing that the company which I intend to acquire goes into IBC. Certainly, certainly. So while these are two avenues, that's why in my example I said that only in a scenario where you have two target companies, company A and company B, and only company A is in insolvency. Now you have two options to choose from. Company A, you can go through IBC route. Company B, you can negotiate with the promoters. So yeah, fair point. Pre-pack insolvency, this is basically for a case where prior to insolvency getting triggered, the promoters and the new bidders can go to insolvency, present a resolution plan, and get the pre-pack insolvency done. This is the fastest mode wherein the insolvency does not even start, but you go with the resolution plan. So this also has been brought into the statute. This works faster because there's no time lag between the company getting admitted into CIRP and the resolution happening, because it starts with a resolution basically. Now these are some of the judgments, one-liners I will speak. I have 1 minute. So what is important and what this journey of 10 years has seen are these key important points. Commercial wisdom we all discussed. It is of the utmost importance because I have talked all good things about IBC. In these judgments, I'll talk you about what are the negatives. Sir, what are the negatives? What happens is, as we discussed, that if there are 2, 3, 4 parties who are interested in bidding for that company, as soon as one company gets, the other 3 companies tries to find loopholes in the processes, tries to file cases in the NCLT to stall the acquisition process. We have seen even promoters, the erstwhile promoters, because as soon as the company is admitted into insolvency, the promoters are suspended. Now, once they are suspended, they don't have anything to do and they see their company being lost through the process. So they also try to find out what are the fallacies in the process and they file an objection in NCLT. So Printhouse was a particular case wherein the erstwhile directors argued before the NCLT, sir, how can you allow a technology company to take over a printing business? What will happen to my employees? Suddenly they feel empathetic towards their employee. Non-logic, but the frivolous litigation is something that which keeps on happening. So Supreme Court has held that COC's commercial wisdom is of utmost importance. Any third party bringing any dispute will not be of importance. If the lender whose money is involved at stake has agreed to give this money, give this company for so and so amount, that should prevail. Then the clean slate principle, Ghanshyam Mishra, celebrated case, copy pasted in every NCLT resolution plan order. Now NCLT has stopped going into the nitty-gritties. They simply quote this particular judgment and they say that any and every relief, whatever you have sought, we give it through Ghanshyam Mishra's judgment, which creates another challenge, which if time permits, we'll discuss. Change in business operations post-acquisition of the entity, as we discussed the Printhouse case. Weber Goel versus DCIT. 148, as we all know that we have 6 years timelines. So income tax department can, and they are mandated to reopen a case. We all know 148A has come into statute. During the 148A process, we submit that, sir, company has been taken over by the resolution applicant. It is no longer the old company. I have shelter of umbrella of the IBC. But unfortunately, as we all know, hardly a 148 notice has ever been dropped. Has anyone seen a 148 notice being dropped at the stage of 148A? Is there any lucky person? Sir, we should all take some submissions from him, basis which he could, I will not say manage. He was able to convince the assessing officer to drop 148. You know about a particular case. So it is brought into statute so that primarily if you don't have any case, it can be dropped. But unfortunately, we have not seen any case being dropped under 148 itself. I have not been lucky enough. So high courts, it required high courts to mention that income tax authority is wrong and you cannot reopen an assessment. So tax authorities are on the losing side when it comes to legal ground at high courts and Supreme Court. We all know Ashish Agarwal's case, we all know Rajiv Bansal's case, but since it's not a tax seminar, I'll not name them. So here I have Vaibhav Goyal, so wherein it has been held that you cannot open a reassessment prior to the company being taken over by the resolution applicant, because you would not have the data itself to substantiate. Plus, when the law itself is giving you a shelter, how can you reopen a case? But unfortunately, there is no provision which carves out an exception under 147, 148. That's the reason they go ahead and open the case, just to see that it is being quashed at the tribunal or high court level. Sir, my only problem is for a person who has acquired the company at 72 lakhs. He does not have a resources to go to high court. Correct. That is true, sir. Approval to resolution plan is not enough. As I mentioned, that merely mentioning in the resolution plan that I will merge so and so company with the resolution applicant or a subsidiary, it doesn't it doesn't give you a benefit to not go through the entire process of 230 and 232. We all know it is a pain-some process. It is a process which is a very lengthy process, so to say, and because NCLT is burdened with the IBC cases, M&A cases take a huge toll because on most of the times you don't get a date. When you get a date, you see a big matter being argued by a senior counsel taking up the entire time of the bench. And by that time, judge has no inclination to hear an M&A because he says, correct. So he says, please sir, come on another date. So M&A process has become a bit lengthy because of the NCLT process being a big process. Change in business operations, post-acquisition, the same case I think it has come. No separate merger application is required to be filed simultaneously with the resolution plan. So here, the same issue 232 was in question. Yes, that's it. So if there are any questions we can take up, or I am 5 minutes early. Thank you, sir. So if there are any, yes, sir. Yes, sir. Sir, pre-package, unfortunately, as I mentioned that there you are supposed to know the target company. So as sir was mentioning that you don't have an option to for a company which is not in PPRIP. So in that case, sir, because the resolution plan comes first. So in a normal process, what happens is you file a case, the lender files a case in NCLT, he gets insolvency registered, RP is appointed. Then RP issues the forms mentioned in the IBC that the company has gone in NCLT, you give the claims. So that is the time when investors comes to know that this particular entity has gone into insolvency. Pre-package, that does not happen. So pre-package, you have to know through network only that when a particular company is in distress. Sir, RP is basically running the process in that case also, but he doesn't have much greater role because what happens is only his role is to collect claims from the lenders. Because the resolution is already proposed in the initiation stage itself. So it starts with a resolution. Yeah, so that is something that you will not get on IBBI website because the process is such that it is not possible. Any other case? Right, sir. No, sir. No, sir. No, sir. So only if in a case where it's an unabsorbed depreciation, you have a unfettered timelines, but otherwise, now in fact amalgamation also they have removed the additional timeline. So that benefit is also gone since 1st April 25. So it is only for that particular years. So you should have the company which is bidding has to have a substantial profit such that it can absorb it. Because if you see, ultimately the money is to be paid upfront while the benefits are to be taken in the succeeding years. So you have to discount and see whether that is beneficial to you, for you to take over a company and set off those losses in those years. Sir. Sir, legally permitted, I understand you are talking about GAR. So there are no judicial precedents on this so far. So I don't have a citation to quote for, but I would say that you have to establish some substance, first thing. Without substance, it will be difficult to argue. But I would say that I have acquired this company through a normal process. This was available for everybody, but it is a point of argument. So I would say that it was available in public domain. I acquired it at the best possible rate because there's no question of fair market value coming into picture. It is already a fair market value. The highest bidder gets the money, company. So these are the arguments which can be done, but yeah, I mean, on the piece, as far as how much it will sail through in terms of assessment by the tax authorities, it's a question. And there is no tribunal or a high court decision on this, as far as I am aware. Sir. Sir, so that share adjustment typically comes in resolution plan itself. So, yeah. So 230, 232, that's what I'm saying. That what NCLT has held is that whether you mention it or not, we will simply say you follow 230, 232 process. So in a 232 to 232 process, it is a normal process that you do. Whatever you do, you can complete, because at that point in time, the company is already with the successful resolution applicant. Now RP has no role, COC has no role. So it is your company and you decide whatever you want to do, you can do. Sir. So the question of compensation is, what typically happens is that a loan gets refinanced or a loan is being taken over by a particular entity. So whenever you are in distress, so this is not even case of ARC, because this is Bank of Baroda directly. So what? Not got it back. Not got it back. That's the reason I'm saying that even Bank of Baroda has filed claim. Bank of Baroda has also claimed in that insolvency. It has not got money. Instead, it has been asked to pay the money. That is where it has reached. So it's a landmark landmark thing to understand and study about, which has just come to light in last 2 days. So the reason is that, see, that's what I'm said. What is important to understand is there is no order of UAE or Abu Dhabi which directed them to pay. Despite that, if they have paid, that's where the papers are important. They will not be in a position to prove that this loan was given not in connivance with the promoters. Such circumstances would have existed wherein they would have given money at a point in time where others would have maybe classified the account as an NPA. So what need arise to Bank of Baroda to fund them this much amount of money? So the circumstances are not yet clear because it's an settlement kind of a sort of thing which has happened. But whatever the information is available in public, it says that there was not enough document available for Bank of Baroda to agitate. Sir, here we don't even, in tribunal we have 1 lakh amount also being contested in tribunal, right? They agreed to pay 5,600 crore without even an order. So, right, sir. So I think with that, we'll conclude. Thank you so much. Thank you so much.
So thank you, Margav. Excellent session, and also you made it very interactive. I think front row was most active. So now I request Rishikesh to offer formal vote of thanks on behalf of all of us.
Hello. Thank you, Mr. Rakesha. A very good morning to all. I think it was a very wonderful session to start off with, and the way CA Shukla guided us through it, it offered a very new perspective on how a resolution process works in tune with M&A. And he has also covered a lot of case studies, and which would help us to understand this process better, maybe encourage us to get into this sector also. So with this, I would like to audience to carry out a vote of thanks with a warm applause. We would break for tea for 10 minutes. We are running a little late, so let us try and be on time.
Request to assemble very fast.
After learning that how many opportunities are there, now it is time to listen and to know what for chartered accountant are being known, to learn the framework, the accountancy framework, that how the transactions should be recorded in the books, so that everything should be gone well with following the guidelines and accounting standards, and as well as taxation as well. So we have the faculty with us, and I'll request Rakesh Bhai, our treasurer, to welcome the faculty first with the memento, and then go for the introduction of the faculty. Memento, please.
So thank you, Piyush Bhai. So CA Jenul Sanghani is a partner with Deloitte India, specifically in the financial reporting and accounting advisory, with more than 18 years of experience advising CFOs and finance leader on financial reporting governance, financial transformation, capital market transaction. He is a subject matter expert in Ind AS, IFRS, and US GAAP. He's led complex GAAP conversion, IPO, M&A deal, and AI-driven financial transformation initiative for leading Indian and global organization. He's a regular speaker at ICI platform, and he's also author on financial reporting book. He has worked with marquee clients including Tata Group, Hindustan Lever, the HDFC Assets Management Company, and ETI Assets Management Company. So with a huge round of applause, we welcome Jenul Sanghani, and over to you, Jenul. Thank you.
Good afternoon, everyone, and thank you, Rakesh ji, for the warm words and introduction. Followed by, yeah, then. हाँ, ठीक है. Actually, then I'll use this. Okay, how many of you have actually worked on an M&A transaction? It can be from any perspective. Oh, quite a few. Okay. And typically from your experience, when you work in an M&A transaction, what are the things that you evaluate? And you can say whatever you have done practically. What are the considerations when you are evaluating an M&A transaction? Valuation? Yes, definitely valuation. Due diligence? Yes, definitely. What else? Common control transaction, yes. Someone said RPT? RPT, okay. Taxation, yes. Tax efficiency of a transaction you will evaluate, yes. Business synergies, that is, I think, one of the key things, right? I mean, when you are buying someone, you will obviously evaluate whether it makes sense for me to buy someone, right? So business synergies, of course, relevant. What else? Sorry? ESG framework, okay. What else? Okay, got it. Okay, what else? Implementation challenges, okay. So if you buy someone, how do you combine the businesses? How do you combine the plants? What do you do with people? If there are duplications, how do you deal with all of those? Physical asset separation, yes, that is very, very critical. Okay, what else? Okay. Softer aspects, yes, people aspects, absolutely, because at the end of the day, people are going to make the transaction successful or otherwise, right? So people aspects are very, very critical. Okay, what else? I think most of you highlighted some of the very relevant considerations in an M&A transaction, except the consideration because of which all of us are here, which is accounting, right? So I think that's one of the, so in fact, what I'm hearing from you is nothing different from what I see practically also when we work with some of the largest companies in India. When you evaluate an M&A transaction, yes, business synergies are important. Yes, valuation is important. Yes, softer aspects are definitely important. So you will consider tax efficiencies, you will consider synergies, you will consider all of that. But one thing that people undermine a lot specifically is financial reporting considerations. And that is something we've seen eventually once the transaction consummates, and if you've not thought through it carefully, it comes to haunt you back. And why is something that we are going to cover today in detail. And then we will go to how do you sort of deal with financial reporting considerations in an M&A transactions. So as I think Rakesh Bhai said, my name is Jenul Sanghani. I'm a partner with Deloitte. And what we are going to cover today is practically how does financial reporting become very relevant in an M&A sort of a space. Yeah. So one thing, one sort of housekeeping rule, I think there is a disclaimer at the bottom of the slide. which says that the views expressed are personal. So I think that's something I wanted to say at the outset before I start. But I think with that, I think we start that what are the key things which are relevant. I think this is the question that I asked you, what are the key factors? And I think most of you covered all of this. So someone said transfer pricing and related parties, yes. Someone said business aspects, synergies, yes. Tax efficiencies, yes. But what we are going to cover today is the financial reporting. That is what we are going to focus on. And I think what has happened over the years, and some of you have been, some of you have experiences of more than maybe 5 years, 10 years. So you would have seen this journey. We started with Indian GAAP, for example, and Ind AS came in India from 2015 onwards. And Ind AS is not intuitive. So there are a lot of practical nuances which under Ind AS makes the financial reporting world very complex, specifically in the context of M&A. And we will cover those complexities today with practical examples as well. But yes, as Ind AS sort of becomes more and more sort of mandatory for large organizations, financial reporting considerations become very, very relevant. So let us discuss some of the examples. So effectively, this is the question. Why as a chartered accountant, you have to be involved in each and every transaction, and why as a chartered accountant, the company should not come to you post facto. So not after they've consummated the transaction. It is very important that we are a part of the deal team. I think someone did mention due diligence. So due diligence, valuation, all of these tax aspects, related party, all of these are thought through when you are structuring the transaction, when you are designing the transaction, when you are planning for a transaction. So that is absolutely relevant. But one other aspect is financial reporting, and why you have to be involved as a chartered accountant working with the management at the planning stage, at the structuring stage. That is what we will cover now. So the first point is fair valuation. Now, a lot of you would have sort of heard that under Ind AS, the accounting happens on the basis of fair valuation. Now, why this one word can change the size of the balance sheet? So say, for example, you are a large family house, say for example, Vedanta Group, right? And you have multiple companies within the group, and you are doing a group restructuring transaction. Now, typically, if you are doing a group restructuring transaction, the balances in the transaction will move at book values. But let's say, for example, now Vedanta is acquiring a SR Mining, for example. They're acquiring a third party. Now, that's when fair valuation comes into picture, and the fair valuation changes the size of balance sheet. For example, the company that you are acquiring may be sitting on land and building, which in their books of accounts may just be at 100 crores, for example, because that's the historical cost of the value in the books of accounts. But the moment you do a transaction, you have to mandatorily do fair value. And if the fair value is thousands of crores, that is what will get reflected in your balance sheet. So one aspect which is very, very important is that what is the transaction? So are you doing an internal restructuring, which is more in the nature of common control transactions, or are you buying a third party, and therefore you will end up with a fair valuation? So the first aspect why you should be involved is the fair valuation, and what are the drivers? So your balance sheet size can change, your depreciation impact can be materially different, and therefore your profitability after acquisition can be significantly different. And also what happens in Ind AS when you do an acquisition, you also end up recognizing some of the assets which are not even there in the balance sheet of the company that you're acquiring, which are called as intangible assets. So something like a customer relationship, something like a distributor relationship. All of these intangible assets also come into balance sheet for the first time after acquisition. And all of these intangible assets increase your impairment risk as a CFO, as a chartered accountant, and as a finance function owner. And that is what you have to highlight at the time of designing the transaction. That this is potential impact in the balance sheet, this is the future impact in the P&L, and this is the future impairment risk that I'm sitting with if I do the transaction. So this is first reason why a financial reporting consideration is extremely relevant when you're doing an acquisition transaction, which is how do you account for transaction. In Ind AS it is fair valuation. Debt versus equity classification, and there are multiple stories I can share on this. I'm right now working with a large company who was actually a startup. They've now grown to a significant size. So when actually the private equity funded them for the first time, private equity funded them through an instrument called as CCPS, compulsorily convertible preference shares. Now, how many of you heard about this instrument, CCPS? Yeah. How many of you believe CCPS is equity? For example, when we talk to private equity, they believe CCPS is equity. How many of you believe CCPS is equity? You believe CCPS is equity, right? So that is exactly one of the reasons why you have to be on the table, sir. A lot of us believe that CCPS, including the investors, including the promoters, they believe CCPS is an equity. It is not always. It is not always. The answer in Indies really depends on the terms and conditions of how the CCPS is worded. And I've dealt with at least hundreds of CCPS practically. We have got to different answers. There is a debt classification, there is an equity classification, there is a hybrid classification also where we've broken the instrument partly to equity, partly into liability. So therefore, and let me share a practical example. The one that it was a startup at some stage, but now it has grown into it's grown into a very large organization, and they are now aspiring to list themselves on capital markets. That's when they came to us saying, look, we want to list into the capital markets. One of the first things we evaluated is that there was a CCPS on the balance sheet. All of them believed it is equity. When we reviewed the terms of the agreement, the CCPS were convertible into variable number of shares. In fact, if some set of conditions were not met, there was a buyback obligation on the company. So they have to buy back in cash from private equity. So when we looked at the terms of the instrument, we said, look, under Ind AS 32, there is explicit guidance. In those situations, this will become a liability. Now this one answer changed their IPO plans completely, because the debt equity ratio completely went for a toss, and they were obviously considering this as equity, and therefore the debt equity ratios were looking very, very different. And this was a material amount, a significant amount on the liability side of the balance sheet. So then they said, okay, look, this is where we are. How do we solve for this? That's when we worked with the statutory auditor, we worked with private equity, we worked with the promoters, we got lawyers in the room, and we said, look, how do we sort of restructure the agreement such that the classification becomes equity in Ind AS. Now imagine this, if they involved the accounting experts or they involved subject matter experts at the time of funding itself, when the transaction was being funded, we would have flagged this upfront. Would they have still done the transaction in the same manner with the same terms and conditions? Possibly yes, because accounting is just one aspect. When you invest in a company, there are a lot of commercial aspects also, valuation aspects. A private equity wants protection of their own money if something does not work with the business of the company. So quite possible they may have gone ahead, but at least they would have gone ahead knowing this is the outcome. In this situation, they were assuming equity, but when we actually evaluated, it turned out to be a liability. And then we had to restructure the instrument, and the IPO plans had to move by 1 year, because then everything had to be put in place and the amounts had to be reflected as liability in the balance sheet. So when you are doing funding, all acquisitions definitely involve funding, right? So you will fund through your equity, you can fund through debt instruments, you can fund through CCPS, you can fund through debentures. There are different financial instruments through which you fund an acquisition. All of those funding instruments, detailed evaluation of accounting is required, which is why, again, to my point, you need to be on the table when the transaction is being thought about and not post facto, right? So this is very, very important sort of consideration. Gain or loss recognition. Now, this is very interesting, and there are again a lot of practical sort of cases around this also. So what do you mean by gain or loss recognition? Suppose you say, for example, you are a large Tata Group company and you want to sort of now effectively demerge a portion of the business and sell to another entity within the group. Now tell me, in the books of accounts, obviously the subsidiary or the division was at book value. So suppose the book value was say 500 crores, and but the real value of the business, it's a profitable division of the company, and the real value is significantly higher. And they are selling it to another entity within the same group, say for at 1200 crores. How will you deal with this 700 crores is the question. Any guesses? You are a seller, so let's say, let me take a step back. So you're a manufacturing company, you have two divisions, both the divisions are profitable. You now decided to sell one division to another company, and the company is a group company, for example. In your books, the net assets were at 500 crores. You have said you did a valuation, and the valuation came to be 1200 crores. Now you're selling the business for 1200 crores. How will you deal with 700 crores, which is the gain in the books of seller? Gain where? In the books of seller. Okay. So let's focus on standalone seller books. Through the P&L. Okay. So how will you decide whether P&L or equity? Hmm. So if it is gain in the P&L, will you pay tax on it? Will you pay tax on 700 crores? So you, in this example, assuming the amounts are congruent in books and tax for simplicity, you are saying if the gain is through P&L, you will also pay a tax on 700 crores. You will not do the deal. You will not do the deal, okay? But what will change after 10 years? No, but what will change after 10 years? So effectively, this company has two divisions, A and B. The company has now decided to focus and grow division B, and company believes that division A is now no longer a core division for me or a core business model for me. And there is another group company which is only focusing on the business model of division A. And that's why there is a group restructuring which is happening. So there is a business context why a restructuring is happening. Exactly. So therefore, to your point is that if the stakeholders are explained in advance that by the virtue of doing this transaction, this is the implication, better evaluate or better think about it hard. Correct. Exactly. Exactly why you need to be on the table, sir. Yes. Anyone else? Yes, sir. Revaluation? So when you say, can you explain a little bit more? So you're saying there is no tax implication on selling of business. Okay? Ah. Okay. No, he is saying that even in this situation, there will be no tax. That's what I think sir is saying. There will be tax. Got it.
Continues, it is not breached, then to that extent you defer it, otherwise tax is there.
So therefore the point is not whether you pay tax or not. The point here is that if there is an accounting evaluation that you have to do, you have to bring this risk on the table, that there is a potential risk that if you do the transaction, this is a factor that you need to evaluate. Got it. Correct. Similarly, one interesting concept is date of consolidation or deconsolidation. Now, this is very interesting, and in fact, Institute of Chartered Accountants has actually, through an ITFG, gave a very interesting clarification on this. So let's first take a practical example of when this applies. Say, for example, there are two companies which are merging with each other. The process is going on in NCLT, right? Now, you are on 31st of March 2026. The NCLT approval came through on 10th of April 2026. Your financials for 31st March 2026 are not yet closed. The question is, will you account for this merger in March 26 or in March 2027? Correct. So the order, so I will give you further facts. The order says the appointed date is 1st of April 2025. So you will give effect of the transaction in March 26. Suppose the NCLT order came on 25th of April 2026. Okay? And your audit was finalized and your accounts were issued on 22nd April. What will you do? 27 or 26? Board meeting 22nd. So two scenarios. Board meeting is before NCLT. Board meeting is after NCLT. Two scenarios. Restatement of financials. So that is step 2. The first question is that. So again, just to refresh the facts, you have a NCLT process going on for merger of two companies, A Limited and B Limited. A Limited is going to merge into B Limited. I am talking about the financial statements of B Limited. Okay. Now suppose you are the CFO of B Limited. Now you are at a situation where you have to close the accounts for 31st March 2026, get it audited and get the results declared. You are a listed company, right? Your board meeting is on 22nd of April 2026, where the accounts are finalized, audited, results are issued to the street. Now the merger order has come on 17th of April 2026. That is scenario 1. Scenario 2 is merger order has come on 27th of April 2026. Now the question is, how do I deal with the merger order in both the scenarios? Now that is where ICAI has issued a clarification, and that is a very relevant clarification in this context, and I have practically applied it multiple times. The clarification says that the relevant guidance is events after reporting period or the post balance sheet events. So if you do get the order before your accounts are issued, then you have to consider it as an adjusting event and in fact reflect the merger in 31st March 26 accounts, and to your point sir, restate if it's a common control transaction. In scenario 2, if the order comes after the accounts are released, then it's a non-adjusting event and then you account for it in March 2027. But in March 2026, give a disclosure that this particular event has happened and this is a significant post-balance sheet event which merits disclosure to the readers of the financial statements. For the stakeholders, yes. So that's how it works.
So during this 21 days period, so it's important to disclose this fact on AGM also, sir.
You will disclose. If you're a listed company, there are anyway SEBI regulations which require you to disclose the transactions.
Even if it is happened in September, means my 21 days notice period was already, it's going on. My agenda is also sent to the all the stakeholders. But now the agenda will not mention this point now because it is during this time of 21 days.
So there are two parts to it. One is the approval of NCLT and second is the process itself. So the fact that the merger process is going on, you would have anyway disclosed it in your annual report.
Okay.
So therefore it is anyway covered. What you are referring to is the approval. The approval can come as per the NCLT process. So you don't have control over that, right?
Yes, sir.
So that's how it works practically. Yes.
I just have one practical question. Let's say
yes.
if board is scheduled on 22nd and the order comes on 20th, how would it be practical to kind of restate?
You change the board meeting date, my friend.
But then there is also a SEBI obligation within which you have to finish certain things, right?
Sorry? Come again.
You have a SEBI timelines in terms of by when you can finalize and you have to do a lot of things.
So those are practical challenges. We've dealt with those. You put in extra sort of hands and you get that done and you revise the board meeting if you can't do it in 2 days, which is practically impossible. Yeah, so then you revise the board meeting date, right?
Okay. I think is there no way to give a performa or something?
Yes. Similar rules will apply. The concept of adjusting and non-adjusting event will apply whether it is year end or whether it is quarter end. Similar concept will apply. So that is why I said date of consolidation or deconsolidation becomes very, very relevant or important. Business versus asset. A lot of you, I'm sure, understand section 219AA, which is the definition of undertaking. Now the concept in income tax is that if the definition of undertaking is met, the tax implications are different. If it is not met, the tax again works very differently. Now, a parallel concept in the accounting world is a definition of the word business itself. And therefore, one of the key questions that we evaluate practically is that when you consider something as an undertaking, in the accounting world, are you classifying it as business or not? And that is a practical evaluation that we have to do. More often than not, the answer always turns up to be consistent, because broadly even tax defines the word undertaking as business largely, and accounting standards also define the word business. But I'll park this for a minute because we have to cover the definition of business in accounting standards in a minute. But this is an important consideration, and we'll come back to this once we cover the business definition. But as I said, these are just some of the examples why financial reporting is very relevant and very important in an M&A construct. So be it your debt equity classification, be it your size of balance sheet based on fair valuation accounting, be it your date of consolidation, date of merger, demerger, all of these become very relevant when you are stitching together an M&A transaction. And M&A transactions practically are of two types. One where you actually buy a third party out, and second is internal restructuring, where you are doing common control transactions. So in both these situations, financial reporting becomes very relevant. Yeah, this is the next point that I was referring to. What is a business? Any guesses? The word business is defined in the accounting standard explicitly. Any guesses? What constitutes a business? How do you define the word business? Okay, but what does it mean? Okay, that's one way to look at it. Okay, what else? What is a business? In simple words, what's a business? Okay, so if you are acquiring, say, in your example, say for example, there is a large IT company, say Infosys, for example. They have a large customer contract which gives them revenues in excess of 1,000 crores every year, right? Now you are cognizant, you want to acquire a customer contract. You want to acquire that customer contract. Is that a business or not? Why not? I'm asking. You can't ask me back again. Okay. The question is that how do you assess whether it's a business or not? That's the question. Yeah, please, sir. Sorry? Okay. Again, same question. You are buying a customer, you are just buying one customer contract. Cognizant is buying, Infosys is selling one customer contract. Infosys business remains as it is, nothing moves to Cognizant. Cognizant has their own way of managing large customers. A customer contract is moving from company A to company B. Cognizant's articles of association mentions providing IT/ITS services is their business model. Even Infosys IT/ITS company. Now in this context, is this a business acquisition or is this an asset acquisition? It's an asset acquisition? It's an asset acquisition. Okay. Going forward is going to come from this customer only. And if be the case, then probably I can say that this may constitute a capital asset for me. Because if this gets divested in future, then my top line and bottom line will have a significant dent. But okay. For example, if this customer contract is going to give me an addition of 2% or 5% to my total top line, then this could be still be regarded as a business. Okay. Okay, so that's one way to look at it. Yes. Set of activities. What activities? Okay. So you're saying employees are moving or not is a question that we have to ask. Okay. Yes. Then it's a business. Okay. Okay, what else? Yes. Okay, so you're referring to synergies. Okay. So you're saying if it runs by itself, then perhaps it's a business. Okay, interesting. Hmm. 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 Okay, got it. Okay, last. Hmm. Hmm. Possible. Got it. Got it. Hmm. Hmm. Okay, so the good part is that the accounting standards have not left it for our judgment. The business, the word business is clearly defined. This is the business. So the business has three elements: input, process, output. So the definition is clearly established in the accounting standards. And I have personally practically dealt with enough and more situations where we've actually applied this definition. And this definition is actually extremely critical because this is the gating question. So if what you're acquiring is the business, then the accounting happens in a particular manner. If what you're acquiring is not a business and a group of assets, for example, then the accounting happens in a very different manner. And the accounting outcomes or the financial reporting outcomes are very, very different in both the situations. Let me give you practical examples of how does this sort of become relevant, or how this comes to life. Let's say, for example, you are L&T, for example, and you are buying a road asset. Say, for example, there is a highway, there is a service concession agreement for 30 years, and as an L&T, you are going and acquiring that, say, for example, from Oriental. Oriental is another company which has road assets, for example, or say Cube Highways, for example. Now, when L&T is buying that company, it is buying shares in the company. That's the first point. Okay. What is there in the company? It's an SPV which has one contract, service concession asset. Say, for example, Mumbai-Pune Express Highway. That's the asset sitting in the SPV. The contract is effectively the toll contract to collect tolls for a period of 30 years, for example. Now, what is L&T buying from Cube? Is it buying an asset or is it buying a business? That's the real question, right? So therefore, the standard requires you to apply this lens. What you are acquiring, are there inputs in this? Are there processes? So are you acquiring substantive processes? And is there an output or an ability to produce the output? If the answer to the question is yes, then L&T will indeed account for this as a business acquisition. In fact, L&T will therefore then do a fair valuation of the underlying assets. It will do a purchase price allocation and account for this as a business combination. And therefore also end up recognizing goodwill if there is a residual amount in the acquisition transaction. Versus if we conclude that, look, there is no business, I've just bought one single contract. I may have bought shares in SPV legally, but in substance there is nothing else in that entity. It's just one contract with NHAI which allows me to collect tolls over a period of 30 years. There's nothing else effectively. There are no employees, there are no processes, there are no other relevant factors, and it's an asset acquisition. Then whatever I pay for is accounted on the basis of relative fair value and assigned to different assets. So in fact, my valuation considerations, if I'm a valuation professional, is also very different. So if I classify something as a business combination, I end up doing a purchase price allocation. If I end up classifying something as an asset acquisition, I account it basis relative fair values of the underlying assets acquired. So therefore, how do you classify a particular transaction as an asset acquisition or a business combination as a direct bearing on both financial reporting and how the valuation is reflected in the books of accounts? Yeah. Now, there are many examples we can take on what is an input, what is a process, what is an output, but intuitively, like in very simple terms, if I were to say, for example, if you are acquiring a manufacturing division of a company, usually what will it come with? Inputs will be your plant and machinery, your raw materials, all of those will be your key inputs. What are your processes? Your manufacturing process, your bill of material, your manufacturing recipe, that will be your key process that comes along with the acquisition. What is the output? Is the ability to produce whatever goods that eventually gets produced by that equipment. So intuitively, if you acquire a manufacturing company, usually it results into sort of a business acquisition. Now in the same fact pattern, if I remove everything else, all I will say is that, look, I just want this piece of equipment, nothing else will come. I will not get the recipe, I will not get the manufacturing process, I will not get anything else in the transaction. Then it starts taking color of an asset acquisition. So therefore, what we need to do as accountants, or what we need to do as financial reporting professionals, is all transactions has to go through this lens, and then you analyze and come to a very measured sort of an answer. Now the standard also has a very interesting concept called as concentration test. And this is optional in the sense that this is an accounting policy choice, and this choice is available to the company for each and every transaction. So not that you take a choice and it's for you with ever, it's a transaction level choice that you take. So if you decide to apply the concentration test, and if the underlying assets are effectively the ones that sort of lend significant value to the deal, then you can say that, look, I want to account for the transaction as an asset acquisition and not as a business combination. So this is a subtle nuance that has come recently in the standard. It was not there always in the IFRS world. I think this amendment came few years back, which is called as an optional asset concentration test. But this is effectively how do you sort of make sure that you account and you classify the transaction as business combination or as an asset acquisition. Now there were some of the examples that I wanted to cover. Is it when you evaluate an asset concentration test, it has to be a single asset where the value is residing. It has to be physically attached with each other, and it should share similar risk characteristics. So for us to take the benefit of asset concentration test, the standard has given certain guardrails, and these are the guardrails that sort of you will follow to make sure that it is meeting asset concentration test. So the highway example that I gave of, practically a lot of companies have applied this in Indian context, where they've eventually concluded that, look, this is a asset concentration test is met, and I will account for this as an asset acquisition and not a business combination. And the financial reporting considerations become very relevant because you will not book goodwill here, which means you are not subjected to any impairment risk in future. So therefore, how do you classify and how do you use optional asset concentration test becomes very, very relevant. Yeah. The tax will continue to be governed by Income Tax Act. Correct. Now, one of the key questions, therefore, so I think what we've covered up till now is one, financial reporting considerations are important, why they are important, what is a business combination, what is an asset acquisition. Now, therefore, we are now going to a section in our discussion today where I'm going to cover how do you account for a business combination in IFRS or Ind AS. There are total 5 steps. These are all very, very sequential. You move from one step to another and you cover the hoop, and that's how you sort of get to the end answer, right? First step is identify the acquirer, which is intuitive in most cases, unless it's a reverse merger sort of a situation. Otherwise, it's fairly intuitive. And determine the acquisition date. And we covered the example of acquisition date when we discussed the ITFG opinion. Identify and measure the consideration transfer. So this is where it gets interesting. You will pay different types of consideration. So when you acquire someone, you will pay cash. You will also have a lot of situations where you say that, look, if the business achieves the numbers that you're promising me as a seller, then I will give you some more money, which is also called as contingent consideration. So it depends. You don't know on day one whether you will pay or not. It depends on the performance of the business. There could also be deferred considerations, which means that, look, I'm paying you 100 today. Another 50 I will pay you over a period of 3 years. So that is deferred consideration. There is no uncertainty. The amount is indeed 50, only time value is the only consideration. So it's like an EMI. So when you are accounting for business combination, all you need to do is you need to look at the shareholders agreement, identify what are the different types of considerations, measure them at fair value, and account for them on day one. So when you're doing a accounting for business combination, consideration accounting is not straightforward. You need to evaluate all of this: contingent consideration, deferred consideration, and the day one consideration. A lot of times businesses also have something called as working capital adjustment. So when you look at shareholder agreements, you will practically end up with situations where the considerations gets adjusted because of a working capital adjustment. So for example, you may have done the deal today saying, look, I want to buy you, let's sit across the table and we finalize, say for example, the deal value is 1,000 crores. Now this 1,000 crores is subject to you doing 5 things for me in future. Only then the cash will exchange hands. But I've locked the value of the deal today. So therefore any working capital adjustments from now until you do those 5 things will also impact the consideration. So how to deal with those working capital adjustments is taken care in step 2. So therefore you may think that consideration is very simple. I'm buying a business, I'm paying him 100, that's the consideration. That's hardly the case. You will always have contingent consideration. You will typically have deferred consideration. You will typically have working capital adjustments. So all of these nuances make step 2 very, very complicated when doing it practically, right? Step 3 is recognize and measure the identifiable assets. Now this is very unique, and for us as accountants, this is very difficult to digest, and I'll tell you why. Let's say for example, HUL is acquiring Nestle, and assume Nestle has only one brand called Maggi, right? There is nothing else in the Nestle's business model in India, for example. Now when HUL acquires Nestle, what will you do as accountants? You will look at Nestle's balance sheet, you will fair value all the assets and liabilities, and you will bring them in the books of HUL. That is what typically you will do. Now imagine the worth of business is coming from the brand Maggi. That's the real value why I'm acquiring that business, right? Plant and machinery I can also build as HUL, but I'm buying Nestle because of the brand Maggi, which is well known in the Indian context. Now this is a brand which is not there in Nestle's balance sheet. So if you look at Nestle's balance sheet even today, and this is all practical, you will not find anywhere a brand called Maggi in their asset side. Quite possible, because it's an internally generated brand, it is never there on the balance sheet, right? But when you acquire Nestle, for example, this standard gives you a special permission that even if something is not appearing in his balance sheet, but you are paying for it because you believe there is value to it, you can recognize it as an acquirer. So this is a very unique thing where something is not there in the balance sheet of the company you are buying, but you can end up as a one-time special permission. You are allowed to ascribe value to the brand, and you will recognize that in the balance sheet of the acquirer. So which is what your step 3 is, and brand is one example. It could be you are buying them because there is deep customer relationships. You are buying them because there is deep distributor relationships. You are buying them because there is a high quality IP sitting there, which is internally developed. So you could buy a company for many reasons. A lot of those reasons are not there in his balance sheet, but you're paying money, you're paying value for acquiring all of those. And the accounting standard recognizes it and allows you to recognize all of those assets in the balance sheet. So this was never there in Indian GAAP as a concept. This is unique to Ind AS. This is very, very common in IFRS. So therefore, step 3 is where a valuation professional does a purchase price allocation. And a very common sort of thing that we do in all our acquisitions is work with a valuation expert and do a purchase price allocation report. And that's where you will see all of these things getting featured. And if you look at any large deals in Indian context and look at the balance sheet of the acquirer in the next period, you will see all of this clearly recognized. So there are multiple examples that you can see. Pick up any large deal in India and you will see this. Yeah. Now all of this goes in acquirer's balance sheet as intangible assets. It will never come in Nestle's balance sheet, by the way. So imagine after acquisition, what has happened? HUL bought Nestle, they bought 100% shares of Nestle. Nestle standalone financials will never have this even after acquisition. So therefore, these amounts are recognized only in consolidation. They never feature in the standalone financials, ever. So Nestle standalone financials will continue as it is. HUL standalone financial will continue as it is. Only in consolidated financials, when you account for acquisition, all of this will start coming through in consolidated financials. Yeah? No. So all assets will be fair valued. So for example, if Nestle's balance sheet had a land which they had bought, say, 40 years back. Now the value of the land must have increased significantly. All of that fair valuation uptick will also come. So in step 3, the fair value uptick comes from the fair value measurement of tangible assets, identification of intangible assets, and fair valuation of intangible assets. Correct. Today. If they have fair value, yes. Provided they have fair value. Typically, if it is written off logically, it may not have value. Yes, in a way you can say that. So let's take a practical example. Again, we'll continue the same example. So let's take a numerical example and we'll continue the same journey. HUL buys Nestle for 1,000 crores, right? The book value of the assets of Nestle, the net book value is say 400 crores. HUL is paying 1,000 crores. The question is, why are they paying incremental 600 crores? That's the question. Goodwill is one answer. Brand is another answer. Customer relationship is another answer. So valuation professional will do something called as a purchase price allocation, which means the purchase price of 1,000 crores is allocated to all the assets. If the book value is 400 crores, potentially the fair value is 600 crores. So you go from 400 to 600. You still have another 400 left to allocate out of 1,000. You will then say the brand Maggie is 100 crores. So now you go to 700. Then you say the customer relationship and distributor relationships, another 150. So from 700 you go to 850. Now you still have 150 which you can't figure out what it is for. Maybe it is because of a superb team that Nestle has built, maybe because of the goodwill of the business. So that residual is goodwill. So numerically you paid 1,000 crores. You will recognize the fair value of the tangible assets. You will identify intangible assets. The last amount is goodwill. So therefore, when you started with the statement that, look, is it breakup of goodwill? In some sense, yes. In some sense, yes. But that's how you get to the mechanics of it. Yeah. It is not goodwill. It's a simpler way to put it. You actually identify each and every item and the residual is goodwill. Correct. 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 So in fact, this has become a very relevant consideration. So when we are actually doing a purchase price allocation report, one of the key asks from management is that please keep minimum amount in goodwill. That is one of the first things that CFO will tell me, that look, goodwill tax में अभी allowed नहीं है. Madam has made an amendment in Income Tax Act. Goodwill is not allowed in tax. Please figure out a way to keep the goodwill amount as minimum as possible. Without sharing the name of the client, I can tell you right now, I mean, live, yesterday I'm working on a transaction where another large firm is an auditor. We are in fact meeting the valuation experts in the evening today for exact this very amount, where CFO is saying, boss, goodwill come karo. So you're right.
Can I say something, sir?
Yes, sir.
That 600 crore rupees you give that guy, example. 300 is machinery. I say no, I take a valuation report and I make it 400. Can I do it?
Yes.
I say furniture and fixtures and this and that is not 50, it is 150. So can I make the amendments supporting by the values?
You can.
So that this gap of the 100 which is getting into goodwill will become zero.
But the only question is that you will have to back it up with a valuation report which says that why the fair value is what it is, right? So till such time you have a logical backing. You can't, correct. But what you are saying is practically what is, so CFOs are telling us, look, goodwill is not allowed in tax. I will lose money if you put amount in goodwill. How can you sort of have your purchase price allocation in a manner that I will have intangible assets more, which are tax deductible, right? Because eventually it is about tax efficiency and tax planning at the end of the day, right? So this is a really very relevant practical consideration we go through almost daily, honestly.
Sir, you have the receivable of 800 crores. But I say, yeah, no, this 100 crore will never come because it's a debt company, debt receivable.
You can say fair value 700. Of course you can. It is not relevant in console. So his point is, if the acquisition was done in standalone. In Indian context, the tax authorities works on standalone. There is no concept of consolidated tax return in India. But the same example, to his point, the same example, imagine HUL was acquiring Nestle and merging it immediately. So they were doing slum sale, for example. Then all the points that he mentioned become relevant immediately. Of course, console in India tax is not relevant. So that absolutely you're right. That's a commercial loss, my friend. You factor that in the valuation. That's what it is. So you can merge the company after acquisition, and there have been enough transactions in Indian context where people have merged, and in fact, again, Institute has done a brilliant job. If you look at an ITFG opinion, it is ITFG 9, bulletin number 9. In fact, in that they have clarified what do you do in those situations. And in certain specific situations, a push-down accounting has been allowed by Institute. So what is push-down accounting? Whatever goodwill, whatever customer relationships you recognized in console is now pushed to standalone pursuant to merger. Now those amounts which were earlier in console and therefore not tax deductible start reflecting in HUL standalone after merger and become tax deductible after merger. So you can merge after acquisition. Those amounts will start appearing in standalone. Some of those will become tax deductible. But this is a very, what I'm trying to do is I'm trying to simplify your answer. But in practical world, there are lots of terms and conditions. You have to evaluate the structure and then get to the answer. But yes, is there a possibility of merging after acquisition and potentially claiming tax deduction in future? The answer is yes, and there are enough and more transactions which are happening publicly also. Correct. Correct. Yes, potentially. Yes. Not in console. Pursuant to merger, yes. Absolutely, because it will be inventory. Potentially, yes. Potentially, yes. That is what, if you look at ITFG bulletin, they have explained in what situations push-down accounting is allowed. So, if you look at common control transaction guidance, common control transactions as per Ind AS 103 has to be accounted at book value. So, you are referring to an acquisition. So, after acquisition, the company becomes your subsidiary. So, step 1 is acquisition. It becomes your subsidiary. So, now it is a common control transaction. All common control transactions are at book values, to your point. However, in specific situations, Institute has said, yes, can you do push-down accounting and can you go past the book value concept in certain specific situations, yes. And in your example, potentially, yes. Asset acquisition. Push-down accounting logic is similar.
Can I make a statement?
Yes, sir.
See, earlier I said that I can write off some receivables, say 100 to 80. Similarly, there is a payable. I say, no, this liability is not accounted. So I want to account. Can I do that?
So again, it is not as black and white as this. Why have you not accounted for liability? Was there a reporting error?
Sir, this may be contingent. the events have happened after the event of the balance sheets.
Yes.
There are certain events which has taken place which has made my liabilities more focused and more committed, which was not earlier.
So
then I
contingent
don't have
liabilities you can.
See, I don't want to blame the previous management or the previous transactions. I want to say today the liability is not 100 but 130 or
You
200.
can. You can. Provided valuation supports it.
Yeah, yeah. See, everything I have to support. If I don't support, then I am lost.
100%, sir.
Thank
All
you, sir.
assets and liabilities at fair value.
Thank you, sir. Thank you.
Capital reserve. In IFRS world P&L, in Indian context, we have a carve out, it goes to capital reserve.
From a tax perspective,
Yeah.
here basically I'm increasing the tax base. If I'm valuing the assets more than the value that I've paid, I've created the asset base which is greater than the value I've paid, which goes to the capital reserve. From tax perspective, I'll still take the deduction basis the valuation. And
Tax
that-
works separately.
Okay.
Tax will work as per the income tax rules.
But the PPA will same PPA will apply, right? For the start base.
Yes.
Okay.
Sorry? In console, no. If you have done push down accounting, then potentially yes, under certain conditions. Only if, see, when you do an acquisition, when will you account for the transaction? Suppose you bought shares of a company, therefore all of this accounting will happen only in your consolidated financials. In India, there is no tax on console, it is all standalone. Standalone is book value, pre as well as post. Only situation where in standalone you start seeing all of this is pursuant to a merger. And that is the only narrow exception available, and that is guarded by ICI by multiple conditions. So it's a complex discussion. We can't do it in this forum. But yes, in certain specific situations, pursuant to merger, you can push down the values and potentially get a tax break. Yeah. Correct.
Automatically all those intangible become part of your standalone. If you acquire the entity, that become the console adjustment. All this fair valuation come as a console adjustment. If you acquire a business, then automatically it become part of your standalone financial statement.
Yeah. Okay. Pooling of interest. So as I said, there are multiple ways in which you can acquire a business. One of the examples is common control transactions. Common control is nothing but group restructuring. You have a large conglomerate, for example, and you are moving entities from one entity to another, one division to another. The guidance is very clear. Unfortunately, IFRS is silent, but not Ind AS. In Ind AS, we have a specific guidance on common control transactions, which says all common control transactions have to be accounted at book values. No goodwill recognition is possible in case of a common control transaction. So all you do is, if there is a merger of two fellow subsidiaries, all you do is simple pooling of interest method, line by line addition, and difference goes to capital reserve. That's the simple accounting treatment for common control transactions. IFRS is silent though, but in Indian context, we have given specific guidance. One nuance in common control transaction, which is very important for us as financial reporting team, is the fact that all common control transactions have to be restated. What it means is that, let's say for example, you are right now in, say for example, July of 2026, you are merging two fellow subsidiaries, A and B, in the month of July 2026. Suppose you get a NCLT order and the merger is effective now. When you are preparing financials, you will have to restate as if the merger happened with effect from 1st of April 2024. So you will have to restate the comparative period and you will have to work from opening balance sheet date. So for March 26, the comparative period is March 25 and your opening balance sheet will be 1st April 2024. So this is the only incremental nuance when you talk about common control transaction, that it mandates us to restate the comparative periods also. Yeah. We talked about business combination and asset acquisition, and we spoke that why it is very important to get this right, because the accounting treatment is very, very different in both of these scenarios. So this is a slide that just summarizes the fact that, look, in case of business combination, there will be goodwill. In case of asset acquisition, there can never be a goodwill. And the fact that how do you account for your considerations and how do you sort of measure all the assets and liabilities. What I wanted to do now is, what does this image sort of tell you? It's a tug of war? Yeah? tug of war. So I can tell you there have been numerous situations in which I've been involved, where I've literally seen tug of war, and in fact I've been a party to the tug of war as well. So what does this mean? Now let's take a practical example. There is a very large Tata Group company, say company A, and there is a very large, say for example, a French company, company B. Now both of them are very clear that they want to set up a joint venture and they want to do business together in India. Absolutely very clear. So from a business standpoint, absolutely logical. The French guy has the product, Tata has the distribution ability in India. Match made in heaven. The stakeholders of the companies have met. They've all said yes, all okay, perfect. Everything superb. So from a business perspective, bang on. Absolutely no problem at all. Valuation also not a problem. And both the leadership have shaken hands, they've had parties, all done. Now comes accounting. They sit together and start talking about the shareholder agreement. Now this is where the tug of war actually comes in. So when you look at a shareholder agreement, now the French guy said, look, I want top line in my books, which means I want consolidation, which means I want control. I want the top line of the JV to be reflected in my books. Tata guy said, look, I always thought top line was mine. Because I am in India, I am the distribution partner, and therefore I want the top line. Now that is exactly when the transaction starts sort of cracking. And I can tell you multiple situations where people have walked out of the deals simply because of this one reason, where who will get the top line becomes a very critical question. Now how does this work practically? Who will get the top line is the JV partner who controls the company. So I'm talking about a slightly different structure, sir. So effectively, let's say for example, Tata and the French entity have formed a JV. That JV is called JV ABC Limited. Now this ABC Limited is doing business in India worth thousands of crores, and the top line is massive. That's the business plan of the company. Now who will consolidate entity is the question. That is where the shareholder agreements comes into the question. That is where you will look at what are the rights that are available to the shareholders, and that will decide who controls the company. And the JV partner who controls the company obviously gets the top line in their balance sheet, right? And why is this important for both of them? Eventually, once you get the top line, the valuation, the way the market looks at you, everything becomes very, very different. So therefore, this is a very important fact pattern. Now, how do you analyze a shareholder agreement is effectively the question. So you look at, so in Indian context, most of us believe that if you have a 51% ownership, you are the one who controls the company. Whereas in India's or IFRS world, while percentage stake is relevant, it is not the only determining factor. For example, even at 51%, I have not 51, in fact, even at 60%, I have seen many situations where we have said, boss, you don't control the company, you only have joint control, for example, over the entity, in which case it's a jointly controlled entity. And exactly that's where reserved matters come into effectively relevant, become very relevant. So what we've done is that we've put some examples of some of the reserved matters that we practically analyze in a shareholder agreement. Some of them are protective in nature, for example, change in articles, change in memorandum of association, change in registered office. These are all protective in nature. They don't swing the answer. But if both the JV partners, for example, have a say in business plan, have a say in budget, and both of them have to approve this, then none of them control the company. Therefore, none of them will get the top line, right? So again in the same example, and the Tata and the French example is not a fictional example. It's a real example where I was involved. In fact, the deal did not happen, and it is all in the press also. It is enough and more in public domain. They walked off because of this, because both of them were not able to come to a same page as to who will control the entity as per accounting standards and who will get the top line. Both wanted the top line, and it was non-negotiable for both of them. So imagine a situation where your leadership has said, look, we want to do a joint venture. Your leadership has said, look, we want to go ahead. Valuation is not a problem. Business model is not a problem. Synergy is not a problem. Everything is sorted. But this one accounting matter effectively derailed the deal, right? So how do you analyze control is very, very relevant, very important. And in fact, a lot of times we get involved when the shareholder agreements are drafted. We work very closely with the lawyers. We work very closely with both the shareholders to make sure that their commercial objectives and accounting objectives are aligned and captured well in the agreement. Otherwise, you will end up with a signed document and you will end up with an answer that you may not like eventually. Yeah. The last slide I wanted to cover was carve-outs and demergers. There have been many situations in India where you do a demerger, where you do carve-outs. And again, a lot of times people assume that, look, it's just one division going there, but it's often not. How do you carve out the numbers? Of course, it is very easy to carve out direct numbers. So if a division has a plant and machinery or a factory, it's very easy to say, look, this factory belongs to division. But more often than not, you will have common items, you will have common expenses, you will have common assets. How do you calculate those? How do you carve out those? Those become very important. Look at it from the resulting company standpoint. How will their organization structure look on day one? How will their processes work? How will the systems work? How will the controls work, internal controls on financial reporting? Those are some of the practical things that we see day in and day out when a demerger or a carve out happens. So again, all of this is work done by chartered accountants. So this is all for us to do, by the way. And these are all the areas where practically there is enough and more opportunities for us as professionals to work with the companies and help them stabilize the operation after the carve out is done or after the demerger is done. So a demerger or carve out does not simply mean giving a tax advice or giving an advice on date of demerger. It also involves a lot of work for resulting company, where chartered accountants like us can play a very important role and help companies in multiple things: systems, processes, internal controls. How do you set up your finance function? How do you run going forward? How do you ensure there is no disruption on day one? All of these are areas of opportunities for chartered accountants like us. So I think that's what I wanted to cover today. And I think by now you would have realized that whenever there is a merger and acquisition, whenever there is an internal restructuring, please make sure you are present. There is enough and more to do for professionals like us, and I think that's what is very important for all of us. Yeah. Thank you for all. Thank you.
So thank you, Jenul. Excellent session. How's the session? So I invite Rishikesh. You have any questions or any further? You want to discuss anything? You can raise it for next 5 minutes. Otherwise, I'll invite Rishikesh for formal vote of thanks. Come, Rishikesh.
Maybe in the next session, I think Yashvardhan Gupta is going to cover the next session. Maybe you can cover it with him. I think he will have a sense of this.
The next session is on taxation, so you can take up that. That was a wonderful session by Mr. Sanghani. What was interesting was the posers that he posed. Apparently, on the face of it, very simple, but then deep dive into it, and then you understand, okay, there are a lot of complications which are involved, which we really do not realize on the face value, on the face of it. And then when you get into it, you realize that, okay, there are a lot of complications which will be there in M&A transactions and which will require the help of professionals like us. So with that, I would like the audience to carry out a warm applause as a token of our appreciation. We break for lunch, and we'll...
Yeah. So we have finished 2 sessions. First is overview of merger and amalgamation, and now the second one was accounting, and now the most important, the tax aspect of the merger and amalgamation of transaction. So I request my council colleague Piyush Chandak to escort the speaker to the dais. So next session is, as you know, on the tax, and speaker is my office colleague from Deloitte India. He will be covering this topic. I request Rishikesh to introduce the speaker. Thank you.
Good afternoon. Yashvardhan Gupta is a fellow chartered accountant and a law graduate. He's currently director at Deloitte, and he advises on domestic and international acquisitions, joint ventures, fund structuring, and governance advisory. His extensive experience across private equity, family enterprises, fintech, real estate, and other corporate reorganizations. He's recognized for delivering tax efficient and commercially strategic solutions, and he has been a resource person on various forums. With this brief introduction, may I request our regional council member, Mr. Piyush Chandak, to welcome Mr. Gupta with a memento. May I request Mr. Gupta to kindly take over the proceedings?
Good afternoon, everyone. So, I've been given the toughest slot for the day because there are three good conditions going on here. Our tummies are full, our eyes are heavy, and the content is quite heavy. So, I'm sure that people would be sleeping. The only request here would be that please don't snore in a volume higher than my microphone. And thanks to the weather. The weather is awesome. So, my topic is a bit more dry, and I've tried. So I'm so happy that this job is not AI replaceable at the moment. There's some. Thankfully so. So I'll just begin, give you a perspective, what kind of a merger, acquisition, demerger, business structuring. I'm sure everyone here is a CA or could know some bit of a basic definition of what it means. These are usually business acquisition or business divestiture strategies. It's as simple as it gets. Merger is when two companies come together. Demerger is when a company split. We've got the largest mergers, we've got the largest demergers across the globe, which are driven by tax considerations per se. Tax plays a very, very important role, leads it from the front. And therefore, at the end of this session, my only idea of this group, this focus group, is going to be for it to be a takeaway session. नहीं चलेगा इसमें. हाँ वही करना पड़ेगा. Why is it happening? Windows P. Duplicate. नहीं चलेगा ना हमारे इधर. Hello. So they tried to make my presentation less, but it's happening anyways. So what I've tried to do here is, I've tried to bifurcate this presentation into 5 broad parts. Obviously, I'm going to discuss the typical modes of how a business restructuring works. I'm going to spend like 10 minutes or maybe 7 now. Then there are going to be 3 distinctive concepts of merger, demerger and slum sale. I've tried to make it case study based because it's going to be a interactive session. And then I've also tried to build in a few of, typical M&A nuances to it. Like I would try to cover Tiger Global and the recent case law for Sterling, etc., etc. Without any much delay, I'll go to, so this is the typical broad-based business organization chart. 1 or 2 strategies are usually used. Combination is used in case of a business restructuring. You will have restructuring could you could have an amalgamation or a merger, basically consolidation of business. Or you could also look at demerger, which is, as I mentioned, carve out. These are basic concepts which I'm sure this crowd would know, but I've tried to put it here. Going to the first part, what is typical, what is amalgamation merger, a term which is interchangeably used. Typically, there would be a consolidation of 2 entities, maybe a company 1 and a company B, A and a company B. There would be one surviving entity and the other would get vested in the surviving entity. And the shares, and a consideration in a form of shares usually, and there is no restriction of giving out any other instrument or any other consideration like a cash, but usually there would be a consideration in the form of shares of the resulting company. It's a good regulatory process that needs to be followed to ensure this. Basically, that procedure could be a court procedure. Earlier it used to be High Court, then it came to NCLT. There is respite now for also certain RD kind of procedures that needs to be done. I'll come to that in a few minutes. From a tax perspective, because that's the focus of my presentation today, you need to ensure that there are certain conditions that are met for it to be a tax neutral. And by tax neutral, I mean, what is the need for a tax neutrality? So if you look at a merger in this case, the first, and these are 2 transactions that are happening in a merger. When company A merges into company B, the entire transfer of assets from company A to company B is one transaction. And the second transaction is when the shareholders of company A now become the shareholders of company B. These are the 2 taxable transactions per se. And then you come to 47. I'm used for the purpose of this session, I'll be using old income tax section numbers also. 47 per se exempts these 2 transactions. So per se, there is a transfer and then it has been exempted by saying that it is not a transfer. For it to become a non-taxable event, there needs to be a transfer of property, which is assets and liabilities all go to the amalgamating company or the resulting company. The shareholders of at least 75% of value of the amalgamating company become the shareholders of the resulting company. And I have a case study for that too. And then there are additional conditions for tax losses which also needs to be looked at for harvesting losses, which is continuance of an industrial undertaking with some kind of parameters. These are the broad-based what an amalgamation from a tax perspective is. As I mentioned, it is going to be an NCLT process, or so usually every amalgamation in the country would be an NCLT process. It would be, I've tried to encapsulate this in 13 to 14 slides. Basically, it's going to be drafting of a scheme, board, then there's going to be a board resolution for accepting the scheme, then a shareholders resolution, and also mixed with chairman filing and a report at NCLT, where the members of the NCLT would pass an order. There are 2-3 external parties which are also part of this process. One is obviously the valuer. The second is the lawyer who is going to present. And then there is going to be an official liquidator. There is going to be an RDROC who are going to clear the scheme. And thereafter there is going to be a stamp duty adjudication wherever it is relevant. On top of all of this, which I have not written, is that a CA holds the entire procedure in India, largely, and lawyers also do. I'm both, so it works for me in either of the service providers, but it helps. A final order by NCLT is binding on the parties, and then it has to be filed with the ROC when it becomes effective. The large part of the schemes in the normal course of business would see that the effective date, basically when it becomes effective, is the day when it is filed with the ROC. Assuming there is an NCLT order which has been pronounced by the members and it has not been filed with the ROC, is it effective or not effective? Sorry? Not effective. Correct. No, I'm saying it's not filed. Delay is when I actually file late. Correct. So technically, an NCLT is a court by itself. A direction of the court is directly binding on the parties. Usually in the court direction, it is written that this scheme will become effective always on the effective date. And therefore, if you don't file it with and the effective date is usually set to be when it is filed with the ROC. If you don't file it, does not become effective. There have been cases when minority shareholders have gone ahead and said that you still had to file it, why didn't you file it? And then the NCLT would want legitimate reasons of you not filing that once you did the entire procedure and not filing it. Then, from a over years, it was a long procedure, 6, 8, 10 months going on the court, and then there were court holidays, etc. Recently, so first it was liberalized to come to the RD, and now then it has come from the scope of an RD merger has been increased. A fast track merger is a situation where you don't have the NCLT procedure. Other than that, all the procedures that have been mentioned are to be done. Like evaluation has to be taken, liquidator is appointed, but the entire thing happens at the RD level. The first, second, third motion doesn't happen. It only ends and starts at the RD. Predominantly, it's a very new concept for a large number of companies. Earlier, we've done VOS mergers, which is holding company and wholly owned subsidiary mergers. There, RD was there. RD already existed, and we've done the RD mergers. This has come 6 to 10 months back, wherein it's a new concept. It's worth the time. It's worth the effort, because there are many companies and now have come under the liberalized. And without taking time, it's written on the board, but I would say, like, for example, a cross-border merger. With a Ghar Wapsi, or you could say reverse flip, very much in existence in India. It was a very large ask from the industry for minimizing the timeline for a reverse flip. And that is the reason even cross-border merger, wherein a foreign holding company merges with the Indian VOS, has now also been part of the RD mergers. Now, what is the takeaway here for everyone? Is that whenever you get a client for a restructuring, and this is going to come very, very frequently to you, the first question you need to ask from the procedure. Many a times we've come across places where the procedure actually kills the deal. I cannot wait for 6 months. I cannot wait for a year. I cannot wait for an integration to happen. I need the acquisition or the asset to be in my hands. That's the situation where we as professionals now need to be thoughtful of, yes, there is an alternative route. The alternative route is a RD fast track merger route. And there are typical small companies also getting covered when they've got, it's actually called small companies, but the loan debentures 200, it's not typically a small company. But as a framework for an MSME enterprise, this is a very nice idea for a consolidation. I also would like to highlight, so if one were to look at the other and this, I've just enlisted some benefits. One of the benefit, as I said, the timing is less. There's less documentation because in a NCLT there's a lot of sworn affidavits, etc., that needs to be filed along with our wakalatnama and all those documents. From that perspective, it's a very shorter and a easier process. And largely it was introduced because it was for the ease of doing business in India. I just now want to take a pause, and this is all I've covered about the theoretical or the conceptual part of amalgamation and merger. The 3-4 slides would actually give you a brief overview on what a merger from an India Tax and Companies Act perspective is. But I just want to take typical transactions as a case study. These are transactions which are very much in market. So by the end of this, you will know that these are the things that come in the market and these are the items that professional would expect us to answer. Management would expect us as a professional to answer. I've got a case study where Y holds B and B holds A. A company is going to get merged into Y co. Obviously, because section 47 clearly mentions that an amalgamation is exempt. Amalgamation requires you to issue shares. Can Y co issue shares to shareholders of A co, which is B co? Okay, let's do something like for a snooze alarm right now. Please get up, everyone, and just tell me a yes or a no. The answer is there on the board actually. No, that's actually extinguishing its capital. And again, there are two transactions here. A company merges into Y company and the shareholders of B company held in A co are getting cancelled. Is there a chance of a merger in this case? It's a merger. The point here is that the Companies Act does not allow you to actually issue shares to its subsidiary. Because of that restriction, you cannot issue shares to B co. Now, with this, is this an exempt merger or not? Because amalgamation requires you to issue shares. Will be exempt, okay. Any other view? Sorry? You can't issue, right? It requires you to issue shares. And my friend is right, the view one, which is predominant in the market, is that you can't issue, still it will be an exempt transaction. Yeah, please. I'm sorry? No, which is fine. I mean, predominantly from a Companies Act, because yes, it's a statutory vesting. There's no doubt on that. The question is, there is a requirement of issuance of shares. And in this case, the shares are not issued. Is there an exempt transfer? Is this a item which is allowed for claiming income tax exemption? The answer is, the view one is the more prevalent one, where it is not supposed to, because there is an anomaly in law. The law does not allow me to issue shares to my wholly owned subsidiary. And then there is another case law which came in Credit Suisse AAR, where they said that it is not an exempt transfer. It's not an exempt amalgamation because you did not issue shares. As much as that is being challenged, prevalent, and our view mostly, the better view seems to be that it is an exempt merger. this is another case that I want to take quickly. A is a company which is merged with B. As part of the merger, B will be issuing a combination of shares and debentures or bonds or whatever you call it. The point here is it's a composite consideration. It could be bonds, cash, anything else. Is this something that we believe is an exempt merger or not? See, your shares are being issued, but along with shares, there's something else also being issued. For example, if I had to pay 10 rupees for acquisition of company A, I'm issuing 7 rupees of shares and 3 rupees of bonds and cash. Sorry? So long as shares are issued, it's exempt. Okay. Okay. 90%, 80%. Any other view? So by your logic, can I also say that you issue only one share and give 9.99 rupees as cash for it to be exempt? No, it's the 75% shareholders should continue. For okay, okay. So your view is that you can have a share or a debenture, but you can't have cash. Okay.
You want to issue the check to the recipient company to deposit in the account and then use it?
Correct.
I don't think this is a workable condition.
So sir, predominantly let's take a step back, okay?
Yes.
We are tax professionals. We have to give our opinion on the tax portion of it.
Yes.
As a commercial consideration, I will not be able to tell to the promoter that cash is not the correct item to issue.
Yeah, promoter will have his own thoughts.
Exactly. And
promoter
therefore
will not listen of any of these things. You say, I want to do this.
Exactly. And therefore the management is asking us, and it's not right or wrong, right, at the most. I want to issue 7 rupees of shares, 2 rupees of cash, 1 rupee of bond. Is this an exempt transfer or not? Is that the question? That's the only question. The question is it exempt? It's not the ability of the company to give cash or not. Correct. Shareholders. Any other view? Yeah. Exactly. That's a nice point.
Sir, I think so both will be, the shares portion are also exempt and the cash component portion will also be exempted. I personally think so. Because sir, sweat equity share, in the case of sweat equity share also, in the case of ESOP also, the shares become exempt, na sir?
Correct. So you're right, and this is where our professional judgment plays a very large part. There are two situations here. We've got the Madras High Court and we've got the Gujarat High Court. Madras High Court says that it is not a tax neutral transaction. You are only, because the provision of the law says shares, the only item that you can give is shares. You can't give anything other than shares. That's what Madras High Court says. On the contrary, Gujarat High Court says that no, shares plus other items can be given, can be issued. Because the word does not restrict not giving any other item, which is a bond or a cash or etc. And therefore, currently there are two schools of thought. From a litigation perspective, we have seen the tax department also prefers the view of Gujarat High Court, because the law or the idea of an amalgamation or to give them an exemption came from the idea that's a share for share. My ownership in one company transfers or transforms into an ownership of another company. Nothing else has shifted from my side. There is no cash flow to me. There is no cash inflow, outflow, or maybe any other instrument by way of where I will get a cash in the future. That is the reason that they believe, at least the tax department is of the view, that only and only shares can be issued. Then it is a transaction which is exempt for both. Sorry? So again, I'm not determining tax efficiency, I'm just determining the taxability. Now I will come to, there is another, and I don't know why this intelligent group of people did not come with the second question to me, which is, okay, if it is a taxable transaction, who is going to pay tax? In whose hands is it taxable? So there are 2 points. One, in the country like India, you don't have an option not to pay taxes. You obviously have to pay taxes. Secondly, Secondly, it's not commercially viable. The tax is always 15% of the income. Okay. So I feel that a commercial proposition, even though payment of taxes, where we've done a large deals where we pay taxes, because the deal asset has a more impact as compared to tax. And therefore, I'll come back to the question, the tax needs to be paid when or by whom. In the same case laws, they've said that the shareholder will have to pay tax for the consideration it received in other than shares. And therefore, it becomes a taxable only for that particular part, which is again in litigation and other case law, where they say that no, the moment there is no concept of proportional, the entire thing should be taxable. Correct. So tax law is also part of how our civil procedure is. We have to follow the jurisdictional high court of. So for example, if you're a company in Gujarat, they can take support of the jurisdictional high court, which is Gujarat, but not necessarily that it is. And the high court of Gujarat or the authorities in Gujarat have to follow the law laid down by the Gujarat High Court, because it's a jurisdictional high court, but it does not solve the situation here. I'll tell you why. If there's a company in Tamil Nadu, or if there's a company in Maharashtra, we have got 2 high courts, one in favor, one in against. So until now, it is at a Supreme Court level. Until it is now decided by Supreme Court or our government does some kind of a retrospective amendment, this position will remain open. And that is when I started with the case study by saying that we have to take a judgment call. Is the deal so important that you are ready to take a tax litigation? That's the question. The question is not payment of taxes. I believe now the tax rates are so low, it's only 15% of the entire game. You have to now take a call as a judgment whether I want to pay the 15 rupee or not to get the 100 rupee asset. That's the point that we are going to debate, or make a difference in a deal room. It's a deal situation. Exactly. So I'm so thankful that in the beginning you said it's not doable. Now you're saying it made a difference. Yeah. Yes. Thank you.
The same thing happens with the High Court also. If you give the different argument, he will come with a different name. If you don't give that, then he will say no, it's not.
And this is the reason why before going for any restructuring, along with the stamp duty cost implication, this commercial viability structure is also evaluated.
Exactly.
Shifting of registered office to Gujarat to avoid tax litigation cost is more viable than continuing there at 2 different high courts.
Could be one of those, and therefore I'm saying because now this is going to the Supreme Court, etc. And a composite consideration will be debated maybe and again, as you mentioned, you can shift an RO. That's a call that you need to.
So in one of our very large deals, we have shifted from Tamil Nadu to Gujarat to conclude at Gujarat High Court itself.
So I've seen that also, and ma'am, we've seen so many people shifting to Gurgaon for saving stamp duty also. So yes, that's also done. I'll come to a case study which is a bit more like indirect transfer. In this case, what is happening, the BICO is actually holding Indian entity, and BICO is a foreign entity which is then getting merged into another foreign company. Okay. The question here is this exempt? So just to give a perspective, there are foreign company mergers that are also provided in the tax law. The section 47 also provides for a merger case scenario when there are merger of 2 foreign companies where the entity below is an Indian entity, subject to 25% of the shareholders going ahead and becoming part of the resultant company. What I just wanted to bring out in this scenario is there are 2 situations again. there's a merger of BCO into EXCO, which is the entire shareholding of BCO, CCO is getting transferred to EXCO. There's a issuance of shares, and ACO's shareholding in BCO is getting cancelled. Now the question to you on this room is, as I mentioned from the very beginning, there are two transactions at play. One is the merger, and one is the cancellation of capital held by ACO and getting replaced by the capital of EXCO. I'm not going to ask this question, I'm going to say this because there's no litigation around this and there can be no different point of view. The simplicity reading of the law is as under. The merger of BCO into EXCO where there is a transfer of shares of CCO is exempt because there is an exemption particularly provided 25% etc. But what is not provided in this law is that, and they've done the 47(6) to say that the resultant company should be a Indian company. In this case, the resultant company is a foreign company, and therefore the shareholders of BCO, which is ACO, when the shares are getting cancelled, do not actually get that tax benefit. And from a literal reading, what happens is that the shareholding of ACO into BCO is a taxable event. And how do you compute? Because if it is a related party, then this goes under the transfer pricing valuation, which is at the arm's length, which is a very big outflow for anyone to look at. This is a typical nuanced item wherein the language is made such that it does not avail the benefits of a merger. I've also done this in the indirect transfer. So the earlier one was a direct transfer of the CCO, which is the Indian entity. Similarly, if BCO, which is holding in CCO in a foreign company scenario, the indirect transfer is also not covered. And what is worse actually going forward is that the receipt of shares, which is the issue of shares of ACO, also are another taxable transaction. Because under 56(2)(10), so as we know, the receipt of share is a taxable transaction in India. If I were to receive any shares, even under a sole merger scenario, it is taxable transaction. For receipt of shares, they've gone ahead and added a clause in 56(2)(10) where the laundry list of 10 items, where the recipients, the shares which are on received on the amalgamation are exempt. But they have missed out this clause under 56(2)(10). And therefore, in a scenario as such, not only the transfer of ACO's shareholding in BCO is a taxable event, the receipt of shares of EXCO in the hands of ACO also become taxable. There is no case law that we've been able to find on or a litigation around this, but this is only exactly how the section has been worded. Now, before my session actually, I had the advantage of actually attending 10-20 minutes of Jenul session, and there was a discussion on debt push down. So while my friends were taking lunch and getting ready for the sleep in this session, I tried to make this slide for everyone's benefit. The situation is as under. Today, what is the capital gains tax on the long-term portion? And what is the dividend tax? 36%. How do my client came to us and told me, how do I solve this situation of an inflated tax that I have to pay for the only profit that I have earned, and how to extract it? This is an debt push down is typically also a extraction strategy. What we will do, we have a holding company with holding 100% of ICO, and I would request everyone to stop me in the step that they don't understand, because this is going to be a very complex debt push down study. And this is a typical structure that you can do actually in India and overseas. This is bereft of any geographical restriction from an India tax perspective. Holdco owns 100% of ICO. What we do is that we make a new company in India. And for example, the 100 is the value of the ICO. the new company will acquire or avail a business loan of 100 rupees. Okay. And then it will acquire the shares of ICO. Okay. So what happens is that during that time, it is a capital gains for a holding co. Correct? And therefore, the dividend extraction cost went from 36 to 12 in a minute. But it's not over. Now what we have a parallel structure where holdco is holding 100% of newco. There is a bridge finance there. And then we have a 100% of ICO. What we will do is we'll go ahead and merge the ICO into the newco, because the ICO had the 100 rupees which they wanted dividend out, and that same 100 rupees will be repaid as bridge finance, repaid towards bridge finance. By doing so, I unlocked the cash at the ICO level, and I also repaid the debt at the newco level while getting my holdco 15% or 14% tax rate. There are 3-4 questions that will come. First question, whether that interest on the bridge loan is at deductible or not from an income tax perspective with operation of 3613. And then I'm seeing a few nods here and there with people saying yes, it is deductible, and then there is a litigation saying that it is not. But I must correct. So I'll come to that. So first, before I move on to the tax portions or the tax discussions, is this structure understood by everyone in this room? Should I repeat it again? Yeah, so I'll repeat it. Holdco has 100% of ICO. ICO has 100 rupees cash. If I do a dividend of 100 rupees, 36 rupees is a tax outflow. What I will do, I will put a new co below the holdco. Giving an example. Now, newco will actually acquire shares of the ICO. And sir, I'm thinking 36 because I want to take the highest. It could be a foreign, so I don't want to impair it for my discussion. The newco will actually acquire the shares of the ICO. Okay? And that is the case when the capital gains will arise. The capital gains will arise at the holdco level. Okay? And that holdco will actually acquire the take the 12.5 or whatever the TT benefit is. If you hold these ICO shares of Singapore pre-2017, the entire transaction is 0% tax actually. And then you go ahead and if you look at the structure below, you've got a holdco and a newco and an ICO all in line. The newco actually took a bridge finance of 100 rupees to pay the holdco 100 rupees. And now through the merger, the entire cash at ICO will come to the newco and the bridge finance will be paid. In this, what I try to do is just get the tax rate to 12 to 13%, whatever it is. From a tax attribute point of view, whether first question that came to my mind is that whether the interest that I paid on bridge finance is tax deductible or not. So there are two, again, schools of thought. And luckily, when I say two schools of thought, I should take a good smile because that's an opportunity for us to make money. The first one is that it is not allowed as a deductible because it is not for the purpose of your business. And therefore, 3613 and the business of a whole newco and a business of an ICO is a business of its own. They are separate legal entities, and separate entities have their own businesses, and that my subsidiary's business is not my business, and therefore this amount is not deductible. And then there is a second school of thought that says no, the acquisition of a subsidiary, growing inorganically, doing a business like how airports are structured today. We've got 10 airports below one umbrella entity, hundreds of RE, which is real estate assets, below the main developer entity. So these, where they take an argument that my business and their subsidiaries business is no different, it has just been housed in that entity for ease of doing business. And therefore, it is a tax deductible item. I must tell you that there is no right or wrong answer in this. I'm coming to that. We've got Supreme Court in favor saying that you can claim it as a deductible. But anomaly is not that, and I want to give you a perspective on a Tata Group company, because there are two case laws which came in 1 month, which is Feb 2026. One for the Tata Chorus transaction which they did, the UK Chorus business that was acquired by Tata. In that business, they allowed the 600 crore worth of tax reduction. Okay? And in the same NCLT, which is Bombay NCLT, passed a case which is opposing this case in Tata Chemical, where they said that no, you can't claim this as a deductible. And therefore, the view that we need to take as professionals is that whether our client has the risk appetite to go ahead and absorb this litigation cost, or to take it to the Supreme Court. And then the Supreme Court obviously has got a set of case laws which are saying they are in favor. And therefore, this entirely should be based on very solid business rationale. Else, leave alone 3613, people will first challenge you under GAR. How did you do it like a new company coming, taking loan, buying shares? So entirely needs to be actually shown through by way of a strong business rationale, which is for this GAR.
A very strong professional lawyer who can fight and who can say, yes, this is what it is done and you have to accept it. No, this is not accepted.
Correct. That's 100% right.
What you have to fight against the point which is favorable to you, and you have to keep on hammering. And then let others say whatever they want. So things will definitely come to your address.
The point here is that, sir, it's not about even the professional, and you can always hire me. I've done this, but the point here is that we cannot predict. We are in the business of tax. Yeah. We are not in the business of doing behavioral and analytics of the tax department, how they will behave. Assuming, so therefore our suggestion to a client at the end of this should be, you need to take a very informed business call and then do this. Coming back to one, correct. So the Supreme Court, it says in the case laws that it says that it is used for the purpose of business. Now, use for the purpose of business is very factual, and that is the time that actually, therefore, it does not become a boilerplate opinion that it is allowable. It's therefore I'm saying it's to be supported by very strong rationale. The rationale that you look in the screen is a very pathetic rationale. If I were on my client side, I would say never do this, because there is no strong rationale to do this unless I build it over 2 years. Unless I build a story of having a NewCo in India, unless I build a story of why NewCo should acquire the ICO and go ahead. So that is where our actually, the future of the profession also lies there. It's more an advisory rather than giving a opinion whether it's possible or not. Then there was one discussion I put in the blue, is on the depreciation on customer contracts in such case of scenarios. For example, ICO got merged into NewCo, and I will record the assets. And if there is a goodwill that I record, obviously there will be a goodwill. If there is a goodwill that I record, whether there is a depreciation on it or not, answer is very simple. There is no depreciation on goodwill. Then someone very wise came ahead with the idea that let's take customer contract, business relationship and other intangible assets and store them in the balance sheet, record them at the time of the merger, and then claim depreciation on it. That's actually a situation where many people have done this. We've got senior counsel saying that it is possible. It's an acceptable structure where you can actually claim depreciation on customer contracts. Again, there needs to be a very strong rationale. So for example, someone would say that it's a fictitious asset. That's what the tax department is saying, by the way. I myself have been working with the GST panel on this structure, where our client has been asked that it's a fictitious asset. Why should we allow a real income deduction against a fictitious asset? And the argument, any argument, see, I'm a Baniya, I have a very Baniya type of simplicity argument. Is there any argument in this room? No, it's that I already paid for it, right? I paid 100 rupee, which included for the thing. So it's not fictitious. The moment you say fictitious, I have not paid or it's come from somewhere or the other. But either to 100 rupees diya hai. I have paid for it, and therefore it's not fictitious. Actual. And therefore, there are strong arguments. Since the law is very, very new on this, the litigation will come, and the litigation will show us where we are on this. Again, this needs to be a very, very structured business call that they need to take. Yeah. Correct. Largely what happens is that many of these holdcos would be, say, coming from Singapore. How will you merge an Indian company to Singapore? It's not there. Outbound merger per se, not there. Now what happens is that there are umbrella structures. Holdco could have any other businesses also. There's a very large cement business which started being housing under a textile. You getting my point? So the point is that until the business, so there could be various reasons for doing so. The holdco would be an untouchable entity for the purpose of business restructuring for license reasons. There could be a power plant that could be there. This typical structure, if you look at this could happen in a power case scenario where power assets are usually housed under different vehicles in a real estate when they are in the different vehicles, and when the holdco wants some kind of an extraction. That is the typical play, and we will have to see, because no one shoe fits all, right? So that's the situation when we will come in, and then we'll discuss on what from a tax perspective it makes sense. Now, who's heard about Ghar Vapsi, Reverse Flip, Pine Labs coming back to India, Zepto coming back to India? Who's heard of it? At least I expect you to know part now. Few members in the audience are known to me. They worked with me on this, and now they are behaving as if they don't remember any of such concept. No, rather I'm telling you, I want to not blame it on my session, but I have to blame it on the organizers for giving me the lunch session. And people are... So who's heard of the reverse flip? And as a concept, it has grown immensely in the country. So what happens is, what are the challenges and why people are doing reverse flip? Now people have come to you, spoken, and you read the news articles on what a reverse flip is. The holding company merging into India, etc. Dream 11 coming back to India, Pine Labs coming back to India, Zepto coming back to India, Flipkart coming back to India. Why they are coming back to India and how they are coming back to India is an item that is of interest. Now to quickly show you, investors are there, you've got a Singapore holdco and you've got an Indian operation company. Okay. What happens is that, what are the problems or challenges in the structure? Challenge 1, investors are at the SGCo level. You have an India opco which is listed. If I have to give cash, some investor might not want cash out, and someone might want an exit. He might want the cash. How do I dealing the cash flow for them? Because share जब बिकेगा तब एक ही साथ amount जाएगा in the holdco. How will I will have to distribute per se. तो किसी का percentage कम हो रहा है, किसी का ज़्यादा हो रहा है. There's a 2-layered requirement. What happens is I first pay capital gains tax here, and then because of the indirect transfer, how India is, any buyback or any capital reduction, etc., would again entail a tax at the overseas level. Getting my point? Now, if I assume that there is no tax point here, I want to do my own voting as an investor sitting at and I want to vote according to my preference at the India opco level. It's not possible, because I will be a minority in the Singapore holdco, where my vote will actually not be tabled at all, and then you will never read the listed co. Tomorrow if I want to sue the company for operation mismanagement, I will never be able to. If I want to come to the annual general meeting and do some kind of drama, I will never be able to, because I am stuck at... Exactly. And therefore, what happens is that I don't have any control, any oversight at the India co level. These are the commercial reasons for doing the flip, not the tax reasons. I mean, tax reason is the main reason, because the moment that capital gains goes up, then you distribute a 2-layer of tax will no one ever envisage, I mean, how will it happen? And which is one more item, that I want to sell, I own maybe 10% of the Singapore holdco, which is effectively 1% of the listed co. I want to sell my 1%. There's going to be a negative perception in the market. Yeah? The promoter who's holding 80 or maybe 60% is going to sell 1 or 2% in the market. it becomes a negative perception also, which is not something that we want to look in the larger scheme of things. These are the tangible reasons why someone would want to do a ghar wapsi, reverse flip, whatever you call it. It's a very simplistic structure. You just merge the Singapore into India. Correct. Correct. Okay. One of the best benefit, and which we never call out to our client, is that you were not able to get a good funding or a valuation in overseas, and now you've come back to India because you now know that you never. If you remember, Flipkart actually flipped its structure, and then it reverse flipped its structure. It flipped its structure to Singapore to raise funds in the overseas market. Now it came back because they are expecting an IPO. So the point here is again, and that is what I was telling earlier, tax professionals do not make deal makers. It's the thought of, we are not deal makers if we are just a tax professional. If I say there is tax, I have to think through like this. From a other perspective, I need to bring out a commercial rationale and tell my client that baki sab bhi hai, plus there is a 2-layer of tax that is there. Again, the main advantages I've already told, and these are the key planning areas, because of I just don't want to go that deep into the procedure, but this is what everyone's done, which is Singapore getting merged into India. There is a thought that whether Singapore can get merged into India, it can be done. There are a lot of schemes that are happening. And therefore now I have to come to my second portion, which is the demerger. Again, demerger, there's unit 1, there's a unit 2. There's going to be a demerger into another entity where there will be an issuance of shares. Again, there are certain items which is the transfer happens on a going concern basis, and business undertaking must be transferred per se, and liabilities, assets of that particular business gets transferred. Well, it's again a similar procedure from an NCLT perspective. I've come again on this question, and this will be quicker. If there is a CCO which is a subco of BCO, which is a subco of ACO, a demerger and then you issue shares, demerge into ACO, and you don't issue shares, again the question is whether it is an exempt demerger or not. Is it an exempt demerger? I'm sorry? No, so therefore we are saying that this is exempt because it's an inapplicable. So there's an applicable provision in law, which is Rule 19 of the Companies Act. It did not give me the ability for ACO to issue shares to the CCO or the shareholders of CCO, which is BCO in this case. And therefore, as I discussed in my very first case study, view 1 is the more prevalent, that inability of law has led to sin. मेरे को तो करने में कोई है नहीं. India में treasury shares होते, I would have done it, but they are not there as a concept. I want to come to a very simplistic case study. A company X has other miscellaneous assets, bank, land, etc. And then they have an undertaking. Whether transfer of an undertaking through a demerger to Y is exempt or not. Yes, no? Quickly. Sorry? They are unrelated, doesn't matter. So basically in this fact matter, company X has one business and one land parcel, 2 items. I'm transferring or demerging the undertaking to company Y in lieu of shares, and all I have remaining then in company X would be that land parcel. Question is whether this demerger is exempt. Question is whether this demerger enjoys the benefit and the shareholders enjoy the benefit of the tax framework. How many feel yes? At least give me show of hands now. Okay. And no? Ma'am, why no? So per se, your thought is exactly what a taxman would think. and that's what they are saying, that for a demerger to happen you need to have two undertakings. But the court has consistently asked the same question. Demerger is qua the undertaking, and you yourself in the tax law have written that that particular undertaking should be a going concern. Whereas the question of the remaining entity allow or mandated to be a going concern. And in absence of the same, they feel that it is not, the view in the market is not required as such, but litigation cannot be ruled out. I want to skip this one, it's simpler. I want to take this, sorry. Correct. So, for example, in an NBFC scenario, you're right, there could be this NBFC's business is holding shares in another company. There has been numerous case laws, not NBFC, whether investment as an can be categorized as an undertaking or not. And that in that case they are using the same scenario, that the business of my company and that company is not the same. However, the favorable case laws though say that they've been monitoring those assets they've been doing, and therefore, for example, a pharma business. If I had two businesses in my entity, pharma and say life sciences, pharma, contract manufacturing, life sciences, I would transfer the pharma and its operating companies all together as part of the entire thing. And therefore, investment also becomes part of the undertaking. It's natural that all the assets, including those, because they themselves mandated, right? All assets and liabilities of the undertaking or part thereof should go. And therefore, the asset, which is the shares, also goes. And on the other side, there are people who've done very, very mischievous planning, where the only thing that they demerge is the shares in the subsidiary, which we don't have a good rationale to do so. You might as well could have transferred it. So there are two views to this. Again, it has to be, as I mentioned, you have to change your perspective from tax. Now you build a rationale on why that one share or one shareholding in a subsidiary is an investment undertaking. Exactly. So that's what I was saying, that in this case, the only other assets that were of bank balance in the remaining portion, right? And therefore, the view is, that's what we discussed, is that what needs to go is to pass the test of an undertaking. Exactly. That, I mean, the case studies are based on the litigation. Though not settled, they are all in the court, and this is a litigation. And therefore, our discussion to our client is that don't keep land now as another asset. Keep a board minute saying that it was a land which is going to be developed and it's a real estate undertaking. Exactly. Then you have to say that we are going to do a treasury business, etc. Exactly. So that these are the points that the tax law will ask tax officer. And before we start, we have to start with 2-3 years back. 3 years pehle say how we build a rationale that those surplus assets constitute an undertaking. Because in a blatant scenario like this, there is no end to a litigation. There is going to be a litigation, because then you could have directly transferred the company. Why did you even keep, if you wanted share for share exchange? You could have extracted the other assets and given the company away. So GAR panel is going to ask you such question. What is the business rationale there? You can anyways, because demerger does not have that requirement. So for example, if I demerge a company, next day I can sell the shares. Vedanta did a demerger into 5. 3 of them are good, 2 of them are not. So people sold those. I will come to a very So tax business law is covered under 72A, and the concept is very simple. The losses which were pertaining to undertaking which got demerged go with them along with the UAD, and the losses which pertain to the undertaking which remain with the entity that was a demerged entity. And if there are common losses, losses arising because of commonality, they are apportioned between the two undertakings in a scientific manner. Now I must tell you one thing, the and in between these two sections is missing. So the section is 72A4 or 3, I don't remember. And the first line says that whatever is pertaining to the demerged undertaking should go to the resulting company. Whatever is not is commonly shared between the two, but the and between those statement is missing. And therefore there has been some people like me who have taken a call that it is either or scenario. And then there are some people like my friend who have taken a call that it's both scenario, you get both. You get 10 rupees of the direct and 2 rupees from the indirect also. So when you read the provision, because I don't have it handy at the moment, you see that the and is actually missing in between of that section. 72A4, 1 or 2 like that. Yeah. I'll come to the recent tribunal judgment which came, I think so, this month. Is on the Sterlite and Thomas Cook. It was a very big, it is going to have a very knee-jerk reaction for the industry, because many of them, Tata Coffee, Motilal Oswal, everyone has done this kind of a structuring, obviously following the advice of the people sitting in this room and including mine. So what happens is, in this scenario, if you see SHRIL is the entity. I don't have a pointer. Sorry. This is the SHRIL entity. This entity. Okay. This entity actually demerged its resorts business to another entity. And the other entity, and the demerger happened at the TCISL entity, which is the subsidiary of the holdco. And instead of TCISL issuing shares, the holdco issues shares to the shareholders of SHRIL. Correct? In a normal scenario, what would have happened? The shares would have been issued here to here. This would have been the scenario. But what has happened? That the shares have come from here. We were of the view, and there are senior counsels coming, and they've said that in this case, in a washer scenario, resultant company definition includes a holding company issuing shares on behalf of its subsidiary, and therefore the neutrality was always allowed and never in question. The tribunal has gone ahead and said that no, this is not the correct interpretation of the law. They are saying that TCISL alone is the resulting company for the definition, and its holding company cannot issue shares on its own behalf. It was a very predominant structure, and this was done, you know why? Because I didn't want to have fragmented shareholding at TCISL level. इधर क्या होता है कि my shareholder SHRIL are shareholders at TCIL level, at this level. Rather, they are not shareholders at this level. And therefore, what happens, the entire value consolidation happens at my level, and then they become shareholders. I'm trying to do something kind of a transfer in a normal scenario. What would I have done? I would issue shares to SHRIL and then done the share swap or an acquisition. But I try to avail benefit of using the language in the resultant company definition, which includes its holding company. They've gone ahead that to say, and they've actually not respected the jurisprudence by saying that whatever is written in the tax law should be the law of the land. So what are the courts doing actually? But we'll not get in a debate. And then also what happens is that since it is now not an exempt transaction, it does not fit in the 72A4 definition, because it needs to be a demerger. And the moment it is not a demerger, all the neutrality, there were 3 neutralities: the shares, the transfer of the undertaking, and the loss. Everything is questionable. This has come, I think so, last week, and it is very, very recent. It was passed by Bombay Tribunal. Demerger process process overview. I just want to give you, there is virtually no difference. It's similar. Only in case of amalgamation, there was a liquidator. In this case, there is no liquidator because both the entities are surviving. Now I want to take quickly slum sale. Not my favorite topic. Not that engaging and not that interesting also. Simpliciter, because I'll tell you why. Because earlier when we used to do presentations, our famous and the best structuring was a Bharat Bijli case, where you do a slump exchange and save tax for the clients and also impress audience. That is gone because slump sale includes slump exchange. Very simple. Transfer of an undertaking includes and excludes any which is not constituting business. There could be a lump sum consideration, and there could be and usually it's a lock, stock and barrel scenario. I want to say key consideration, obviously valuation is required now under the law. They have 11 UAs and that rule which is there. Then there is a cost of acquisition of the undertaking, simple, whatever is the book value is taken. Computation mechanism, long term, short term, full sale consideration less the book value of the undertaking. Sorry. And then there is succession risk, NOC for required from tax authorities, etc. We've got SEBI considerations in case of listed company, whether allowed. Slump exchange predominantly, very recently we also got to know is that SEBI does not allow for a slump exchange. A listed co cannot acquire a company's undertaking by way of issuance of shares. Then there are FEMA considerations on how a FOCC will work in such a scenario. I just want to take you to the test of an undertaking. It's also on lines of the same, that is with reference to demerger. It should be a distinct and a separate business activity. Business should be carried for earning profits. Basically, there should be some business rationale capable of owned and being transferred, transfer on a going concern, etc. What if, I just want to take the fourth question here, what if there are certain employees that are not transferred? For example, many people have just transferred free assets and liabilities and then claim that it is an undertaking. It goes under long-term capital gains tax rate 12.5, planning done. Again, here is when we will make a big difference. Without employees, how will you actually transfer an undertaking? How will a business run on a going concern basis? And then there is a jurisprudence saying that you don't require employees, but you require head and brain for anyone as an undertaking to function. So you don't have to transfer your CFO and CEO and CTO in an undertaking, but you at least have to transfer some knowledgeable employees that can run or continue the same business on a going concern in future. Is it compulsory for both income tax and GST authorities to take the same view? Predominantly, it is not required per se, not mandated nowhere. But if you look at the law, the GST law does not talk about slump sale. It does not talk about demerger. It only talks about transfer of an undertaking on a going concern basis, which is similar, not same, not say same because similar to the language in the Tax Act, but I'll say similar because there are other conditions also in the Tax Act, Income Tax Act, which are not there as part of the GST law. So basically, it's a bit more informed approach that if it breaks in the income tax, it naturally becomes a questionable transaction under GST. And then the entire tax is applicable, including whether under a statutory vesting scenario, the credits would be available or not to the resulting entity. I just also take you to the full value of consideration. This is a concept which has come recently because earlier people were taking benefit of this and distressing valuation. And like our tax department works, they've actually plugged this hole too. 11 UAE is the entity which rule provides for this valuation. It says fair market value of the assets that are transferred or actual consideration. Whichever is higher becomes the fair value of consideration. You can't distress a valuation beyond a scenario. And then there are key practical issues that we people in the boardroom would actually face a problem for, which is how will I actually factor a deferred or a contingent consideration? Should I add it in this? And if it's a contingent or a deferred, if it does not happen, then do I get a rebate? Correct? Because it is full value of consideration that they've used. If I pay something tomorrow and I don't use it, whether in that year do I have to pay taxes? And if yes, then whether the entity who's receiving or acquiring the slump sale, how will it record it? Will it be part of the asset, or will it be part of, it will be a dead loss because he will never be able to capitalize and not paid. These are the technical portions. There are case laws for both scenarios.
So then what is the recourse?
Recourse is simple, so it's an informed call. There have been judgments that say that the full value of consideration includes the deferred and the contingent. Deferred. Contingent, they are saying that it does not include, and it will be offered to tax in the year when we receive it, because that is when it becomes the real income. See, Income Tax Act, except for deeming sections like 56, are trying to tax, where they are trying to tax unreal income. The income tax charging section talks about that in the purview of the act, only a real income can be taxed. That's the reason, right? Your mean profits are not transferred, taxable. Your compensations are not taxable, because only a real income can be taxed, not a capital receipt or an unreal income, nominal income that they call.
The notional one.
Yeah, the notional one. No, notional are actually covered in 56, they are, but in this case there is no charging section to make this real or notional actually. It's not a deemed income that is coming. I also want to take you through the taxable, taxation of capital gains. There is one important point, that the period of holding is 36 months. It's a distinction. Everyone knows that everything has now become 24 months. This is one item which has remained 36 months. So when we are talking to the client, especially RE developer, we need to tell them that आपका land होता तो 24 months पे अभी transfer करोगे तो tax होगा. If it is a undertaking that we are transferring, then it has to be 36 months. This I am just going to skip. Yeah, okay. This is a very interesting item, and it's going to be a very debatable. If my net worth of the undertaking is negative, in the first one, should I consider it nil, which is capital gains should be 100 rupees, or I have to consider the nil because it's an arithmetic formula and come to 300 as a capital gains for offering to tax? Any view? Have you understood the questions first? So what is your view? Nil. The first one. Anyone? Okay, who all offer the nil? Because the first one, that you have to consider negative consideration nil. Okay. And who on the other side feels that? Okay. Which means that 80% of them are sleeping. I'll ask my question again. Who is in for the yes or the no? The first one. Who believes the first is the better view? Who believes the second is the better view? Okay. The view again is decided by the courts. There are two case laws which say the first and the second. In my opinion, and a view that we have taken the second one as the better view, and I'll come to the reasons why. Arithmetically, I will leave that to be the case. But if you think from business perspective, haven't you paid 100 rupees for the business and also assumed a liability of 200? So if you are the seller and I am the buyer, आपको 100 rupees I have given you for the undertaking, and I'll also taken 200 rupees liability off your books, right? Off your books. Now I tell you, really what is the consideration you got? 300. The second view is that arithmetically I can never pay a negative consideration. Then you go for that end. But if you, therefore, I'm not going in arithmetic, I'm not going in anything, I'm just going by logic. You are absolved of 200 rupees worth of liability, plus you get 100 rupees. 300 is the better view. So we've got case laws on both the side. Zuari is the first view and Smith's is the second view. I also want to take, quickly, everyone knows what dividend is, buyback is, capital reduction is. I'm not taking it. I just want to take it to the buyback, and I've got a good case study here. If you know that 1st April 2026 onwards, buyback has come back as a capital gains. This is one section. This feels to be the most stepmotherly treatment given to this section. Is that every 10 years or 5 years a section comes and they change the tax treatment. When I started my articleship, it was capital gains. Then it became tax payable by the company. Then it became dividend. Now it's come back as capital gains. So it's a full circle which is completed. It is a true case of 3 left turns. And actually there are 3 left turns only in this because she took 3 left turns to come back to the same position. But then what they've done is that they've played with the rates, and they've got the rates so high that it comes at par as the dividend tax rate. So what I've done here is I've tried to categorize my investor profile. And this is something, this becomes my handbook for this group here. This is the handbook when I will go and talk to my client. In a scenario that I'm going to talk to a resident promoter, which is the 4th one here, the tax rate is the same, 35% on the capital gains and 35% of the dividend. But still I will say that you should go for the buyback regime, because at least I get my cost benefit. Correct? In a similar scenario, I will go to my foreign corporate promoter. There I will go that you will get treaty, used to get treaty on dividend, 5 to 15%. Now you go from treaty to go to a capital gain scenario, and therefore my dividend regime is better. So don't do a buyback, you keep on giving dividend. This is the child's handbook basically for when we go to our client for discussing. And this again, impact on the ETR, there is an impact. The large point here is that you don't have to go as a manual for taking tax implications. You have to say that what I need to come and discuss with you, the impact on the ETR, which will actually impact your IRR for a fund manager. That's the discussion, because these 2-3 basis points also actually are an item which actually changes the IRR of the fund. I will come to a repatriation of a cash, which is a case study. Very simple. If I do a buyback of a shareholding of the shares which were acquired prior to 2017, I get 0 tax. Not even, my earlier this one was foreign corporate shareholder was going to 32%. I get it at 0. Any reason why? Because it is a capital gains. And under capital gains you will test the treaty, and then you come back to 4A, 4B, and then you come back to taking a full exemption on the entire capital gains. This is a manner where if you work on clients which are Singapore shareholders, you should look out for these 2017 shares and give this idea. Effectively what happens is, if this is the wholly owned subsidiary, the old shares can be used and harvested out in this manner. What is this subject to? There is a very big caveat to this case study. Any idea? What is the case study caveat? Any idea? I mean, after someone, for example, you are the client, some person came और बोला ये कर लेते, आप okay बोलोगे कि any question you'll ask? What's the case study? What's the issue here? There's something missing. Okay. So, which is on the similar lines. For availing treaty, it cannot be a treaty abuse. You have to prove substance. Substance analysis is missing in this. आपका substance क्या है? ऊपर कुछ भी नहीं है. What is the rationale? Why suddenly you want to do buyback? The choice, no one can question. That we are very clear of. But we need to ask the question to avail whether the Singapore Holdco is a Khoka entity, Dabba entity, or it is an entity which has actually a head and the brain in Singapore. Which then I will come to our Tiger Global. This is exactly how Tiger Global was done, right? They wanted to harvest by way of taking treaty exemption. Now, since I've got only 4 minutes left and they've put a very big screen for showing me the timer here, so I will take it very quickly. The country has been actually at war, and we are not at war with our unfriendly neighbors. We are actually at war against the people who are actually abusing tax. Suddenly, it started from 1985 when you actually started saying, in a Tiger Global scenario, tax planning within the four corners of law is a legitimate tool. To 2026, where we've taken the full circle and come back by introduction of retrospective Vodafone issue, Singapore and Cyprus Treaty getting amended for 2017, your GAR and your MLI actually coming into force, and now the Tiger Global. It's the last nail in the coffin. Now when I go to my clients, I'm talking more about substance than about tax. The reason is because there is a new case law which is there by the Supreme Court, which says Tiger Global was simple. It was a transfer of an Indian entity, Indian entity held by Singapore, and the shares was transferred. They used treaty. The only thing that they were testing throughout the case law is where the head and the brain was sitting. Now look at this scenario. The High Court actually ruled in favor. And my ex-boss used to always say that if there were a court above Supreme Court, half of the case laws would again become favorable. This is what has happened. Supreme Court has gone ahead and actually flipped this. And now the situation is very simple. If there is substance in Singapore and you need to look at the head and the brain of the entity, is where you will look at a substance. And then they've gone ahead, TRC is required but not sufficient. GAR are there in place, so you can't do a substance abuse. Then there is indirect transfer taxes. Is it indirect transfer that 4A, 4B, 5 exemption is for genuine cases, for abuse cases? What are the judicial backing on who has a right to tax? This was an India deal actually. And when there is a case of dual non-taxation, because in Singapore there is no capital gains, here there is no capital gains, you are actually abusing the system, and then the entire money is actually going tax-free. So prima facie is a tax avoidance, which means it's a very beautiful hope for all of us in this room. If our clients have a good backing, if our clients have a good substance, good commercial rationale, still the harvesting of pre-2017 is possible. Where my clients in this Tiger Global, the fund managers were sitting in the US, there they said that the head and the brain never ever were established in Singapore. How can you claim that this is a Singapore resident only for the purpose of treaty? So if my clients' efforts are such that they've got an up and running good team sitting outside of Singapore, there is a very clear scenario where I will get a chance to claim the exemption. So now, instead of saying the Tiger Global aane se pura khatam ho gaya, I'm saying I've got another streamline of work where I will try to build in some more substance to get the tax exemption. There are potential impacts. I've tried to list it down. My biggest impact, in this is going to be that now someone needs to take a very, very clear capital gains position, whether you'll get. And you are going, and how many of you all have heard of tax insurance in this? Tax insurance? How many of you all have done the tax insurance? You've done it with me actually, so please raise your hand. So we got one. Extensively there is a tax, we got two, we've got tax insurance also available in the market. Basically what it happens is, to give a very simplistic item, it's a very good trend. There are many tax insurers going by the name of Vale or Devonshire, etc. 15 or 14% is the tax rate. They will insure yourself, based on the facts, etc. Your exposure for 4 to 5% of the entire consideration, which is at the end of the day you still have a coverage or a opportunity to make the 10% gains. Basically 15 is the tax saving, 4 or 5 is the cost of insurance, and then balance delta becomes part of your. Sorry?
You are doing insurance, 4%.
Huh.
My tax liability is 14%.
Right.
So at the time of the hearing, will you come to my assess? I will advocate your case, and I will get you a favorable order.
Correct. So, sir, it is not as loose as this. I'll tell you why. Because they are putting 4%, they are covering you for 15. They want to tie you in. The tax insurance NBI, which is non-binding indicative term sheet also, and then the final insurance is a very fat document where they say that every submission that you do to the tax department should be vetted by me, because I am ultimately covering you for the entire thing. Yeah. The litigation cannot be a simplicity because मेरे पास तो insurance है मैं जाके बोलूँगा हाँ tax कर दो. No, you have to put your best foot forward, and then you will get the claim. If there is lethargy on your part, you will never get the claim. So you have to fight tooth and nail from a fact perspective to win the case. If you don't win it, then I will give you the insurance. That's the tax insurance. Deal specific, transaction specific. In fact, in a deal scenario, because we're not discussing other portions, in a diligence you can also have a WNI insurance, which is warranties and indemnity insurance, which we've also done, and it's very much prevalent in the market where they actually open, and there on the stand it's a CA who's done the diligence. आपने क्या क्या देखा diligence में? एक एक चीज़ बताओ हमको. That's how it's actually done. Disclosure letter, in fact, I have, as the firm that I represent, we had to actually submit our IRLs, which is the information request list, what was the ask on my diligence, what were my procedures of the diligence, and what was the reply, and then what call I've taken and how I've taken. So that's the, and for example, if I mentioned that my materiality was say $2 million, no coverage for below 2 million. So that's the kind of an item that they look at.
That becomes a deal breaker also, because then your basket definitely is directly affected by how much they are ready to cover.
Correct. And with this, I come to the end of my presentation. Are there any questions that you might want to ask? Maybe you will get the content later. But for now, if there are any questions. Yeah, I can put it in place.
So I want to have your view. Going back to the disjoint demerger, the ruling that has come out, it could be subjective, but I just want your view on the pragmatic approach that had it been, now that if we go for such a disjoint demerger, if we have a good representation, can we get a favorable turning point back? Because there are so many structures which are actually based on such kind of disjoint demerger. Even in the normal demergers where the shares are not issued directly to the demerged company but to the shareholders of demerged company.
No, that's a different scenario. So there are two things. The case law has come on who can issue shares, which is the holdco of the resultant co. And to whom the shares can go, that we are clear. It has to go to the shareholder. In that case, see, Thomas Cook is not a small entity. They have the best people there on the board. The ITAT has taken a very simple literal reading of the case. What it says, demerged company wala demerged company. Resultant company means resultant company. They have not gone ahead and read in between the line that the resultant company includes the holding company. They have given it in the law. And then they have gone ahead and say that the reason why demerger was to do this, which I think so on a personal, and this is not an opinion, on a personal note, this does not seem to be the correct law. And therefore the industry, because it has come 3 or 4 days back, 5 days back, and therefore the industry is of the view that it will get litigated. Sure.
Don't blame me, because they are not the best tax experts like you. They are the one among the humans.
No. Appreciate a point, sir. I'm sure that people who are representing the case, it's a very large number.
Sir, prosecutors, department representatives, they should say, no, sir, please read this also. Don't read, then this is going to be disaster. Sir, ek baat suniye aap. When Supreme Court government petitions are challenged by the government. Some government petitions which are challenged, 10,000 crore is the stake. The Venkatraman goes and tells the Supreme Court, sir, if this is not decided in favor of government, the government will lose 10,000 crore. It is already decided before heard, before even decision. Submissions are made, facts are made. It is already decided because 10,000 crore will government will lose. This is how it is.
Correct. And to answer your question, there have been a lot of other structures. Tata Coffee did it, Motilal Oswal. So we believe that there is a strong case. As we want. It will impact. Till now we had precedents on the structure but no litigation. And this is a litigation. It's come 5 days back actually.
Yeah, just wanted to know, by your experience, have you come across a case of amalgamation and demerger together, and whether there are complexities doing both
together in the composite scheme?
Yeah.
So I had the opportunity, and I cannot name it, but I had the opportunity of working on the largest amalgamation demerger composite scheme for a RE major. Okay, in real estate what we had to do, there were two brothers owning 10-15 companies. The idea was that both of them get their part of the company, and it was the shareholding was very cross shareholding, and this is the experience that has not been picked up for case till now. What we had done was that the merger happens on 1st April 2026, all companies, and then the demerger under the same scheme for the effective date of the demerger, the appointed date of the demerger is going to be 1st October, 6 months later to the merger. I could have done it simpliciter, the merger and the demerger on 1st April, and it can be done in the composite scheme, and there are so many of them. But in this case, we had gone ahead in the practical point of view, done it 1st October for the demerger. The reason why? Any thought on the reason why?
To comply with amalgamation provision first.
No.
And demerger. Okay.
So for demerger, then undertaking needs to be there. 1st April कोई merge होके 1st April कोई नहीं होता. Income tax does not even consider morning and evening. There is no concept of morning and evening in income tax. Previous year is 31st March. There is no morning, there is no evening. And therefore, wo jo close of business hours is a Companies Act style of writing. Therefore, we had to keep it for 6 months to show that 6 months that undertaking existed. And only if it existed can I do a demerger. So that is how we actually structured this. You do a composite.
Saying you file simultaneously both. Effective date is simple.
I'll tell you why.
One is
I'll tell you why. Demerger. No, you can do so. For people like who are risk averse, they wouldn't want to do it. They would say कि एक merger हो जान दो, 6 महीने बाद demerger हो जान दो, two different scheme कर सकते हो. If you heard, I did it for an RE major. What is the RE point of view? What's the biggest point in a merger of an RE? Does this room know? So if the composite scheme of merger and demerger comes through one order, my stamp duty at cap is 25 crore at that point, now at 50 crore. Now if I do it in your manner, and the stamp duty cap will get different. So it's double for two things. That is the reason why that merger and demerger happened under a one structure scheme.
my query was not that. My query was I filed today. So I filed one scheme which is merger, retrospective, effective date is 1st April, and I filed right now another which is prospective.
Which is?
1st October.
Doesn't matter, that's what we've done.
There are two different schemes.
Doesn't matter.
That
It can be done two separate also, and it can be done composite also. Composite was done in that scenario to save stamp duty.
Save stamp duty.
Because see, you understand one thing, we are tax professionals, stamp duty law is now out of CA final only. I got to know that very recently. But when we did our CA, we were taught everything, and we had to think on the stamp duty also. It's a cause that needs to be actually factored in.
But now the law is clear. In a merger or demerger, only the land, if it is going out, is subjected to stamp duty, or no?
No. So, like in Maharashtra, there is 10, 0.7. There's a computation matrix, right? It has to be followed like that. If it's a land, then the land valuation also plays a role.
So you have to pay stamp duty on land.
Yeah.
Right? What about other assets? Like if you transfer shares, listed shares, unlisted shares.
Everything,
in the
because the
scheme of
computation
merger.
so computation is 10%, 0.7, and then the land cost. So it's a matrix higher of the two and subject to minimum of.
And what happens, so this is actually on stamp duty, what happens if the registered office are in, I think this has also been a subject of litigation in some other state, the registered offices in some other states of both the companies, but land is in Maharashtra.
You have to pay.
You have to pay.
In fact, you've got two different registered offices. In the case of the biggest company of the country, Reliance, you have to pay duty on both states.
So they paid both in Maharashtra.
Yeah, Gujarat and Maharashtra.
Right? So, but that is settled. I think that was contested in one litigation
Settled.
from West Bengal.
It's settled now.
Accepted.
No, there is no credit.
There's no credit.
No credit, because exactly in that case, the court has passed the order saying very clearly, stamp duty is payable on the instrument, and the instrument is the merger order from Gujarat and the merger order from Maharashtra. These are two instruments. There's not one instrument.
Okay,
There is no set of available.
I'm sorry, my question is more where in one demerger order, the properties are situated in, let's say, 3 states, and maximum value is in Maharashtra, let's say.
Again, it is separate, because this is a more practical approach, because the merger order, for example, your property, two Maharashtra companies are getting merged and the property is in Gujarat. Correct? So you have to get the conveyance done for the Gujarat entity also.
Yeah, so let's say the property
There you have
is
to
in
pay
Maharashtra, Gujarat and Tamil Nadu, and let's say I pay 50 crore in Maharashtra, will I get that credit or that capping in
There is no
Gujarat?
concept of
There's
credit.
no
No, no,
concept. Even credit is not
no,
available.
no, no.
So for all individual asset, I need to go and pay the stamp duty, huh? Second question, can you, this 47(4) exemption, relate, I mean, subsidiary holdings, relationship, can you breach by choice and can you breach by choice?
Yes, our country, so you can break the law by choice and they'll give you notice. So you can breach it. You can breach it. There's no problem. As so long as you pay tax. So if your question is you breach it and not pay tax, is there a situation? No. You can breach and pay tax. I mean, they are more than happy.
Yeah, because see what happens typically when the receiving company wants to take the tax deduction, they can only avail the incremental tax deduction upon breach, right?
So, see, so long as you pay tax, no problem.
And to add on to your composite scheme question, I agree with Mr. Yashvardhan. In one of our composite schemes, we had to wait for 5 months. We had an investment and manufacturing division. We had to split the manufacturing division, but then investment remains and my NBFC triggers. So we had to develop a trading business, show it. We had to wait for 5 months because we had the 31st March balance sheet, so that we can show that business in that balance sheet and then go for the composite scheme to establish that there was an undertaking and majorly into trading.
I hope there are no officers in this room. Exactly. I hope there are no officers in this room.
No, but that was genuine, because that was genuine. They wanted to develop trading. No, that was genuine.
Ma'am, I must tell you, this is a recorded session.
No, I believe that you
Many,
must have structured
many
it
of
well.
these, it's very predominant in RE assets. So we are very well aware of how to monetize RE assets. That's how people are doing it. Right. Correct. No, these are considerations. So I'm not. So first of all, if tax is driving the restructuring, if the tax is making a big sense, then the client would actually do. And obviously it doesn't come, it's not a no strings attached scenario. There are certain items that needs to be actually factored in, which includes your ERA compliance, including a litigations, how they will come on to the other new asset, etc. So that we are, obviously. and licenses, etc.
Yeah, last one. Like, sorry.
I'm sorry. You demerged. You can. I mean, there's no restriction in law. No, actually, so can they come? Anyone can come. That's not the question. Is it a defendable position? Okay. If you read the law and if you read the order, it's a statutory vesting scenario, right? Mera jo bhi tha, whatever litigation, assets, liability, everything is gone in that entity. So particularly when the order is passed by an NCLT, it blesses it. It says, yeah, the demerger is there. So if someone comes and still does a frivolous claim, you can't help the frivolous claim, but it's a defendable position. Yes, it is. Yeah.
Yeah. Just one last question. Like, there are many companies who's having registered office at Daman or Silvassa.
Right.
But for Daman, ROC becomes like Gujarat, and for Silvassa it's Ahmedabad.
Yeah.
So over there also they are subject to double stamp duty. Is it correct?
I wouldn't. I will have to check that.
Okay.
CA Yashvardhan, Gupta, thank you for a wonderful session on tax on M&A. I think that applause says it all, and plus this was the most interactive session we have had so far amongst the three. So I will take a 15-minute tea break. Let us assemble at 4 o'clock sharp. Our panelists are waiting.
Here, I request my chairman to escort the speaker and the moderator to the dais. So without wasting further time, I start the session with I request my chairman to have his opening remark. Thank you.
Good afternoon, one and all. On this rainy day, also we have wonderful discussion at WRC on conference on merger acquisition and business structuring and restructuring. And today I am very happy that we have power pack panelists with us in terms of CA Ketan Dalal sir, CA Sanjay sir, Shri Girish Vanvari ji, and it will be moderated by Anand Bathiya ji. So friends, it is one of the exciting area where we generally have very good participation from our CA friends. And it is really a need of the hour when we are aiming towards something big as our country and economy. Then the role of merger acquisition and structuring and restructuring is very, very important. Earlier, it was majorly focused on the larger companies, but now as a strategy, there are other companies also which is looking upon for the restructuring, or you can say business structuring, and which is really need of the hour in the era where we are having so many companies for the listing part. And today, I believe that you had a wonderful sessions. We have completed 3 sessions, and now we are moving towards practical discussion under Ind AS 110 consolidation. I can assure you that you will have a wonderful knowledge sharing in this session also. Friends, this year at WRC, we are targeting to have more and more programs, which is really very, very important to understand. And I can say that in last 129 days of this tenure, we have already completed more than 120 programs. And in terms of knowledge sharing, effective delivery, and we are innovating all our program, because innovation is the need which we have to understand. And this program is also very, very important in terms of understanding the innovation, because again a different area where very few chartered accountants are working as a strategic partner. So again a great opportunity for all of us to explore. And believe me friends, this year we have done knowledge sharing on family offices, we have done knowledge sharing on AIF, GCCs, and then CXO Roundtable were again a signature program which we hosted at Geo Convention Center at a larger landscape. And recently we have completed our Scale Up India Summit with the participation of more than 1,000 members, where we are targeting to have more and more participation from MSMEs. So it is really a great year in terms of having contribution for knowledge sharing and impact which we are targeting, and we are focusing on more innovation, and that we are trying our best that we should have more and more workshop, hands-on experience. In this series recently we have done a program on business modeling and valuation with only 50 members, because we want to give a hands-on experience rather than having knowledge sharing in terms of theoretical base. And that is why we are aiming again for a wonderful program as a strategic skill set for modern CAs, which is again very, very important to understand. On 11th July, we are hosting this program at the same premises, where only 50 members are invited. I request Mishra ji to place the program details on the screen. And then, well in advance this year, as earlier year, we were receiving some feedback that our regional conference was launched at a last time or like that. So this time, 7 months before, we have given an opportunity to all our members to register for the regional conference and plan their schedule accordingly. On 4th and 5th December, we are hosting our regional conference, that is the Divya Drashti, where we are going to have more than 100 speakers. We are targeting for 2,500 members, and wonderful exhibition also we are planning in our regional conference. Friends, at WRC, we believe that 3 I's is very, very important. One is already highlighted, that is innovation. And another I is investment for future. So my request would be to each and every members, whatever currently you are doing, please keep in mind that where you want to be in next 5 years and invest for that. Because in general, we are occupied with so many stuff, and we are not thinking about the futuristic area which is going to be very, very important for our profession. In current scenario, when we have an economic size of around $4 trillion economy, and our country is aiming for $35 trillion economy size by 2047, then the role of chartered accountant is also very changing rapidly, I can say, because in the current scenario, the way number of IPO is rising, the way number of AIF is also rising, we have to understand our role in a different way. And I personally believe the kind of opportunity which we have in income tax, GST and audit, similar kind of opportunities are available in financial market, which is still pending to explore by the chartered accountant. So my request would be to take participation in all the knowledge sharing programs which we are targeting for such areas where we can have a wonderful working. And friends, again a very important program which I want to highlight, which is we are hosting on tomorrow only, master class on GST, in which we have invited CA Bimal Jain sir, CA Jatin Harjai, and there are advocate Dr. CA Avinash Poddar, CA Sunil Gabawala, CA Sonia Arora. All are going to discuss about the recent development in GST, which is again very, very important in terms of JSTART, the appellate tribunal which came into picture. And one more program which we are hosting on internal audit, that is on 10th and 11th July in the same premises where we are sitting. This is the National Conference on Reimagining Internal Audit. Women Residential Repressor course is also organized by WRC on 17 to 19 July. And then this is wonderful course which I want to highlight amongst all of you, that GST Art. It is 3 days certification course which we are doing under the committee of Central, and it is really a very good course in terms of having all about the understanding of representation in appellate tribunal or before that. Then, as I highlighted, that beyond numbers, strategic skills for modern CAs is really important for all of us. That this type of program in general we are seeing in the corporate, but at WRC this year we are targeting to provide some intuitive experience, and that is why we are hosting this program where we can understand how we can solve our decision biases, how we can be effective in terms of marketing. My request to each and every member, please have a look on that. And this is the Divya Drashti. This is our 40th regional conference. Well in advance we have announced where we are going to discuss about Vidya, vision and values. Friends, we have come out with the digital initiatives also. WRC Connect is the app from which you can get all the details on real-time basis. In general, we have a website only, but this year we have renovated WRC Connect app also, and through which you can get all the important details which is required to the members for having programs, for having knowledge sharing opportunity. Friends, at last I want to say 2 lines to each one of you when we are discussing about such a important topics, that you जमी पे बैठ के क्यों आसमां देखना है, you जमी पे बैठ के क्यों आसमां देखना है, पंखों को खोल दो यारो, जमाना सिर्फ उड़ान देखता है, जमाना सिर्फ उड़ान देखता है. And fly in your career with the help of WRC and ICI, which is our alma mater. So looking forward for your effective participation. Thank you so much.
Thank you, Chairman. I just request my council colleague, Piyush Chandak, to introduce the panelists as well as the moderator for the session.
So in this last session, I know that you have enjoyed the 3 sessions in the day, and the last session we have very experienced and veterans in the field, starting with Mr. Ketan Dalal, a veteran tax and transaction structuring expert with over 40 years of experience, and specializing in mergers and acquisitions, restructuring and family settlements, a former managing partner and joint head tax at PwC India. He currently leads Catalyst Advisors LLP. He has served on several key Securities and Exchange Board of India, SEBI, and government committees, and is widely recognized among the India's leading tax advisors for his deep expertise in international and corporate taxation. So please welcome with round of applause, Ketan Dalal sir. Then we have CA Sanjay Asher. He is a solicitor and chartered accountant with over 3 decades of expertise in mergers and acquisitions, cross-border transactions, joint ventures and capital markets. He has served on key committees constituted by SEBI and the Government of India, contributing to policy and regulatory reforms. A distinguished speaker and author, he regularly addresses leading professional forums and has authored book on the Companies Act 2013. Great. Then we have CA Girish Vanvari ji. He is the founder of Transaction Square and a seasoned chartered accountant with over 30 years of experience in taxation, corporate finance, M&A, valuations, restructuring and governance. Prior to founding Transaction Square, he spent nearly 14 years as a national tax head at KPMG, India, where he led complex domestic and cross-border transactions. He has also served as an independent director on the boards of several leading companies, bringing deep expertise in financial oversight, governance and strategic decision making. Please welcome CA Girish Vanvari ji. And to take out maximum possible for the benefit of all the participants, we have CA Anand Bathiya ji as a moderator, a distinguished chartered accountant, company secretary and legal professional with over 20 years of experience in corporate finance, taxation, transaction restructuring, and strategic advisory. He has advised on 350 plus merger acquisitions and capital market transactions with an aggregate value exceeding USD 40 billion, making him a highly respected expert in complex deal structuring. He is also recognized for his contributions to corporate governance, fundraising, restructuring, and broad level advisory across diverse industries. So please welcome CA Anand Bathiya ji also. So I'll request Chairman WIRC and Treasurer WIRC to felicitate all the speakers and moderators with the memento as a token of appreciation on behalf of WIRC. So starting with so dear participants, you must have appreciated that while I was reading the profiles of every speaker, the total count of experience is 40 plus 30 plus 30, that is 100. And that is to be dealt with the guy who is sitting next to you as a moderator. So sir, your job is, I think, tough as well as great. So the dais is all yours now.
Thank you, Piyush ji. Good evening, friends. Good evening. Good evening. Wonderful. Thank you, Saurabh ji. Thank you, Rakesh ji. Compliments to the team to organize such a wonderful one-day event on M&A. Compliments to all of you all for being here on a Saturday, a rainy Saturday, not choosing to merge with the Lonavala traffic, but choosing to merge with us on this panel discussion. As you would have seen from the introductions, my job is almost done, right? You have the assortment of speakers, the who's who of the transaction world, and my job is to just pin them so that we can extract maximum out of them. What we'll do is we'll keep it completely lively. In this entire panel, we'll not talk about sections, about acts, about rules and regulations, because in the first 3 sessions, we have spoken a lot about the how aspects of M&A, be it accounting, be it tax, be it IBC. But as chartered accountants, we just don't want to be on the how aspects, but also want to understand the why aspects and perhaps the whether aspects. That should we do an M&A? Why should we do an M&A? Should we restructure? Why should we restructure? And then the how can always follow. And with that objective, today's panel, we are going to talk about the why aspects. The session topic is also very clear: value creation through M&A, synergies and cost efficiencies through M&A and restructuring. That's what we are going to talk about. Now, fundamentally, if one sees about merger and acquisitions, we need to understand from a 40,000 feet that why is it even in existence? Fortunately or unfortunately, in today's day and age, growth is something that commands a premium, and businesses strive for growth. Beyond a point, organic growth can have its limitations. And can you look at inorganic avenues to grow your business? That is something at a very, very 40,000 feet, enabling growth through inorganic acquisitions. But a strategy of M&A is not always successful. In fact, statistics suggest that only 30 to 40% of M&As are actually successful or actually command the same outcome that you had set out to achieve. As chartered accountants, we would feel very happy seeing that percentage of 30 to 40%, whereas in our pass percentage in our examination is significantly lesser. But just like you don't leave CA because the pass percentage is low, similarly you don't leave doing M&A just because the success rate is low. So it comes with its own perils, but if you can do it right, there is significant value creation. And we'll talk about those lenses from people over here. Not just our dressing is different, we also have a diverse panel of practicing lawyers, transaction advisors, senior board advisors. Most of us sit on board committees as well. And getting that perspective is very important. Let me first start, Ketan bhai, with you. There is a connotation that most of the deals are generally not successful. It could be either got to do with overpaying the price, or it could got to do with the process and the diligence not done well, or it could be with the integration gone wrong. In your experience, having worked with hundreds of M&A transactions, tell us about your high-level insights on M&A and how should practitioners go about as a value creation tool, and what are the risks associated with that?
So first of all, I think this session is very, very interesting because, the point is that we as chartered accountants normally tend to look at, the regulatory aspects, the tax aspects, but Anand, as you mentioned, the why. Because every M&A transaction, now whether it's an acquisition, whether it's a merger or a demerger, the underlying rationale is always commercial, right? It cannot be anything else. So it could be, developing scale, getting a distribution channel, getting backward integration, forward integration. So I think there are 2 or 3 aspects to this. First of all, you mentioned that you don't stop doing CA just because the pass percentage is lower, and I wanted to add that nowadays with the younger generation, probably 50 or 60% of marriages fail, but I don't think it is deterring people from getting married also, right? So I think M&A is like that, right? So you will do M&A regardless of this, but on a more serious note, Anand, I think the key issues are the rationale, obviously the valuation, and most importantly, the cultural fit. See, what happens many times, the cultural fit becomes a massive issue. So I'll give you an international example, which I'm very fond of sharing. Daimler Chrysler. Daimler is, as you know, the manufacturers of Mercedes. So Daimler is German, Chrysler was American, and I think which year, I forgot which year, 1998. This is a 18-year-old story. So Daimler acquired Chrysler in 1998. Now Chrysler was relatively a mass market car. Daimler was, a luxury car, right? And the marriage didn't go well because the Germans said, look, sort of started looking down on their American counterparts, and many things went wrong. And that was a disaster of an acquisition, and ultimately Daimler sold Chrysler about 8-10 years ago. It was a massive destruction in value. Similarly, Microsoft acquired that handset business of Nokia, and that didn't go well. But that doesn't mean everything doesn't go well, So for example, I think 21st Century Fox acquired one of the Disney businesses, It was a great success. So Microsoft, LinkedIn, which youngsters, most of the people in this room are very young. And of course, I know you're more on Instagram than on LinkedIn, but it has been a great acquisition for Microsoft. So I think, to your point, Anand, cultural fit, obviously pricing, and getting the right thing, the key issues right at the beginning. So for example, in one of the acquisitions, I think it was a Vodafone Idea merger, the branding became a massive problem. It took 2 years for the branding to come together. People are totally confused. I'm Vodafone customer, I'm Idea customer. What also happened was billing integration, IT integration, all that didn't happen. So, these softer dimensions of a merger or an acquisition, such as the cultural fit, the human relations aspect, in a merger, 2 CFOs will become 1, 2 company secretaries will become 1, 2 controllers will become 1, presumably. So while, the NCLT is doing what it's doing in a case of a merger, or the lawyers are doing what they are doing in the case of a transaction, one of the CFOs is wondering whether I'll have a job, and his heart is not in it. So the longer the transition, the more the mess. So I think, I know it's a long answer to a short question, Anand, but I think these are some of the issues.
Interesting, Ketan bhai. You can clap. Sanjay bhai, you have on the board position on many companies as independent directors as well. Now management will come to you with a transaction proposal. Management might have their own interest, ability into it. Investment bankers will come and present to you. They have their skin in the game and slightly conflict sometimes. But at the board level, when you know that there are these perils in doing an inorganic acquisition, and you still see value creation at the end of the day, what goes in your mind in terms of balancing the risk versus value creation potential?
Look, risk is always there. Risk is always there. And every company, whether it is small, medium or large, and let's first look at the small company, the aspiration is always to become medium and from medium to big. And therefore, while forming the strategy, the board is in charge of forming the strategy and not get into the operational details, which is why the management is there for the purpose of operational details. So the board's role is to play an important role in what is the strategy, what is the vision of the company 3 years, 5 years, 10 years down the line. So board looks at it from short-term, medium-term and long-term perspective. And obviously the long-term perspective would be to grow. Even the medium-term perspective would be to grow. And so therefore, to answer your question, that yes, in any acquisition, risk is there. One has to tackle the risk. Without risk, there is no fun. Without risk, there is no growth. Without risk, there is no business. There is no money. And so therefore, always, whether it is a large entity or a medium-sized entity or a small entity, listed or unlisted, it's always growth, growth and growth. And therefore, now apart from growth, there is also the competition. If I don't grow, if I am not of a critical size, if I don't have volumes, I will then have to get eliminated. And therefore, from a board's perspective, it is always, yes, whether to set up a greenfield project or to acquire something which is a fit within, as Ketan bhai said, the cultural fit, the operational fit, the human resources fit and all of that. Now that is getting into the details aspect of it. But that surely the management, while evaluating several options which they have, whether to acquire A, B or C, you have several alternatives which are there for acquisition, and then you see as to how the fit is, whether they will fit within what our culture is, whatever our vision is, whatever our ethics model is, etc. So the answer is that yes, the board always looks at growth and acquisition through the brownfield projects, irrespective of any risk involved. The risk has to be resolved. Yeah. The risk has to be mitigated. The risk has to be answered in some or the other manner.
Yeah, so the board would want to understand mitigation plan B to make sure that the risks are covered. But I think the point that we are trying to drive home is that M&As come with an inherent risk. And the idea is to not be scared by that, but to mitigate it to the extent possible. Girish, I think you are in a very unique position, not just having worked with hundreds of M&As, but also working closely with family-owned businesses. And first generation, second generation, founder-oriented businesses. The general sense is that professional managed companies are fairly acquisitive. Like Ketan bhai was telling an example of some European company, or even if you take an example of Meta or Facebook, today Instagram and WhatsApp, which have been acquired, are far more larger than maybe what Facebook is contributing. And that strategy has worked beautifully well. In the context of M&As, your guidance, and also from the lens of family versus professional management, how do you see the risk and the value creation balancing out?
I think the names you mentioned are actually family-owned businesses. So if you look at SpaceX, if you look at the names you mentioned, Facebook, these are all promoter-driven businesses. What I find in a boardroom is a professional-run company will find it difficult to make acquisitions than a family-owned business. Because family-owned business will take a risk. The one guy will say, let's go beyond diligence reports or legal due diligence report. Let's don't worry about indemnities, warranties. I believe it's good. My hunch says it's nice. Let's go for it. So if you see Indian examples also, the way Adani, JSW or Reliance have gone about it, the maximum acquisitions have been done by family-owned businesses. So I think over-analysis is sometimes deterrent to the whole hypothesis of M&A being successful. I want to talk about value, what we spoke about. Do M&A add value? Mother Road statement, no? Very, very Mother Road statement. What is value? What is value? No. Value is after the announcement is made, stock market upar gaya ki niche aa gaya. What is value? What is value? Take an example. When Tata Steel acquired Chorus, Tata Steel price went down by 20% that year. When Tata Motors acquired Jaguar, the price went down by 15-20% that year. And they are very successful acquisitions today. And today also that, you saw Persistent Novaro. I just saw that the day the acquisition was done, 12% it went down. So how are we judging everything? Share price.
What we perceive that after the acquisition, what will be the rate?
The promoter thinks it's good for the long run. The market, investors see how the value is reacting on the stock market. So what is value? What is value? So the point which I grapple with is that as we look at as chartered accountants, value is how does that acquisition impact the earnings of the company? And how does the acquisition impact the earnings of that company in the next 3 to 4 years? Immediate and the next 3-4 years. So whether the acquisition will lead to intangibles, whether it will lead to brands, hit to the P&L, interest hit to the P&L, and really how will the EPS be impacted or not impacted. I'll give you some good examples. Take how Torrent has gone about acquiring, Torrent Pharma, JB Chemicals. With every acquisition, the market cap is going up. Because whatever they are doing is value accretive to the EPS. So according to me, all of us in this room, Mother Road statements are value, integration, these are all Mother Road statements. But really, in hardcore numbers, will that lead to accretion in the EPS in the near term, in the medium term, in the long run? We all dead, then it becomes like a Tata Chorus, Tata Motors. We all waiting, the stock will go down. So value is in relation to the impact on the EPS, and where the companies are communicating the right impact on the EPS, like a Torrent Pharma or a JB Chemicals, Torrent Pharma. There's so many Croatia, Torrent Pharma, Sun Pharma acquisitions where they actually tell that this is how the value EPS will go up in tangible numbers. And Sanjay, that's what you would be going on the board also. Tangibly, how does it impact the EPS, and then wait with the risk.
Very true. And then one has to survive in the market and
Correct.
fight it out. And so therefore
Correct.
acquisition is absolutely must.
Correct. So
if I'm too small,
correct.
then I will get eliminated if I don't. Either I sell off or I allow somebody else to buy me.
Okay, I'll give you examples. Take Interglobe Aviation. Interglobe Aviation only does airlines. They're not going out and acquiring companies. They're just growing. They're adding aircrafts. Take an example of a diversified group like Adani. They are actually getting into everything. Drones, data centers, everything. Acquisition, growth. So nothing is right or wrong. It depends upon how you keep your focus. And how do you convert your acquisitions into accretion in EPSs. I repeat, and with Ind AS, earn-out structures, payment of ESOPs, all that is an impact to the EPS. What we forget to communicate is how will the EPS go up or down. So Anand, impact on EPS and what is value, very important. Very, very important.
Very interesting. And I'll stay with you, Girish, on this point because that's a thread to the next discussion. Is one way to measure these synergies or whether a M&A is successful, value creating or not, is trying to build synergies. That whether 1 + 1 is actually 2 or whether 1 plus 1 is 2.5 or 3. And the difference between 2 and a 2.5 is the synergies. And a lot of companies, while justifying an amendment to the board, would go ahead and quantify synergies. That, hey, look, I feel that my company has profit, this company has losses. Not just I can do that, but also save my own tax. There are some tax synergies there. Or there could be revenue synergies, or there could be cost synergies, or there could be managerial synergies. So Girish, one way to measure, while everything boils down to EPS, EPS is a function of various line items in my P&L. And one would want to quantify revenue synergies, cost synergies, tax synergies. Is it good to go clinically with this? Or is it good to hunch it out and say, hey, I'll go ahead and do this transaction?
Stay with me with a live example. All of we are following REC PFC merger. Yes. Very, very popular. Very much. Everybody has stocks also of REC PFC. Great dividend deal like an FD. Awesome. REC PFC merging to create the best power finance company in the country. In a country where energy is very important, so on and so forth. Lot of motherhood statements, lot of synergies, duplication of cost, all will go away. It will function as one entity. That was the promise on HDFC Bank merger also, by the way. So lot of promises. And today an article has come that by merging we'll not be able to borrow because each lender has a limit for one corporate. First they were giving to both the corporates. Now they have one limit for the merged REC PFC, which is PFC, and they'll not be. So as an investor, I'm confused. One was synergy, one was this is the downside. But I did not see a presentation which actually said this is the benefit tangibly, this is the risk factor, like this lender point. When the merger was announced with the ratio, I would expect that to be communicated. That's why the market is neutral. So value tangibly, not in Hawa, not in motherhood statements, synergies and all, tangibly. And risk tangibly, Sanjay, that these are the 5 areas of risk is where the trick of an M&A success or failure is, and success or failure is how the markets react. Sorry, just tangibly. Tangibly.
How the market perceives.
Correct. Sanjay, isn't it? I don't know.
That is true. So one does a sensitivity analysis and see as to what are the downsides, as you rightly pointed out. So while evaluating, if I merge, if I don't merge, if I acquire, if I don't acquire, if I have 5 different candidates, which one to acquire?
Correct.
And then at that point in time, you evaluate the synergies, the downsides, what is there in the sensitivity analysis, where is there a market overlap, so on and so forth. So yes, and I would say that Lala is the best person to decide, and not the professionals. Lala knows, Lala has the fire in the belly. Sorry, nothing against professionals, but I would say that Lala is the best person because his skin is in the game. His money is on the neck. His name is on the neck. So if the Lala decides, that yes, I want to acquire, maar tod karke, he will see to it that it works.
He will deal with any eventuality and any problem.
Yes, that is how it has to be.
He says any political party or any situation he will deal. Because he has a fire in the belly. He has a fire in the belly and he will deal. He will go in the front and say, okay, come on, what do you want? And then, yes, I will do it.
Ketan bhai, your views on that?
No, I think, sorry Sanjay, some different things on this,
No, I purposely did that in order to arouse some discussion.
No, I think some of it, I agree with both what Girish and you said. Some of it I have somewhat different views. See, today, I'm on the point of this so-called Lala. Today...
Not so-called, the Lalas.
Okay, Lalas.
Yes. The Lalas are Lalas and they don't believe it is Lala.
Okay. No, I have a slightly different view.
I think I should go there and you both sit here.
I have a slightly different view. If you see over a period of the last 10, 15, 20 years, yes, you do have, and I agree completely, Girish, with your point, that family or promoter-driven, I won't say family-owned, but promoter-driven, listed companies also, their ability to be more agile and therefore take those risks is greater. But over a period of time, there are different categories, so you can't generalize it into the Lala kind of thing, but I have some broader points to make on that. So you have to distinguish between a professionally managed company which has no promoters, and the classic examples are HDFC and Larsen and Toubro are classic examples where there is no promoter at all. And there are some 5, 6 others, some smaller ones, but these 2, 3 are the ITC. These are the bigger ones. So that's one part. The second category is those companies which I have got smaller public shareholding, smaller promoter shareholding, and they are also very professionally run. Classic example is Mahindra and Mahindra, where the stake of the Mahindra family is 18%. Not many people realize that. It's only 18%. And it is very professionally run because Anish runs the company, Anand doesn't run the company, okay? So I think in that kind of situation, capital allocation, acquisitions are very professionally done, albeit to some extent it is still promoter driven. That's one point. On the point of synergy, absolutely, Anand, as you mentioned, there could be different kind of synergies. So say in the case of HDFC Bank, there was one reason of what I would call relative disappearance of what we call regulatory arbitrage, and I will explain that in a minute. And the second was synergy, cost, etc. So this regulatory arbitrage was that, HDFC Bank is, of course, a bank. And HDFC was a housing finance company. And over a period of years, the RBI, NHB, later it moved from NHB, National Housing Bank, to RBI as the regulator. More and more tightening of the regulations on housing finance companies, at least of the size of what HDFC was, had reduced what we call regulatory arbitrage. That means if HDFC is a separate company, and it was actually the original parent of HDFC Bank. The point was that the son became 6 feet tall or 9 feet tall, and the father was 6 feet tall, which was HDFC. So what happened is the regulatory arbitrage disappeared. So that was, I'm not sure whether to call it a synergy, but the disappearance of the regulatory arbitrage, I know, was a very important reason for the merger. Point one. Point two, in the synergy part, and the jury is still out whether that merger has worked. I think it will take time. It's a massive merger. When you have a merger of this size, things do not come together immediately. It takes time. It's been 3 years, and I think over a period of time that probably will work out. The borrowing cost, you raised a very correct point, Girish, about PEC, REC. So that may be in that case. But in this particular situation, the ability to have a much greater pool and the synergies in terms of the ability to cross-sell. I think there was a study done that how many borrowers of HDFC are bank account holders of HDFC Bank. Because see, bank account holders of HDFC Bank, very few will be borrowers, but the reverse, could be. So I think that those kind of synergies over a period of time will play out. So there could be cost synergies, there could be synergies out of borrowings, there could be synergies of distribution channels. See, one of the very important things is in the context of FMCG sector, for example. In India, and I can tell you a little bit of a funny story, and I know I'm talking a little longish answer, but I'll tell you. I was dealing with a large MNC, and I think we were passing by Powai, and the global CFO was sitting. He'd come to India only the first time, and the concept that, he had not seen this Panwala Dukan kind of thing, And he said, but how on earth? See, he had seen Walmart. So he's from America. It's an American company. So, he, in his mind, his product should show up on the shelves of Walmart, for example. This Panwala kind, so he said this small shop, and he said, how on earth did my product reach there? I honestly have no answer also, because I'm not a marketing guy. That massive, complex distribution channel of India. So what happens is that in an FMCG, distribution synergy is a massive synergy. Massive. Because if I have 300,000 distributors and the other has 200,000, can you imagine what it is to create another 200,000 distributors? It's a nightmare. Nightmare. It can take you 20 years. In a single stroke, you can get a distribution synergy. I mean, those are the kind of things.
And staying with that, Ketan, you spoke about HDFC Bank merger and some synergies, regulatory cost. But counterintuitively, my mind tells me that sometimes as a business restructuring, people go for demerger. Classic example of Vedanta, where one large listed company split into 4 listed companies. Now, generally you would assume that you would need to have 4 MDs, 4 company secretaries, 4 CFOs, and clearly cost synergies are not visible. So from an EPS perspective, what are the synergies is a question. Perhaps the reason is focused attraction of investors, which are all non-P&L synergies. So why would someone cut a business into 4 and still the stock market appreciates that fact?
Let me just sort of rephrase this thing. I think our obsession with the stock market price, to my mind, is not sort of well focused. To my mind, the share price is a consequence, not the reason for the demerger. See, what happens is, one of the single biggest reasons for a demerger is business focus. So what happens is that, let's say I am dealing with a situation of a chemical and pharma company. So it is in agrochemicals and pharma. Company is not very large. And for years I've been telling them that, look, these 2 in 1 is not a good idea. But one of the reasons is currently the agro is not doing very well and the size is small, and therefore the demerger is not envisaged at this point. But they are slowly coming to the conclusion that they will need to do it because let's say in the agro segment, they are thinking of a partner in the agro. Now, if you have 2 disparate businesses, they're not thinking of share price. If they have 2 disparate businesses with potentially different strategic partners for each, or let's say strategic partner for 1, you cannot have that strategic partner in the same company because it has 2 separate businesses. You need to split that business. Now, whether you drop it down or whether you do a vertical demerger has got different sets of issues, as you're aware. But you need to do it. Now, you may, of course, have to think of share price. For example, what happens is, if the market cap is, say, today 6,000 crores, okay, and you split it up, and just for sake of argument, think it's equal. What will happen is, the mutual funds who are investing in a 6,000 crore company will drop when you become 3,000 crores. So what will happen is, let's say an HDFC mid-cap is investing, it will drop out and only the Bandhan small cap will invest. And institutional interest going down in a company is a problem. But this is of listed companies. For non-listed companies, you can sort of do it for a variety of reasons. But even in listed, you look at the number of examples. Vedanta, of course, is a very, very big example. But look at Siemens Energy, which is also a big example. So what happened was, the energy division of Siemens globally demerged. Now, this is an MNC example. In India also, it demerged about 1.5 years back. And the reason for the demerger was that the need for business focus required on the energy division, which is in power generation and power transmission manufacture, is very different from manufacturing, say, railway coaches, kind of equipment, and some other engineering stuff, which the broader Siemens does. Okay, now look at, for example, Astral has announced a demerger of the chemicals and paints, because people are getting confused that, am I investing in pipes, where am I investing? So when you demerge, the ability to get private equity, strategic, business focus. Also, there is one very important thing which I have found from practical experience. The incentivization of top management is also sometimes a very major reason, because the guy who is running, say, paints, his incentivization in a paint company is different from a conglomerate company, because A, the management will not want to incentivize him because he may not be contributing to that, and B, he may not want it because he may say, my paint company may move faster. I know today it is making a loss, but I would rather hitch my wagon to the sector and the business that I am running, because I am confident it will grow faster, as opposed to relying on somebody who's running another company and I get confused at what is the value of my ESOP. So I think there's a variety of reasons why. So the point I was trying to make, coming back to the point I was trying to make, Anand, is I think this over focus on share price is perhaps misconceived. I think the share price, the value is a consequence of a business decision, not the other way around.
Interesting. And Girish, I'll just come to you that stock market needs to be a lag indicator and not a lead indicator. And lead indicator needs to be the intrinsic benefits, EPS, synergies, etc. But when it comes to internal business restructuring, and some of these demergers, is it more for theatratics, or is it that you actually create P&L EPS value through internal restructurings?
See, I think there are more than one reasons for demergers, and I have not sat across a board meeting. Now I sit on 7 listed boards, wherein we would have looked at a demerger without worrying about what the share price would be. So to say that I will ignore the share price and I'll just create value is a decision which no board will endorse. So clearly both go hand in hand, because if you demerge, like I'll tell you, like I've been following one more demerger, Astra Microwave. They're going to create a space company from the defense company, and space company will get a SpaceX multiple. If SpaceX multiple comes, they will be able to raise money at the SpaceX multiple to do further research on SpaceX. So it's all together, because if I demerge and the value gets created, I'm able to raise more money. If I raise more money, I'm achieving more objectives. So clearly what I'm seeing is that up to the incubation, it's a conglomerate. So like if you see Adani Enterprises, it was incubated, ports was incubated, energy was incubated, and then when the time came appropriate, they was left to run on its own. Same happened with Vedanta. So incubation happens in a bigger company where the finance and all synergies are there, and once they go on their own path with their own business requirements, then they split, creating value, creating share value, and then ultimately growing the company. So I would not really look at any restructuring, dehorse of impact on stock market, because in all discussions on REC PFC, they say, see, look how HDFC went, merger failed, this will also fail. Any article, it starts with that. Because HDFC Bank eventually will be successful, but today the market price for more than one reason is not reflecting that. So from a long-term perspective, great thing, but to the immediate shareholder, it's not created value today. So it depends on which lens you look at it from.
Correct. So I think what Ketan Bhai said and even Girish spoke about is that there could be some synergies which are beyond the P&L as well, like attracting different set of investors.
Absolutely.
Or having management incentivized, are beyond your P&L, or even stock market price for that matter. So one needs to look at the P&L synergies and what a Boston professor says, cap table synergies, which are outside the P&L but impact the cap table and the stock price as well. Sanjay bhai, in internal restructurings, pricing is never a problem because it's your own both sides and you can decide swap ratios, etc. When we are talking about third-party M&A transactions, the success or failure of an M&A will also largely depend on what price you are paying upfront. If for the same asset you are paying 10%, 20% more, chances are that your M&A success will be that much lesser. At a board level, when you are sitting there, how do you bring in the pricing discipline? Because they are in a running process, a bidding process. Tata Chorus started at 8 billion but had to close at 12 billion because of a bidding process. So how do you look at that? Is it that sometimes giving 10% for a good asset is a better bet, or holding tight and not doing that is a better bet from a board perspective?
See, one would look at it from the asset quality. A, is there a synergy? B, should I acquire this particular asset? How is it going to benefit me? So once that decision is taken, that yes, this is a good asset, this is a good paper, I have to somehow acquire it. Now, obviously, I mean, if it is a good asset, if you need that particular asset for the purpose of growth or for the purpose of any other reason, then if you have to pay some 10%, 20% more, so be it. Your payback period may get elongated, but ultimately, you have to have that asset in your books. You have to have your asset in your pocket in order for your sustainability, for your growth. So in other words, what you see is that, is this asset useful to me? Is that asset going to be helpful to me from a long-term perspective? If that is so, you might as well pay 10, 15, 20% more. For example, if you have an apartment which is next to you, and you say, no, I need that particular apartment, so obviously you will pay, I mean, to give a very simple example, that yes, you pay 10%, 15%, 20% more. Yeah. So therefore, one needs to first answer as to whether should I have this particular asset? Is this asset going to be useful to me? If the answer to that is yes, then yes, you pay 10, 15, 20, 25%. And the classic example, as I look at it 20 years back, for example, the Vedanta group, they paid money for Hindustan Zinc, and you see today, it has created massive value.
Yeah. So Girish, 10, 15, 20 are numbers, but would you go for a walkaway number that beyond it, please guys come back and don't bid beyond this? How would you look at it at a board perspective?
Absolutely. Deal which we call like a winner's curse. Sometimes you may pay 10, 20% more for your adjoining house, but if you land up paying 50%, it may become a winner's curse. Now, the difference is that when you're buying a house, you're buying something which is, you're gonna live. In a company, you have many more people in the ecosystem who judge you. There are lenders who would have a view, there would be investors who would have a view, suppliers would have a view. So beyond a point, the rubber band stretch can lead to a disastrous outcome. But what I, Anand, also think is that, like all of us in this room, how do we get associated with it? We get associated with it by a query. He'll get a query, I'm doing a non-compete, how will it look at? How will SEBI takeover code look at? How will, whether losses will get transferred, whether Section 79 will get impacted. We get it as a query. Correct? All of us, query. And the trick on the questions which you're asking us, do we go beyond that query and do research with AI tools, understand the whole rationale, understand the whole matrix? So like what Ketan said is that, look, there may be valuations, synergies, all that can be easily studied through AI, understand global success failures, understand global premiums, past example like Hindustan Zinc, and go back to the client with a commercial output. And have the guts to tell the client, you're doing this, I think it's very good, or you're doing this, I think you must not do it. I think that's the difference the CAs have to cross. And not just address that one query in a memo and then convert it into an opinion. So if this session has to take one big takeaway, that guts to go beyond your Income Tax Act or a NDS and in a report form, and AI tools do it. I have 5 AI assistants today. Actually, I have 5 AI assistants.
Sir, I want to say one thing. You said that, okay, I'll pay 15% more, but let's have it. The other one said, no, I will not have it. I will still differ. He is a competitor, he is the sole competitor to my business. If I take him off from the scene, I'll have 100% growth or 500% growth. So I will say, okay, I'll pay 30%, provided I can remove him from my competition. So that is the situation. The case-to-case number should not be 10, 20 or 30. It is the situation where, okay, can I remove him? Yes.
No, which is where what Sanjay said was a very right thing at the start. It's the promoter's instinct.
Yes.
That, if I do this, that 15% is not a big deal. It will come back. That judgment, that's why you don't see L&T doing big acquisitions. Whereas if you see a JSW, Adani, they do an acquisition, Ketan, I think every month, or a Murugappa group, say a CG Power, Tube Investment, the promoter gut, which is, I think, very important. The Lala gut, as you call it. So sir, I agree that 30% also on the gut, not relevant.
I have to remove
Correct.
him. Let me remove Anand from the scene.
Correct.
How can I remove it? Pay 50%. Let's do it. Can I remove the CFO from the scene? Let's do it.
Interesting.
No, I can't do it.
Yeah. So again, Ketan, by coming to you, this pricing is a very, very subjective thing, right? As sir is also saying, it cannot be a fixed number.
Yeah.
And sometimes buyer and seller have their different justifications. And as deal makers, all of us would bring some rabbit out of our hat and say, look, this is how we are wanting to match the price. And there could be some structural solutions that can we look at an earn-out model that you pay something now and then the remaining, if there is a business outcome available, or can you have a non-priced round of a compulsorily convertible debenture where you don't talk about pricing right now, but let the company perform and that is your valuation. So you kind of do a price discovery where the price is not matching. How do you see, Ketan bhai, such instruments or ways to bridge the price mismatch?
Yeah, so I think just stepping back and looking at the bigger picture, see, this earnout model is relatively common in the services sector. I'm not saying it's only in the services sector, but more. So for example, in IT, so for example, I'm involved with a company which is not a very large software company, but reasonably like a 25,000 crore market cap. And they keep doing what they call bolt-on acquisitions. You know, that means the acquisition is not that big. So it may be say like a 300 crore acquisition, and majority of them are in the US. So say $20 million, $30 million, $40 million, because XYZ is in Seattle, that company is doing work for Microsoft, it will give me a foothold. XYZ company is in, MNC company is in San Diego, doing work for the city of San Diego, it will give me this contract, you know, those kinds. So either it is skill, or it is customer relations, or it's a combination of A and B. Now in this case, what happens is, the seller normally paints a very optimistic picture. You know, this is what I will do, this is what I know, my growth last year was 14%, but next year it will be 46%, year after 62%, those kind of things. And I think there the M&A team of the company has a very important role. For example, this company has an M&A committee which is not a part of LODR. It's a sort of non-companies act but commercially driven M&A committee. So we always ask that committee, why, first of all, why did you zero in on the company? Why? What is the specific thing? What are the peers that you looked at? And then to your point, you know, this guy is telling XYZ and you are saying, no, we must acquire this. But what about the earnout model? In many cases, they say, okay. So we are okay. They tell the promoter, you are wanting, let's say $30 million. We are okay for 28 million. But out of the 28, 20 upfront, and 8 will be earnout if you achieve EBITDA of so-and-so, if you achieve PBT of so-and-so, if you achieve a revenue of so-and-so, or a combination of A, B, and C, etc., and we will give that. So in many cases, the promoters agree, some cases they not agree. So it's a question of situation to situation, company to company, how desperate you are to acquire, how desperate you are to, you know, Sanjay gave a very good example, you know, of the flat next door. So sometimes I may have a flat next door, I may have a flat above, I may say, okay, duple banayenge, nahi lenge, it depends. So to your point, the earnout model is relatively much more in the services sector. I've seen it much more in the IT services particularly, but I've also seen it in manufacturing, but lesser. But I think the earnout model is a good way because it is a sort of a balance between overpaying and saying, okay, you say this, I am not saying I don't disbelieve you, but I don't want to put my whole money on it. I'm willing to pay you this if you achieve X, Y, Z. The one thing I've seen, the definition of what is an EBITDA, for example. Top line is much easier. The definition of what is an EBITDA no, sometimes gets into a problem. So, you know, accounting system, depreciation, amortization. What happens if you merge it and then how do you consider divisional EBITDA? What about management cost allocation? So I'm a little uncomfortable with the EBITDA thing, but in some cases you may not have or a PBT thing, but in some cases you may not have a choice. But I think as a practical takeaway, my advice would be to be extremely careful if the earnout is based on profitability as opposed to top line.
Girish, two questions. One is, how do you see this earnout model and any other alternatives to bridge a pricing gap? And B, we have seen a lot of earnout models fail. It's also in a way to say that, look, today we can't agree on a price, and hence let's push the discussion down the road. And as Ketan bhai said, then we get into discussion, what was the EBITDA? What is the adjusted EBITDA? It was a COVID year and performance did not come. Is it good to agree the price upfront and settle it once and for all? And what are other means by which we could bridge this price gap?
Actually, I'll just add one more dimension to it, and it is the tax and regulatory dimension. Say, earnout when you're buying shares of an Indian company when a foreigner is buying. There are FEMA to be looked at. Only 25% can be deferred. Earnout in the case of open offers, where you have to follow SEBI formulas. Earnout in the case of taxation, do you pay upfront Do you pay later? You know, like there are contrary decisions. Earn-out in the context of, say, RBI approval, IRDA approval, and there is a whole ecosystem of regulations which are to be looked at. And then earn-out and the hit to the P&L. So like, if you did an earn-out and said that if that guy delivers that EBITDA, then I'll pay him more. Then whether it is capital gains tax, business income, if it's business income, it's a hit to the P&L. So there are different dimensions. So if you look at the complexity of all those dimensions in listed companies, you don't see too many earn-outs when you're buying and selling companies. Earn-outs happen when, like in Ketan's example, when an Indian company is doing bolt-on acquisitions, when you're doing 100% acquisition, you pay something upfront, something later. So for smaller deals in the private sector, I see a lot of earn-outs happening. But for listed companies, I don't see too many earn-outs. People rather do clear deals, and then people put reps, warranties, and indemnities to adjust for whatever is the delta to be adjusted. Now I come back to the profession. For us to go back and come up with those models, okay, you know, this land is not a clear title, let's look at a model wherein we, you know, pay on milestones or pay on things. You know, going back with those commercial suggestions, marrying, because see, we have a unique advantage. iBanker will say do an earn-out, whereas a chartered accountant come iBanker and a lawyer come chartered accountant come iBanker like Sanjay would say, you will do earn-out, this is how you can do it, compliant with FEMA, compliant with SEBI, compliant with accounting, and this is a solution. So solutioning that, what Ketan said, in a deal-like scenario is, I think, Anand, the key.
Interesting. So we spoke about whether to do an M&A. We came to why this company and not this company. We spoke about pricing, how to bridge the pricing. Sanjay bhai, we next come to diligence, right? I mean, they say that deals fail in diligence, or you know, you need to have diligence to cover some of the value-driving aspects which are there. In your experience, the rigors of diligence, how does a board make sure that there is appropriate diligence? And there is no accounting standard kind of a thing that this is how diligence has to be done. It's a very bespoke thing based on risk and value attributes that you have. So how do you see diligence as a process in M&A transactions?
No, you've touched upon a very important part, and yes, in my view, the devil lies in detail. And therefore, diligence is extremely important. Now one has to break it up into A, B, C. As to what are the A items on which the entire transaction is hinging upon. So those, surely one has to look at it with an absolutely microscopic eye. If you're not happy with those A category of items which are pivotal to the growth, which are pivotal for the acquisition, which are pivotal for the transaction, then yes, surely one has to do it. Now, whilst we are talking, okay, my team is working on something where they have to complete the diligence on Tuesday. The transaction has to get signed on Friday. So obviously it's a very, very arduous task. So the point being that yes, at times you get into a situation wherein the time is short, the transaction has to get completed, there are diligence issues or there could be diligence issues. How do you tackle those? But you can't rush into a transaction merely because the seller is putting pressure on you. You can't have a situation wherein your diligence is not complete. And it can't be a desktop diligence. It can't be a diligence which is done by junior professionals. It has to be the senior professionals necessarily have to get involved in the A category items as far as the diligence is concerned. And obviously it does affect the price. And after, if the diligence is half-baked, and in case the skeletons come, okay, you can't say that, look, lawyer did not do a good job, the reps and warranties should have been this, the indemnity clause would have been there, etc., etc. The management, the professionals, the Lala, everybody has to look at it. Okay, these A category items, am I satisfied that yes, they are kosher, they are, if not 100 on 100, at least more than 90 on 100.
Perfect. Ketan bhai, I'll come to you on your views on diligence, but also help guide the audience in terms of this concept of vendor diligence. and how is it something that is helpful. And the purpose of diligence is to cover risk. And today you have these tools of insurance and reps and warranty insurance available. How common do you see them being adopted in the Indian context?
So I think, let me first, because it directly flows, on the concept of diligence, then I'll come to vendor diligence and then to reps and warranty. So on the concept of diligence, Sanjay, I absolutely agree. I just want to add 2 or 3 dimensions to this. First is we must be very clear what diligence are we talking about. So there are 3 types of diligence broadly. One is commercial, or maybe 4 types. Technical, I'll come to that in a minute. Financial stroke tax, maybe more financial than tax, although in some cases tax, and of course legal. So commercial diligence is, let's say, what is the rationale why I'm acquiring the company? So for example, if it is customers, okay? In one case we found, my client was thinking of acquiring for certain customers, but when the M&A team went into it, they found that one of the contracts expiring next year, the customer was very unhappy, we figured out in some way, and at the end of the term, the contract was likely to go. So that is a part of commercial due diligence, okay? That I am acquiring for say 10 customers and this customer was 20% of my business, the others were smaller. And if the 20% customer was likely to go, then it's a risk. One way to look at it is, okay, I can take over and then convince him not to go, but it's a risk and I have to build it into the price. So this is a part of commercial. Technical and manufacturing is, what is the quality of his plant, assuming it's manufacturing, does he use robotics, etc. So that's a very different type of technical sort of manufacturing duty. It's sort of an offshoot of the commercial, but a sort of very different offshoot of the commercial. Third is the financial and tax due diligence. And the financial, one of the biggest issues, we are looking at a small acquisition currently, and we had a discussion with the potential bidder. It's again a small company, and he's saying, look, I just cannot afford some big liabilities, and although the acquisition I'm doing is small, it is coming out of some stressed parent, and I'm not sure whether some bombs are sitting inside the company in terms of, so I asked him some examples he gave me. So I said, okay, we'll have to look at it, we'll have to figure out, because I want to understand your mind, what you are fearing. And of course, there could be tax due diligence and legal diligence. So Sanjay, for example, Girish also mentioned, land title may not be clear. In one case, here we are the sellers, and our lease, we are not sure whether it is transferable. We are not sure. It's a very old land with some salt pans and all, some 50, 70 years old, and it's a 99-year lease, but we told the buyer, look, you will have to take, and that land is important to them. We'll have to take a call. We don't have any ability to transfer it. We don't have the political muscle to get the transfer done. Now you'll have to take a chance and see, and we have agreed upon a reduction in price, etc. But we don't want a condition precedent that before the transaction we will be able to transfer the land. We said we do not have the muscle to do that. You will have to take that call. So it depends on what. Now coming to your second point of vendor due diligence, and I'm sure many of the people in the audience are aware. So in a vendor due diligence, what happens is, I'm a seller, okay, I have a Big Four or any other large, or Anand Bathiya's firm, do a due diligence me as a vendor. That means the buyer is not doing the due diligence. I am doing it myself, self-check kind of thing. Now you come as a buyer, you are not going to rely on the vendor due diligence. But the fact that I've got it done, and especially if I've got it done with a reputed firm like his, you will say, okay, I'm 80% comfortable. And in many cases we have found that the vendor diligence, I've told my client, look, let me see who has done the vendor doing XYZ firm. Okay, let me see who is the partner involved. I said, I think 80-90% you can. Of course, if the vendor due diligence is very old, then I have to do an update diligence. But it definitely helps. Of course, from a client standpoint, it increases the cost, pain, and one of the problems in a vendor due diligence is confidentiality. Because when you do a vendor due diligence and the staff starts getting uncomfortable, ki chal kya raha hai, are we selling, what about my job, etc. But I mean, it will depend on the situation. But overall, I think vendor due diligence in appropriate cases may work well. In some cases, it may not work well.
Yeah, the other advantage of vendor diligence is also that there'll be no surprises from a buyer diligence, right? You would have done it yourself, so you know any red flags which are there.
Absolutely.
And sometimes in a bidding process, if you have more than one bidders, you would want that, I don't want 5 people to do 5 advisors and 5 diligence. Might as well do myself nicely and share reports with 5 of them so that they can base their bid based on that. So one concept of vendor diligence is also something that we can advise our clients to deploy on.
Oh, absolutely. But as I said, no, Anand, that in practice I have found this confidentiality is an issue here. And ideally I don't want, this thing floating around with 5 guys, Then I'll try and see who's more serious and restrict it to 2 people. See, what happens is, in this Swayamvar kind of situation, it has its own negatives here. I mean, you have to also consider, see what happens also, it's not only staff, Let's say customers come to know of it, suppliers come to know of it, lenders come to know of it. Even if you are a closely held company, people get uncomfortable. So I think this entire process of sale and purchase, and especially if you are the seller as opposed to the buyer, that whole process has got some serious sensitivities and needs to be handled carefully. See, one of the points I wanted to make, I forgot to make. One of the problems where I'm facing in actual practice, all of us are facing in practice, is the length of time that it takes to complete a transaction in India. Even if it is an unlisted company, or let's say a merger. That time frame is driving people nuts, because what happens within that time frame is a whole set of companies. Because life is going on in the meantime. Okay, while a merger is going, PVR Inox merger is going on, 12 months. But life is going on. So exhibitors, film, people from whom you have taken studios on rent, etc. I mean, all these things are going on in the middle. Dealing with that whole ecosystem, having your internal team aligned, explaining to them why the delay. So this is again, so therefore, as a practical takeaway, just making sure that somebody is focused on compressing the time as much as he can is very important, and having different identified work streams, naming those work streams, putting people with specific charge of that work stream, ahead of that work stream, who knows that his evaluation and his career path is partly dependent on it, blah, 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 and making sure that there's a project office that they internally coordinate, I think are also some important practical examples.
Interesting. Girish, Ketan bhai spoke about the regulatory delay and the risk arising of that. But in the Indian context, even sometimes when you are doing some internal reorganizations, the tax department after 3 years can come back and say, look, this was not done appropriately. The recent demerger example where someone is saying that the holding company issuing shares is not a compliant demerger. Or we had the whole controversy of treasury undertaking being an undertaking or not. In the internal restructuring, how do you minimize or mitigate risk of any kind of such regulatory considerations going forward?
I would say by not being clever. If somebody comes and tells me today, I want innovative ideas, it scares me. If somebody comes and says, I want to do tax planning, scares me. The more clever you are, the more likely you are to suffer in 3 years. I think the law has become more substance over form now. And the law is going by the intent of law than the literal reading of the law. Say taxation of sale of OFS shares, which got blocked. Say goodwill depreciation, which got challenged. Now still people are brave enough. I see marketing presentations saying that do acquisitions, then we will do merger, create intangibles other than goodwill, get depreciation, factor that in the IRR. You're bound to fail in 3 years. This thing about Sterling hotels, which you're talking about, that's a wrong decision. I mean, on the reading of the law, that's a wrong decision. So there I have no excuse. But if you look at a Binny Bansal case, Tiger Global case, intent of law, so I would think the less clever you are, the safer you will be.
Ketan bhai, you have any views on that? I'm sure you have.
Yeah, I do actually. I absolutely agree with Girish with one, sort of supplemental point. See, what is happening, Girish? What is the definition of clever is changing. See, what happens is, I was telling somebody in a slightly lighter note, I said, if you do something which is very aggressive, the chance of risk is very high. If you are very conservative, also sometimes I think the chance of risk is high. You know what is happening? Look at what happened in Sterling. I couldn't believe that judgment. I can't believe it. Number one, Tiger Global. I just cannot believe that judgment. You can write 300 pages in fantastic English. Oh, what are you writing? So I'll give you what I'm saying. The Tiger Global was a situation where shares were acquired by, I forgot the private equity, in Flipkart, the Tiger Global, sorry, in Flipkart before 2017. What is the relevance of 2017? Because the India-Mauritius Treaty and the India-Singapore Treaty were amended in 2017 to say there is a grandfathering, and after this if you buy, the tax will be there. Arey Baba, the whole purpose of the grandfathering was to accept the earlier ones, no? And remember one thing, if most of you are, very young, so you will not remember, but Sanjay, I, Girish, we all will of course know this. In 1991, when the industrial policy came, Manmohan Singh was the finance minister, Narasimha Rao was the prime minister. I distinctly remember because I was 34 years old at that time. And I realized that life had changed because FDI regime was completely changed at that point in time in a positive sense. And in 1992, the FII regime, or what is now called the FPI regime, came. And around that time, the India-Mauritius Treaty was remodeled. There was something called MOBA. There was a director of MOBA, Mauritius Offshore, Rajab Ali, whom I met in Mauritius. The whole thing was predicated on the basis of attracting foreign investments into India. It was a blessed tax avoidance. They said, we know you have nothing in Mauritius. We know that. But you get a TRC and we are fine. And Azadi Bachao Andolan said that. Still Tiger Global happened. The point I'm trying to make is, what is clever in this? There was nothing clever. You were just following the law, and then you have a 300-page decision which turns your life upside down.
No, so I'll add the clever part of it. The clever part of it is that I'm selling shares, how to save tax. Okay, go to Singapore. Go to Mauritius. Then, you have old shares, do it. Clever part of it is we all sitting here in India, we want to set up a fund set up in Mauritius. We'll all manage it from here. So the clever part, there are, Ketan, there is always a substance. Clever part of it is DIFC, go and set up a trading company there, we'll start parking profit there, we'll make it tax free. So being clever without substance, Ketan, is a problem, I think. Yeah.
And just one,
there has
can
to
I
be a
add
commercial intent behind that.
Correct.
For example, just now we are fighting 2 GAR cases. The orders should come from the High Courts very shortly, which will obviously be carried either by the department or by the assessee to the Supreme Court. There, the entire hearing, both at the GAR tribunal, at the GAR panel level, as also at the High Court level, the commercial intent. If there is a commercial intent, yes, there may be some tax savings, there may be some carry forward business losses which you will get to set off. But there has to be, and even 30 years back, you see wood polymers, any restructuring, wood polymers is very clear. So on anything which you do, if there is a commercial intent, then you will be able to fight out legally, technically, yes, there was a commercial intent, which is why I did something, and not for the purpose of saving some taxes or dodging some regulation.
May I add to that?
Please.
I 100% agree with you, Sanjay. You know what the point Sanjay made is the heart of the issue. The question to ask, is this a commercially driven transaction with, let's say, a tax saving, or the other way around? If the answer is first, then GAR should not apply. I think one of the councils gave me a fantastic example recently. He said, suppose you have to come from Nariman Point to Bandra, okay? You took the road which made most sense, which is the coastal road, rather than coming through Pedder Road and all that. And because of that, you saved some time. So if your commercial intent was to get to Bandra and you took the coastal road and you got some benefits out of it, that's fine. But if the commercial intent is not there, or you cannot establish it, so which is another point, Sanjay, one of the problems I've seen, you are absolutely right about the commercial intent. Sometimes, you don't have the documentation to establish. I'll give you an example. In one case, the bankers wanted the 2 companies to merge, the profit making and the loss making. The problem was the client, and this thing came up, you merged because of loss, blah, blah, blah. I'm not able to get a letter. This was some years back, fortunately, it went through then later. I said, yeah, did you get something in bankers, this thing, some mail that, okay, you are telling me this, we had this discussion, I'm looking at it. The ability to establish that commercial rationale, that I did it because the bankers were pushing me also. I had commercial reasons. Otherwise also, the bankers were also pushing me. That was another commercial reason. By the way, this is why I got the tax benefit, but that was not the driver. I mean, that's the point.
So I just want to just add one and you can just think. So according to me, the definition of clever has changed. We all have to add value to business, create legacies, come up with winning ideas, come up with value creation ideas with our client, and not dodging laws. So our clients are also expecting them to be guided to do the right things, creating value in business and not dodging laws. And Ketan, Sanjay, I don't know what you both think. What I'm seeing is now the professionals are as responsible to a regulator as the person who has the proceeds of client. So I mean, if you see a Vedanta...
Lawyers have little protection.
Yeah, but Sanjay, chartered accountants, if you see...
I'm on a lighter vein, I'm saying.
So the Vedanta ED thing which I was reading, I know professionals who have signed up on TP reports who've got summoned. And I know people in the industry who are dodging the law, being clever, also getting summoned and being on the other side of stuff. So I think the definition of clever is thinking growth, thinking value add. So value addition on mergers and acquisitions. Not doing Coca company mergers and saying I'm merging, which is not clever today.
Correct. And I think just to extend Girish's point, I was recollecting one incident when Shri Azim Premji was addressing a group of chartered accountants. And the question came up that, what should be a good structuring versus a bad structuring, etc. What is sometimes it is grey and not black and white. How does it pass the smell test? What is clever, etc. His answer was very simple, that for a professional, grey is black. And it was categorical. If you are a professional, grey is black. It might be a pendulum on the other side, but that's what the expectation by the society, by the entrepreneur, by the new communities, that if you are a professional, grey is black. It might be counterintuitive to few of us who are, kind of feeling that we are there for saving a few bucks in tax, but that's not maybe the only reason why we are. And that hard-hitting message was very clear set in stone, Girish. I'm just cognizant of the time. I want to take 2-3 floor questions, but before that, I want your views, Ketan bhai, Sanjay bhai, Girish bhai, on one recent trend of flips and reverse flips. Again, from the concept of merger acquisitions or bringing the holding company back in India, for the longest time, we saw people being forced to register overseas under a hope that perhaps they may be able to list in the US or Singapore or maybe attract capital better over there. And many of the new age companies had their holding companies overseas, which was flipped. Now the thought process is that the Indian markets for the longest time have been value accretive. The P multiples have been higher and people have been forced to flip it back to India. And that involves a lot of regulatory rigmarole, Girish, as you know. A, how do you see that trend? And B, what are the regulatory nuances that you can highlight?
I would say the trend is here to stay because the Indian markets are definitely giving better multiples and more so relevance. So I had a lot of cases, advising from a Lenskart IPO, OYO and different kinds of stuff which are big. But in the US context, they're not even a followable stock. In US context, below $10 billion, below $15 billion, nobody even writes about it. So where you could be a king in India where $1 billion is a celebratory IPO. So really the relevance, the market multiples are going to see more and more reverse flip happening into India, leaving technology where say a pharma or a SpaceX-like thing where US will understand things better. I would say the reverse flip trend is here to stay. But it has its own nuance. If you are reverse flipping from US, there's a US tax, there's a shareholder tax, carry forward loss impact. It's not as easy as it sounds. Singapore is easier, but Singapore owned by US people are also a difficult flip. Dutch cannot be flipped into India, EU cannot. So Anand, it's not a black and white answer, but I'm seeing the trend here to stay. Somewhat reverse.
Yeah, I think I agree with what Girish is saying. And also people, to pay that kind of tax also in a reverse flip. Sometimes it may not be required, but sometimes it may be, many times it will be required. For example, in the case of Grow, they paid 1,300 crores, $160 billion at that point in time. It's not a small amount of money. They paid it, but I think the Indian valuations being sometimes higher, and for a variety of reasons, you can get lost in the global market, the size may not tally, etc. And of course the multiples, and of course I'm talking now about multiples of say FMCG companies, whereas this is new age. But say Hindustan Lever multiple in India is say ranges, or Nestle is usually between 60 to 70 times. Globally it will be 20 to 25 times. Suzuki, the valuation of Suzuki is probably 80, 90, maybe 100% of the global valuation. So it's like saying that if somebody buys Suzuki Motor Company shares in Japan, actually it's almost as if, he's paying only for the Indian company, and almost as if Suzuki is not valued at zero kind of thing. But that's not actually the way it works. But I'm just simply saying that the multiples are very different. Whereas in the case of the reverse flip, Anand, that you're talking about, we are not talking of a Lever or a Nestle example. You're talking of a re-domicilialization. So yes, it depends on the long-term intent, and of course you're weighing it. You earlier thought that a global listing may be better, a global headquartered may be better. But here you are believing that no, re-domiciliation in India is better, particularly because a large proportion of the business value may also sort of emanate out of India in some sense. And therefore, the ability to attract and relate to an Indian investor base must be higher.
Interesting. And because I have this
as long as you get better valuation. And why would you get better valuation? It's a game of demand and supply. 25 years back, the number of investors, the number of mutual funds, the number of small investors as well, compared to today, because there is a demand for a stock, which is why there is attraction towards India. Will anybody list their shares on London Stock Exchange? The answer is pure and simple, no-brainer, no. Will anybody list their stocks on Singapore Exchange? No. Because you don't get valuation. Why? Demand and supply. Now, for example, in Meghmani Organics, for example, okay, and Rediff were the two first companies we got them listed on Singapore Exchange. And that too on retail board and not on the wholesale board. Why? Because at that point in time, the Indian exchange did not give a good multiple, and the PE had to be given an exit. So an unlisted company in India first got listed in Singapore, and then the government came out with a notification that whosoever is listed overseas has to get them listed in India within a period of 12 months. My point being that it all depends on how is the market, how is the demand and supply, how is the multiple. Now, if there is shortage of paper, obviously there will be demand, and you will have higher valuation and higher multiple.
Perfect. I'm just tempted to do a quick rapid fire with three guests that I have over here. Sanjay bhai, just 30 seconds to answer. 30 seconds, all your three questions. I'm going to put you a spot in one of the questions.
Spot, okay. Then I'll allow it to pass if it is.
But my first question is, one diligence finding that makes you walk away.
One diligence finding, if there is anything to do with PMLA, which would, I would say that yes, that would be a walk away.
If the choice is between overpay by 10% for a right asset versus hold firm and risk lose it, which mistake would be okay with you?
What is the second thing? Pay extra 10% or?
Or hold firm and lose it, which is the mistake you would be okay with?
No, I would be okay with paying 10%.
The last one is, who is more effective, lawyer or CA in a M&A situation?
They have to work together. They have to work together. There is no lawyer or no CA. They have to all work together in order to see that.
Perfect. It's the combination of both.
In fact, way back, I got my membership of Bar Council delayed by 2 years because I had to fight with Bar Council as also with Institute. Sorry, nothing against the Institute. I had to give them an undertaking that, look, I will not sign any valuation report or audit report to both the councils. And thereafter, they gave, yes, you can keep your certificate of practice of CA as also practice as a lawyer.
Interesting. We'll leave it that. Ketan bhai, Fast track versus NCLT, your favorite topic. Which one is a better one?
No, obviously, if it is fast track, the very fact that it is fast track is fast track. But remember one thing, and I find this extremely, I know it's a rapid fire, but I have to say this. In a fast track demerger, the fact that 219AA does not seem to cover it is completely brainless. Yeah. I mean, I can't understand this only. Why do you tell me to do fast track and say, by the way, I forgot to tell you that if you do fast track, you'll be taxed. So why the hell would I do fast track? So answer is always fast track unless it's a demerger.
Yeah, so I had a chance to represent before the Parliamentary Standing Committee when this new income tax bill was coming up. And one of the points we raised was this, that demerger should also be exempt under 219AA. They have responded in their responses policy to say that the NCLT goes through a drill of valuation and all of that, which is missing in ROC. So that is why they don't want to give. So it's
I'll add something to it. The select committee was 31 people, 31 members. I happen to know 2 of the members of parliament personally. I spoke to both of them. No, none of them is a chartered accountant. No. So I did explain for 10 minutes. Both are very sharp people. They understood, but nothing happened. I was just shocked. I said, look at this stupidity. Absolutely. Just like that relative reciprocity kind of, I mean, absurdity, unfortunately, doesn't have a statutory limit.
Ketan bhai, earn out, is it a good way or a trap?
It depends on the circumstances. In appropriate cases, earn out is a good way, for sure.
Cash or stock, what would be a mode of payment that you would prefer?
It depends. Also, it may not be my choice, no?
Yeah.
Because the buyer may, seller may say, you want to give stock, you know, but I don't want to, you know, you are offering me non-vegetarian food, but I'm a vegetarian.
Interesting. Girish, we'll just go to you and then take some audience question. Demerger, is it really value creating or stock market theatrics?
No, I think there is value creation in demergers, certainly.
Flip versus reverse flip. What is your long-term trend that you are seeing?
Reverse flip, many of them.
Complete the sentence. A deal is won or lost not on price, but on dash.
It is actually on culture and emotions.
Culture and emotions. Wonderful. I think with that, we'll sign off for the panel here. We can take a couple of questions if there are any, and then we'll close the proceedings. Yes, sir.
We discussed about listed entity, you get actually instant gratification or at least an answer whether merger was a success or not a success. How do you go about advising the client or where you're working? Because as a finance guy, there is no gray, it's a black. Whether this deal was success or a failure, how do you go about dashboarding unlisted space?
Yeah, if I've understood your question right, and I'll repeat it because everybody may not have heard it. So I think what you are asking is that if you are advising on whether to merge or not, and one of the issues is the share price, how do you sort of judge that, and how do you advise on this?
No, his question is that if it's an unlisted company, how do you measure success or failure?
Achha, in an unlisted company, okay. 2 unlisted companies merging, is that what you're saying? Yeah. So I think the real answer is how will that merger pan out in terms of, say, profitability? For example, one of the reasons would be growth. One of the reasons would be profitability, as Girish was correctly mentioning. So I think the key issue is, as a result of, first of all, what is the rationale? You know, what happens is, I've always said, the identification of a problem correctly is 50% of the problem solved. What is the problem you are trying to solve? What is the rationale that you are trying to do the merger for? And what is the what-if scenario? If you merge, after 2 years, how will this look? How will this look? So one of the things I've always said, create a business plan for the future for a merge scenario versus a standalone scenario. So as Anand, you correctly mentioned in the beginning, will this merger in a 1+1 lead to a 1.8 or will it lead to a 2.5? Of course, some things you may not be able to envisage. Look at PVR Inox. They merged because they could reduce rentals on properties. They merged because they could hike up advertising rates, and I think they were all very good rational, but it's not really worked out, not because they were wrong in thinking, but because Netflix and OTT and Amazon Prime happened. So people are not going that much to theatre. Now, you can't judge all that, you know. So it depends on the situation. But as I said, the making and evolving of a business plan in a merge scenario, which is a standalone scenario, is one possible thing, but you have to make very sure that the assumptions are right. The assumptions underlying the projections should be sensible, rational, and thought through.
Yeah, absolutely. And I think just to add, there is a science of synergies as well. And there is a lot of literature available around how do you quantify these synergies. So large acquisitions, you will be seeing management come out with a synergy number as well. That as a part of an acquisition, we think that we'll realize this much of synergy over a period of time. Now that has basis in terms of calculating, as Ketan Bhai said, the with merger model and the without merger model. In those both trajectories, what is the difference? Is generally the synergy. And that synergy quantification, if you test it 3 years down the line, did I actually achieve? That is maybe a litmus academic test of whether it is successful or not in an unlisted company. Not to forget the other non-quantitative aspects, qualitative aspects of culture, etc., that also come into play. Yes, sir, please.
Girish was saying about HDFC Bank. Even KK Mistry has said that we are not able to communicate well. That is the reason market is going down. And he's saying this consistently since 2.5 years. Nobody can doubt HDFC management. So maybe scenario is such that you're saying because of merger things have gone down. Otherwise, both the institutions would have been down. Because of the scenario. Please clarify.
Story building. There is nothing like.
No, I agree with you. I think communication is the key, and monitoring the progress we have in the communication transparently is also the key. And I think, for unlisted company valuations, what I see is that one is vanity. One is you do an acquisition statement, Rajasthan Royal acquired, vanity, it's like statement. And second is the next round of funding. So like what I see is that in say off business or where roll-ups are happening, like if it's a very acquisition, the valuation for next round of funding goes up. So that's how they measure the success or failure of M&As. And of course, we spoke only about good examples, but Byju's collapsed with acquisitions. So there are many bad examples like that also, where companies have ceased to exist because of M&A. So.
UK is nowhere on the sea.
Sorry?
Go ahead.
UK is nowhere on the sea.
Yeah, yeah.
Just scream up. Yeah, stand up and scream up. Thoda loud. Can you be a little loud?
Yeah. 10 years from now, we'll have a large domestic private equity who will be kind of doing multiple acquisitions or creating real value creation.
I think the question is around acquisition funding. Earlier, leverage buyouts are triggered by NBFCs and PE funds.
I think the challenge is not. So there are two challenges. One is the funding. Now, 75% of the acquisition can be funded by a bank. First, banks could not fund acquisition of shares. Now, the banking regulations permit up to 75% of acquisition to be funded by banks. The challenge, I think, where I see with clients is the debt pushdowns. So typically, like I would form an SPV, borrow money, acquire companies, or acquire company in an existing company, and then I have to push down the debt, service the debt. Interest deductibility for acquisition of shares is a good case to argue, but no clear answers on that. And then debt pushdown is a very big example, especially with GAR. Like, I form an SPV, then merge that SPV into the target. Commercial rationale, debt pushdowns. Internationally, that is not there. Internationally, there are group consolidations. Like in UK, you acquire a company, it's a group consolidated. US, it's a group consolidation. So RBI is a small step. There are many more ancillary steps which I see, which is not favoring Indian acquisitions by Indians. It just started actually now. I don't see too many cases because the cost of funding is very high, but it started now. Let's see how it goes.
Perfect. No, I think we have, okay, we'll take one last one.
Now my question is to any panelist whoever wants to answer. It's more from the listed space where we see, that IT companies are going through to some extent existential crisis. Do you see that
in some way the investors are pushing them for some innovation in AI or going for merger acquisitions. How do you see such trends? Because then these companies are being pushed to go for AI. When they buy, you see 15% down and 20% down. And we as a retail investors are really losing money. And the moment you see your own shares getting hit 15-20% down, then you really feel perplexed whether you should actually, hive off your position or you should continue. So what is your? Yeah. No, actually it's merger and acquisition.
Yes, it's partly a stock market question really. But if you look at it commercially, we are in a very volatile scenario so far as AI is concerned. Honestly, a year back, I could not have imagined that this is the kind of disruption that will take place. Look at what has happened to the TCS share price, right? Or the whole IT sector. It's unbelievable, and it has taken most people by surprise. Having said which, I think what is happening is companies are taking some very serious bets. So the Coforge acquisition of Encora is a classic example. And whether it works out or not, this will be seen, because they have taken a big bet on AI. But I don't think that there is much choice for IT companies but to take bets on AI. Now, what are the ways you can take a bet? Internal bet or external bet? So in one software company where I'm involved, what we are telling the management is to track. They call themselves AI native. We said track AI related revenues. Okay? And how do you define AI related is another nightmare. So he's telling something, but I'm not understanding how he's defining the AI revenue. Because it's easy for us as non-AI IT people to get fooled with all that. And persistent. Girish, you mentioned about they have paid for Nagaro 140% premium over the share price. Now, this is an extremely smart company, so I'm sure they have their reasons. So, it remains to be seen. As an investor, if you're an investor in the IT sector, it's a completely stock market question. I don't think I'm qualified to answer that. But you have to take that call. You have to, if you are with that company and if you want to hold on, you are relying on the management.
Actually, I have a aggrieved investor answer to that. So let me answer that. So the more and more the ICE sector goes down, the biggest fund managers come and say the worst is over, contrarian bet, time to enter IT, and next year it goes down again. So when big fund managers talk that IT will rebound, it's a contrarian bet, that's the time you have to exit, because the distribution is happening.
Great, I think we have gone beyond the scope of this session into stock market as well. But thank you so much for your patient listening. And once again, thank you for all the panelists for taking it forward. Thank you.
As the saying goes, save the best for the last. I'm sure you'll agree with me. So on an individual level, on behalf of the WRC of ICAI, Mr. Girish Vanvari, key takeaways, just to summarize, would be let us add value as a professional to our clients, for our clients. Sanjay sir, let us keep that Lala instinct intact. It was a very nice takeaway. Ketan Dalal sir, grey is always black. That was my key takeaway for me. And Anand Bathiya sir, that was a wonderfully conducted session. I would request every one of you to carry out with a warm applause, a vote of thanks. Thank you everyone for spending such a wonderful rainy Saturday evening with us.